method of determining the trend. And the Keltner channel was invented by a guy called Chester Keltner back in the 60s, and he wrote a book on making money in commodities. And it's just, that book is generally forgotten now, and not too many people look at the Keltner channels, which is a great shame, because as you can see from the slide we're showing here, this movement down is delineated by the trend itself. First of all, we should say that he based it initially over a 10-period. It's a 10-period moving average, and then a multiple around it, generally between 1.5 and 2.5%, or 2.5 times. The charts that you're going to see today will be shown at 1.5 multiples, and the moving average is based on a 13-period. And the reason behind that is that I'm a great fan of Fibonacci numbers, to be perfectly honest, and over the time, especially with the computer software we've got today, you can experiment with different inputs, both on the percentage of this Keltner channel, the moving averages, whether they're simple, exponential moving averages, etc., and find the one that works most consistently. I'm not somebody who believes in using one set of inputs for euro dollar and another one for the FTSE, for example. I prefer to have some sort of consistency, so when you're looking at things, you're looking at the same input on every chart that you look at, and that also applies whether you're looking at an hourly chart or a daily chart. So what I'd like to do is go through a bit of the theory with some charts that are in the past, but not in the dim and distant past, quite recently, and then if we've got time, we'll look at current charts and see what the Keltner channels are showing us at the moment. So first of all, we're looking at dollar yen on a daily basis, and we're looking at June through to the middle of July this year, and a decline of more than 11 big figures during that time. And even at first glance, you can see how the Keltner channel and the 13-day moving average, which is the midpoint, they act as a great indicator of trend, keeping positions either short or square until July's early bounce from the psychological 100. Of course, you can see the spike down there on the Brexit thing, and that will obviously pop up when we look at the live charts on cable. But to be honest, as you can see from that point, it was the Keltner channel still delineated the close on the Friday after the polls. Now, the first point to notice is the extreme high. After gradual gains during May, at the end of that month, we saw a high at 111.45. Prices are still close to the top of a rising Keltner channel, and the trend, therefore, is still going to be assessed as positive. But the month ended with a dark cloud cover on the daily charts, and this warning was followed at the beginning of June with a move down through the 13-day moving average and the midpoint of the Keltner channel. And that led to 2 solid down days, and most importantly, took the dollar yen to the lower band of an increasingly negative channel. It's when the spot prices are hugging the lower end of the Keltner channel and even exceeding it on the downside slightly that the trend is emphasized. And during the next 9 days, prices fell by another 3 big figures before the market saw some consolidation and attracted some profit taking. I think it's likely the rally would have been contained by the midpoint of the channel under normal conditions, but as I've just mentioned, this wasn't normal conditions. The real world does enter technical analysis sometimes, and you can see the exceptional circumstances that Brexit made, not just on dollar yen, obviously. Massive extremes as a result of the vote was anticipated and then reacted to. What is interesting is that after the shakeout, the market returned to the underlying negative trend that was apparent beforehand, perhaps in a slightly less pronounced way. The bounce from the lows, or the post-Brexit lows, was very limited over the next 5 days, and it did end with a bearish engulfing pattern. I should stress that you have to bring other instruments into the Keltner channels. No technical tool indicator is a standalone. As I said beforehand, this is not a science, this is an art. And so you have to build in a few tried and trusted tools that you can employ on a consistent basis to formulate your analysis and therefore your trading views. Now, that failure did lead to another move lower, marked by the tracking of the channel base just about. It was obviously less pronounced, and it did reach the emotive 100 level. And this is a much better base than the 9901, which was created by the UK vote. It's at that 100 point that enough investors see value to reject the lower end of the Keltner channel, and it created a bullish morning star pattern. And importantly, at the same time that bullish morning star was confirmed, it broke through the midpoint of the Keltner channel and turned things positive. And as you can see, the renewal of buying interest then takes dollar yen to the top of what is now a positively trending Keltner channel. You can see from these points how the Keltner channel helped determine the trend. It confirms the strength of a trend, and it also provides levels to consider entering fresh positions or for taking profits.
Alan?
Yes, sir.
Just a quick question from Stuart. He says, what are the outer bands defined by? Is it just a percentage of the moving average?
Yes, it is. It is a multiple of 1.5 times or 150% in these particular cases. I'm not a great one for mathematical formulas, etc. But a quick Google of Keltner will find the actual inputs. It depends on obviously which system that you're using for drawing your charts. Most of them nowadays will have Keltner channels, and even MT4 has it, not in the default stuff, but you can obviously download there's at least 3 different programs that will show the Keltner channels on there.
Fantastic. Thank you.
I should say that although I'm basing all these charts on a closing basis, it is possible to calculate it on different inputs, and some people do. And again, I would encourage anybody to try the Keltner channels out, but to experiment with other inputs. So if we change that to the opening price rather than the closing price, you can see that there's not much difference here. But based on the higher price, this will show more extremes. It's too conservative in an uptrend, and it's pretty aggressive on a downtrend, and vice versa when you're basing it on the lows. But again, we come back to the fact that these things are tools to be used, and your own style of trading really needs to have this adapted to it. So you can try these things out. If you're a more cautious trader, you'll use a different input for the Keltner channels. If you're more aggressive and you're happy to take a few hits now and again to get in earlier, then you'll use a more aggressive method of looking at it. So we're looking at the DAX now. I know most of the guys who filled in your poll earlier on were talking about FX, but a lot of people trade intraday on the DAX as well. And we're looking at the DAX future. We always look at futures rather than the actual cash price. It's much better for definitive open close highs and lows. And this is on a 1 hourly basis in between the 3rd and the 10th of August. And you can see pretty solid appreciation, and the Keltner channel was an excellent indicator of how strong that positive trend was during that time. The market did base in early August after a preceding downtrend, and it was marked by consolidations first of all at the oversold extremes, but gradually higher lows led to a close eventually above the midpoint of the channel, and that was a clear indication the downtrend had ended, although we were still looking for confirmation before looking or being committed to the top side. Now that confirmation was provided here by a move to the top of what was an increasingly positive channel. To be fair, the net upside was limited, and it did lead to a sharp setback. As I say, the more you drill down, the shorter dated you look at these things, the more there is potential for blips through it. And sometimes, especially if you're looking at hourly charts, you have to be very careful of what hours you look at these moves on, if you see what I mean, in the sense that the first couple of hours are pretty important. Lunchtime, mid-morning for something like the DAX is less important, and then there's an afternoon spurt as New York comes in, which again is very, very important. Later trading is obviously thinner, and therefore moves until the close are of less significance. So you have to build these sort of things in here. But nonetheless, on the hourly chart, which you didn't see on the dollar yen daily chart, there was a small temporary false break, which we're putting in here. But nonetheless, it didn't take too long, just 2 hours, and the move was back above the midpoint of the channel when the underlying bullish trend was confirmed. And that midpoint acted as a support for almost a day, and then it translated into a platform for a move to the higher band. And as you can see, the steepness of the Keltner channel is starting to accelerate. And that's another thing that's really important. If you're just hugging the top of a rising band, you have a trend. If you're exceeding it, you have a really entrenched trend, and then you can have more commitment to the upside in this particular case, and obviously bigger positions if that's the way you're looking. Now the move outside the top of the channel, as you can see here, so what we're saying about the commitment to the top side, gained more than 140 points in this particular, well, it's just over 2 days, well, basically on a 24-hour time frame. The eventual pullback was limited this time by the midpoint of the channel and the 13-hour moving average. Another reflection of the strength of the trend. The only print below that point was a 7 a.m. open. That's what I mean about how important it is what hours you're trading. So we opened below the midpoint of the channel at 7 a.m. but by the close, an hour later, it was back above the trend. And really that, to a follower of the Keltner channel and trading the Keltner channel, that is really strong confirmation of the fact that you should be long. And as you can see, the buying from that point took the futures back to the top, through the top of an increasingly improving Keltner channel for one last powerful move higher. I think you're getting the picture now about how useful Keltner channels are in identifying trends and the potential correction levels. But we'll move on to the live charts in a moment and see how the Keltner channels are fitting in currently. But finally, before we move to that, one final example, and that's how the range trading. I mean, to be honest, we look afterwards at sterling, at cable, and at euro sterling, because they've been dynamic over the last couple of months. Eurodollar has really taken a back seat during that time. It's been very, very dull, very boring for intraday traders, and that's obviously reflected here on a 2-hourly chart, as you can see from a Keltner channel, which is showing a broad trading range. It's at the end of a bull channel, bull trend I should say, and before a negative trend develops during September. The bull trend ended with 2 sharp but failed spikes outside the top of the Keltner channel, and it formed a bearish engulfing pattern and an outside day, or sorry, an outside 2-hourly period at the end of the positive trend. Confirmation was provided by the next day's decline through the midpoint of the channel. Now the move to the bottom of the channel did take a period of time, and it does seem to indicate a new bearish bias, but there's no follow through, and this is going to be symptomatic as we go through this chart of the range trading. In fact, the market recovers very gradually to the midpoint of the channel and the 13-period moving average. Then there begins a long period of consolidation with the Keltner channel broadly flat. Tests of the extremes, but they're rare and they're firmly rejected. In other words, the market is not hugging the upper band or the lower band to any degree at all. So there's not a trend here, but there are opportunities when it does stretch to the highs, especially on the top side. And it's those failed highs at 112.68, 112.74, 112.85 that would give the market the hint, perhaps, that the next move would be to the downside. And that's exactly what we saw here when the consolidation ends. New bear trends begins with a very sharp deterioration, and the lower end of the Keltner channel is exceeded quite strongly. This time, it's a close below the line rather than a rejection. It's like with all technical analysis and based on candlestick charts, the highs and lows are important, but it's the open and the closes which are absolutely vital. And they're the ones that really define candlestick shapes, obviously, which are important, but also is an indication of what the market, in my opinion, really believes. Especially with FX, there's always in the background the concern that technical levels are well known by virtually everybody, and spot traders very often use them, not to go long at the right point, but to stop people out. I've sat on many trading desks where you know the level is 112.80, for example, and you buy it through to 85, so you stop people out and then you sell it. So the closes rather than the spikes are what you're looking for in all these things. And that's the overall thing. So we've shown that Keltner channels are useful when there's a strong trend up and down, and can also be of use during a consolidation period, although obviously in this particular case you'd have to be quite an aggressive intraday trader to really take advantage of it. If you were a little bit more cautious, perhaps this is a sort of example when you would be standing aside or perhaps looking at something a little bit more interesting somewhere else. So if I move on to, does anybody got any questions on that particular aspect?
Yeah, Alan, thank you. Just a couple of questions. Well, Steph's asking, do you believe that the Keltner channel is better than Bollinger Bands?
Yes, I do. I did use Bollinger Bands back in the past when technical analysis, or when computers became more prolific. People were introducing technical instruments slowly into their software, and Bollinger Bands was one of the first things that were put on there, and they do have use. Don't get me wrong, they certainly do. By and large, I used to use them in the past for looking for extremes, to sell at highs and to buy at lows. But that's when I was more of a spot trader, and nowadays I'm looking for a trend, and I don't think a Bollinger Band is as good at delineating trend as the Keltner channel. I mean, the ideal thing is you put them side by side and compare them, but I think you'll find over a period of time that you'll get more reliable results from looking at the Keltner channel. If you're a contrarian, then you may prefer the Bollingers.
Okay, thank you. If the price action details line up with the Keltner channel trend, but there is high impact news coming up, do you still go ahead with the trade?
I think if you're looking at a position, a view that is longer than the next couple of hours, then yes, you do. If you're an intraday trader, I can't even say that word, but if you are trading inside the day, then no, perhaps you don't. You stand aside and wait to see what the reaction is. As we saw on that slideshow for the Brexit things, the market was already moving with the dollar yen, which is what we saw in the example, was already moving down, and Brexit basically made things a little bit more difficult, certainly more volatile, but it didn't impact on the overall trend. And the same can be seen on the screen at the moment. Obviously, we've got a sterling against the US dollar daily chart, and you can see this here spike lower. It's not the Brexit, that is the flash crash. But you can see even here that the market was hugging the downside of the Keltner channel even before that flash crash. And what was interesting is the market closed back at the line, and then kept on going. Obviously not down to the extremes that we're seeing. But it doesn't matter whether you're looking at Keltner channels or moving averages or candlestick charts. If there is huge data coming out, then you have to be realistic. The real world is entering the market, and you have to have sensible size positions. I think that's more key sometimes than the actual level of your stop losses. You've got to build in that, realism into that as well. But it's always better to have a wider stop and a smaller position rather than a larger position and a smaller stop when it's approaching important data. Although nowadays the amount of really huge impact numbers is certainly less than it used to be.
Thank you. Ben is saying, just quickly, what's the difference between Keltner channels and Donchian channels?
To be honest, I haven't looked much at Donchian channels. I haven't analysed them or used them. They are even rarer than Keltner channels. I don't believe they're even part of CQG's thing. Might well be right. No, and that's why I haven't looked at them. I've been a user of CQG for almost 20 years. I like CQG, although it's very expensive, but there are lots and lots of different types out there, and CQG don't pay me for saying how good their stuff is. They have a lot of technical indicators on there. They don't have Donchian channels. I have seen them available on MT4, but I haven't used them. So I have to confess that if it was on CQG, I'd probably give it a try and see how it compared.
Okay. Nick's saying Donchian only use the highest high and the lowest lows over certain periods. Question from Kumaran, what stop loss size do you use for a day trade, and what risk reward do you look for?
I'm not a great believer in risk reward, to be perfectly honest. I think you can be looking at a 50-point gain with a 50-point stop. There are people who profess not to look at trades unless it's 2-to-1. If you set out to only take profit at a certain point and only take loss at a certain point, then I guess you have to have a sensible risk reward right at the outset and not let that go. But we don't look at it that way, and I don't think a trader on the desk generally looks at it that way. Your original thoughts might be that the cable will go up to 123, but during the course of the day the momentum is weaker than you thought, so instead of looking at 123 you might look to take profit at 122.80. So your profit levels come in. Does that mean you should tighten your stop? From a practical point of view, possibly. But the one thing that I was taught many years ago, especially when you're looking at taking trades from a technical perspective, is where will you be wrong? And where you are wrong is rarely because it's gone down 25 pips or it's gone down 35 pips. It's because the reason you took the position is no longer valid. Let me just widen this perspective out. So if you were long of cable this morning, to be honest, there wasn't from our perspective, we stood on the sidelines for cable. There wasn't a tremendous amount of intraday signals. But if you were and your stop, the chances are you really know you're wrong below yesterday's open, which is at 121.90. Today's low so far 122, the figure. So that's where you'd be wrong. And therefore, if you get long at 122.48, for example, which was today's open, your stop is 50 points. Now, you should be basically saying, I'll only be wrong 50 points wrong. So should I have a full position, a half position, double the position? A great deal depends on what you're risking here, how deep your pockets are, etc. And it's the size of your position that I believe should be fluctuating and not the actual stop. And it's like on the for where targets are, for example. The market is looking at lots of different ways of calculating targets, and obviously I haven't covered today where I would be looking, or how I calculate where we're looking at potential profit levels. But the point here is that 123 is a valid upside target here, but I'd be inclined to be taking some profits if I were long at 122.87. That's the open back from the 20th of October. So, but if it gets to 122.87, you'd be reducing your position. So instead of having, I don't know, say 5 contracts, you might be left with 3 contracts or whatever the equivalent is. And therefore the stop could even be deeper because you'd be losing the same amount of money. You wouldn't do that. You would keep things the way you are. And the way we do things at 3CA is if we have taken some profit, then the stop would be moved up. But to actually say you'd have to have a 2-to-1 ratio or 3-to-1 ratio, I think you're just going to miss so many trading opportunities to look at things like that. I really do. So we don't look at that.
Okay, thank you, says Kumaran, for that explanation. I'm conscious of the time. We lost some time at the start. So, do you want to continue with your analysis?
Yeah, this is not. Obviously, this is a cable chart which is covering. This is today's 27th of October, and you can see it quite clearly how well the Keltner channel has delineated the downtrend since the 16th of September, with the rallies being capped by the midpoint all the way down. What is happening now is the Keltner channel is flattening, especially on the downside. The market is moving sideways. So in our view, or in my view, you'd now be a bit more concerned about the underlying negative tone. It's not hugging the bottom of the Bollinger Band, hasn't broken back above the midpoint, so it's not bullish, but things are moving a wee bit sideways. To be honest, until some more bad news comes out of Europe, then we've got to the stage now where a tremendous amount of bad news is inside sterling assets, and the market needs some more bad news to begin things, or people will slowly unwind positions and you might go back to the top side. We're a long way from developing into a bull trend here. If we go to the 60-minute chart, obviously things are a little bit more volatile when you see things like here. This was after US figures, and that you mentioned earlier on, do you take that into account when you're taking positions? You wouldn't take, after US figures, you would not take a new position based on this. You have to be practical. You have to wait for the market to settle down. Sometimes it makes sense to stand aside and let the market calm down. Only top banks should get involved when the market's really volatile. Unless you believe in flipping a coin. But here we can see that although the market didn't exceed the top of the Keltner channel particularly, from yesterday 9 a.m. when it hit the top, it was gradually moving higher all the time, and until we got to 1 a.m. obviously overnight in Asia, then that trend was pretty clear, even if it wasn't particularly dynamic. If it had exceeded the top side, that would have shown dynamism. Another example here, going back a couple of days, about using the ranges when the Keltner channel is flat, selling at the top and buying at the bottom, but that takes a fair bit of courage. And if we move to Euro sterling, probably be better to look at the dailies. What is interesting here is the fact that we're fluctuating around the midpoint here. Euro sterling is more likely to move down than cable is to move up at the moment. And obviously that's because the euro is slightly weak, but the fact that it's around the midpoint of the channel makes it a little bit less clear, and we haven't got a particularly dynamic trend. If we look at something, that's not particularly interesting. Dollar Canada, one of my favourites, and we have got a positive trend here. It's not particularly dynamic, but I think it could become so. We've bounced back from the lower end of the Keltner channel. We've gone through the midpoint with a particularly aggressive move. I mean, this is an imperfect morning star pattern. It's not a perfect one because it's nowhere near the bottom of a big downtrend, but nonetheless it's a good indicator. It's gone higher, and now we're tracking the upper end just about, but I think this one has got the power and the trends, but certainly the bottom Keltner channel is showing some aggression. I think we've got potential here to stretch the top side in the coming days, and once we've broken through, there's a level 134 the figure to 134.40. Once we've broken through that, we should see a sharp acceleration, or would see a sharp acceleration if we get through that, up to 35.5, 36 area. Is there anything anybody would like me to put up that we can see what the Keltner channels are showing?
Sorry, yes. The euro dollar is being requested.
Euro dollar.
And
let's have a look.
Okay.
But it's euro dollar on a daily basis. The one thing I should say on these charts, that you'll see in this particular part here, the candles are a slightly different colour. That's because they reflect oversold situation. As I say, you cannot take these things in isolation, and you can see at the bottom there's another 4 oscillators that I use to fine-tune the overall trend. But after a bit of consolidation here, I mean, and basically all this flat movement here in euro dollar ended with this move down that was confirmed to the bottom of the Keltner channel. And since the 11th of October, we have been trending steadily down. Even this spike here hit the midpoint and then closed down at the lows. What we've seen over the last few days is consolidation, 2 dojis which show investor indecision. Yesterday's bounce, but it was a pretty half-hearted one. And I think we're going to see the downtrend reassert. That's compromised a little bit by some of these oscillators down here, but I think if we could see a move back below 108.73, then you'd probably be okay to look for the move to continue down towards the low 107s. But as things stand, you're either short or flat.
what about Caroline's asking a question. What about the red candles? They look like they engulf the previous day's tails. Is that
You're
the
talking about
reason
this
they're...
one here.
Yeah, the red ones. What is the reason of
Well,
them being red? What does that indicate?
the red one, sorry, they show, yes, Caroline's right there, they show outside days where, you know, you've got a higher high and a lower low. Obviously, this one is an engulfing pattern, and really the fact that it, it, it completely reversed that rally attempt, confirmed the trend that the Keltner channel was already showing, and that was a full down day from 5, which confirmed that. And the fact that that was a bearish outside day is generally significant. Here, it is a bearish outside day, but it was a spike higher. It wasn't that high was temporary, and it was on a, it wasn't believable, if you see what I mean. It wasn't sustainable. The fact that it hit here was great, but when you put a formula into a computer, it gives you exactly what you've asked for. So basically, this definition of an outside day is a higher high and a lower low, and it's showing it regardless whether it's a bearish engulfing pattern as well. Here it was quite relevant. Here again it was irrelevant. I place less importance on those than I do the overbought and oversold situation. But I would stress, I think I mentioned right at the beginning, that I'm a trend following technical analyst, not a contrarian. So even when things are oversold, that is a time to either square up or to cut back on shorts. It's not a time to go long, not unless you're very brave.
Getting a few requests to look at the indices, the FTSE 100.
But we can look at Q.
The S&P. I know we've looked at the DAX, I think, already.
Yeah, this is the FTSE. It's not very dynamic, is it? Overall, you'd be short. I did make a long call this morning, and it worked initially, but it's run out of steam at the midpoint of the Keltner channel. There's not enough confirmation here. I mean, we've got a negative DMI difference, we've got negative RSI, negative stochastics, negative momentum, and we're below the line. So your outlook to the FTSE has to be negative, in my view. It's not hugging the bottom of the Keltner channel, so it's not a clear trend just yet. I would much prefer to be shorter when it hit the bottom of the trend, but we're not there yet. Let's look at the S&P. Difficult, the S&P, because of the way it's set up. Let's look at the continuation chart, and there's just so many gaps. This is not my favourite. It's not my favourite instrument to look at in almost any technical viewpoint, to be honest. And here, it's even less of a trend. We're basically close to the middle of the 13-day moving average and the middle of the Keltner channel. There isn't a clear trend. The oscillators, as you can see at the bottom, are very, very flat. I'd avoid that, to be perfectly honest. I don't think there's an awful lot of mileage getting excited in the S&P either direction.
Okay.
And the DAX is quite, well, obviously the FTSE is negative. The DAX is again stuck in the middle. It's come off the highs. In fact, it rejected the top of the Keltner channel here. It's come down to the midpoint, and I think we're looking at sort of decision time, if you see what I mean. The rejection of today's highs is interesting. If selling it continues or accelerates when the US markets open and we get a close below the midpoint of the Keltner channel, then obviously there's more potential for it to go down. But we're a long, long way from either of the Keltner channels. So here again, there isn't a clear trend. That's certainly not what the market's telling us at the moment. Well, I hope everybody will go back to their charting software afterwards and take a look at the Keltner channels for themselves. But if you want to take a look at how we do things on a daily basis, then just go along to our website, which is 3canalysis.com. Take a trial, and you can see for yourself how we try and help people make some money out of these markets.
Fantastic, Alan. I've just posted your website in the message box,
Okay.
so that people can go and visit it. Thank you very much. Just in a final request, we've maybe just got another few minutes. Gold has come up a lot. Can we have a look at the gold?
I'm not certain whether I can, because I don't follow it, and therefore I'm not enabled for it. That's sad.
Okay. No.
So sorry, I can't do gold.
The other one that's come up a lot is the Euro Japanese yen.
Euro yen. To be honest, if I'm really honest, I got this wrong this morning. Very frustrating. Because of this, we haven't got a huge trend. We had 3 up days in a row yesterday, and it hit the midpoint of the Keltner channel on the 13-day line. All the oscillators were negative, and I actually went with a bearish call this morning. And although it flirted with it, it went down initially in Asia, and I thought I was right. It's not working out that way, and we look like we're getting a close above the midpoint of the Keltner channel and the 13-day line for the first time since the 10th of October. If that is confirmed by today's New York close, and obviously we're a long way from that point yet, then you'll see these oscillators, certainly 3 out of the 4 more positive, and then you could be looking towards the top side of the channel. But as you can see, even when it was hugging these channels here, if you take a step back, that gives a better perspective. It is flat-ish. At the moment, you can be trading the extremes. So you're buying it below 113, you're selling it about the 116 level. There isn't much more than that jumping out at us as things stand. It really is taking a back seat. To be perfectly honest, it's amazing how even all these months after the Brexit vote, so much of the market is looking at sterling. And although there are fits and starts where the yen is in focus or the euro, basically sterling is the biggest game in town, and is likely to be so through to when she triggers the Article 50.
Alan, thank you. Tina saying, what's the difference in Keltner channels and Bollinger? Tina, Alan described this at the outset, so rather than go back and do it again live, perhaps you could catch up on that in the recording. I know that you did talk about the difference in Bollinger bands earlier in the session. Ben says, can you let us know what other indicators you would use at the bottom?
Well, there are so many of them, and what I tend to do over the years is look to virtually every one that's out there, except Donchian bands, obviously, as we mentioned earlier. But I have settled for these 4. These are my favourite 4. DMI difference. Most of you would have heard of DMI, but there is an indicator that is a difference between the 2 DMI indicators. I like to track that. This one here is relative strength indicator. Everybody's heard of RSI. This is a stochastic indicator, but it's adapted. Again, most of you will know that stochastics are measured a K percentage and a D percentage. And what I've done with this software here is add the 2 together and have just one stochastic indicator. And and then below that there is momentum. Now all those indicators, DMI difference, RSI, stochastics and momentum, they're all shown on the screen in red. The blue line is a moving average of the indicator, and this is a 13-day indicator offset by 5 days. I use normal moving averages when you're looking at spot prices. For indicators, I use an offset moving average to try and get rid of some of the noise. And what I'm looking for here, just like you would look for a spot price to be breaking the moving average, and as I mentioned beforehand, the midpoint of the Keltner channel is a 13-period moving average, and I use that a lot. That's a big trend indicator for me, even if you're not anywhere near the extremes of the Keltner channel. But I use a simple moving average but offset for the actual oscillators, and you'll find that if you watch when an oscillator breaks its moving average, sometimes it's more important than the spot breaking it. It can be confirmation or it can actually lead, but it's a wonderful tool to play with. If your spot is here not quite so certain, but all these are crossing their moving averages on the top side, which they're likely to, if, as we mentioned earlier on, we close above the 13-day moving average tonight in New York, then you've got your confirmation that things are a bit bullish. So that's those 4 indicators, but the key thing, and you won't find too many analysts who do this, use moving averages on the indicators. Now we don't. The one thing I should say is that if you do take a trial of our analysis, we do not show all of this when we produce our calls. We strip it down. We make it graphically interesting. Let me just show you basically what it looks like when we produce our stuff. We strip out a lot of the stuff that you see below the line. That's for us to work out how we come to our calls. These are the actual. This is how we present it to clients, which is an entirely different way from what goes on underneath the bonnet, if you see what I mean.
Fascinating, great. Is that a trial? Is it a free? Is it a free trial?
Yeah, there is a free 2-week trial. Yes, but as I said beforehand, it is alive. This is why, talking about risk rewards, we update constantly. If I take this back here, you can see that there's been 2 updates on Bunds. So that's the wrong one. On the DAX. This morning, there's one on the Bunds there. We update during the course of the day. We take profits when the market tells us that situation has changed. We raise risk levels when the market is telling us the price has changed, and so it's pretty aggressive. Although obviously all these calls are on the website and the updates are on the website, most of our institutions don't ever log into the website. They are too busy. They basically, we send out an email first thing in the morning which has all the details on it, and we send email updates throughout the day, and that's entirely what it relies on. All our calls are made pre the market opening. The emails go out, well, the foreign exchange managers goes out at no later than 6:45 in the morning. The equities goes out something close to 5 a.m. in the morning, and so it's on people's desks before the trading starts.
Fantastic. Well, Alan, thank you very much. We'll put that website address for those that would want to take a trial in the chat box there, 3canalysis.com. And thank you very much for joining us this morning. There's been a lot of questions come in. I think we've addressed most of them, the people that are asking for the various markets, but if we haven't been able to get to your particular question, apologies for that, but do please get in touch with Alan through the website at 3canalysis.com. And my apologies for the technical interruption that we had at the start of your presentation, ate into your time. We're now eating into George's time, of course, who is waiting patiently. So in the meantime, Alan Collins from 3canalysis.com, thank you very much for joining us, and hopefully we can stay in touch and perhaps invite you again to join us. That's a fascinating presentation, and a lot of people here saying we haven't experienced or know much about Keltner channels, so you've opened their eyes to that this morning. So thank you very much indeed.
Okay, pleasure. Thank you, everybody.
Thank you very much. Okay, I'll take the presenter role back. Just for a moment or two while we get ready to go straight across to George Hallmey, who is waiting patiently for us to go across to him. And my apologies to him for eating into his time. George, I think you're there. Can I hear you? Hello, George. Hi, George. Are you there? I think I can. Okay, George is just not there for the moment, so as soon as he comes back, we'll go straight across to George. For that, he is going to be speaking about his swing trading strategies. And my apologies, everybody, for the technical difficulties that we had at the beginning of this session. My computer, I think my computer here, experienced can only be described as a crash when everything turns off and the screen goes blue, and Windows 10 seems to want to reboot itself. So apologies for that, and thank you for you all for coming back in and joining us. Now, we did record that last session, so if you did miss anything, I know Tina was asking about the difference between Bollinger Bands and the Keltner channel, which is something that Alan did talk about at the start, so it will be recorded and you'll be able to catch up on that on the recording. So we're now waiting for George Hallmey from Click Events. Just when he's here, baby George, if you can hear me, just let me know that you can hear me, and then we can go across to you for your next presentation. So there's the schedule for today. Here we are at 11 o'clock, how to swing trade successfully in 20 minutes a day with George Hallmey. He'll be followed by David Paul at 12 p.m. from VectorVest. Okay, George, I think you can hear me, but I can't hear you. For some reason, what we will try to do is just make you the presenter and go straight across. See if that helps with the communication. Yes, Gordon says the trials and tribulation of being live. Indeed, we're being tested this morning, Gordon. Okay. Now, George, I think we might be having a problem with your microphone because you're unmuted from my end. I believe you can hear me, but I'm not hearing anything, and I think that might be the case for those at home. Can I ask everybody else if they're hearing anything from George, or is it just my voice? No, yeah, just thank you. Yeah, George, it's just us. I think there might be an issue with your microphone. Anything that you can unplug and plug back in? I can hear something. Okay, George is going to rejoin us on another PC. Just a couple of minutes. The trials and tribulations, yes. Well, it may be a cyber attack, of course. We might be subject to one of the hackers. Normally these things run fairly smoothly. Today we seem to be just having a couple of gremlins in the system. Anyway, while we're waiting for George to come back in, we're viewing his screen, of course, but we're not viewing, we're not being able to hear him. So I will take the presenter role back from him while he logs back in with another PC, and we'll see if we can get a better connection then. Just to take you through the rest of the day, while we've got a couple of minutes, you'll see some new speakers coming to join us this afternoon. At 1:30, Dr. Andrew Lumsden-Groom from the House of Trading. He is joining us at 1:30 for a very quick presentation on harnessing economic data to improve the risk-reward ratio. And Francis Hunt, of course, the market sniper, always good to hear at 2 p.m. talking about his HVF, his Hunt Volatility Funnel strategy. The dynamic trader, Zaheer Anwari, at 3 p.m. And Ulrico Bracci, yardcharts.com, new system. Quite a nice, simple system. I met Ulrico at the London Investor Show a couple of weeks ago. He showed me his new system that he's launched with a facility for overlaying the yard charts, proprietary indicators onto various markets, and looking for the triggering, the signals triggering the buy and sell signals as they occur. 5 p.m. Pablo Ortiz. Some of you might have heard Pablo talking about his algos, his robot trading strategies from the FX method. Ruben Miller, Investing Academy, brand new to the event at 6 p.m. The earnings report and profit strategy. And of course, all these speakers will be at the live event that we're doing in London on the 5th of November as well. So you can come along and meet them in person at the Grand Comet Rooms on Saturday, the 5th of November. Andrew Keane joining us from the US at 7 p.m, spotting hedge fund options orders. And finally, Metastock is previewed at 8 p.m. with Jeffrey Gibby, his favorite strategies using the Metastock trading system. So quite a few new names and new presentations to keep it interesting and not to undervalue any of our regular speakers, of course, who we are always grateful for taking the time to join us and give us an update of their portfolios and their view of the markets. So we're waiting for George. I think he's logged back in now. So let's go across and see if we can hear George. Okay, microphone is on. George, are you there? Can you hear me okay? Okay, yeah, he's gone. He's gone again.
This is absolutely amazing.
There we are. George, I can hear you now.
Do you hear me now?
I can hear you now, yes.
Oh, amazed. I've just picked my PC up and I've shaken it.
You were about to throw it out the window, weren't you?
Absolutely, absolutely. My apologies, everybody.
And make you the presenter now. Let's see if that section works.
Right.
So if you can confirm.
Okay, let's get straight into it and we will get started.
Fantastic. I hope you're well, despite these technical niggles.
Well,
We've had our fair share of
yeah,
technical
there's a
niggles
bit
already
of a
this morning.
spike in the blood pressure this morning, though. Right. Now, hopefully, you can see my screen.
Yes, we can.
And do you still hear me?
We're looking
Excellent,
at
excellent,
we've
fine.
got 8 charts, so we've gone into the time. So we'll let you get started straight away. George Hallmey, Click Events, the extreme swing trader. I'll let you get started.
Fine, okay. Right, folks, well, good to be with you. And the trials and tribulations, technically, we all get them now and again. Generally speaking, my PC setup is reasonably sound and solid, and I've got access to 3 PCs, and if ever I have a glitch on one when I'm trading, I of course then can switch over to an alternative, which I find very, very, very useful from time to time, and also it enables me to have sort of multiple windows, multiple sort of order tickets open, so that I can move quickly when I need to. However, let's just get to the nitty-gritty of really what I want to talk about today. You can see in front of you a series of charts. They're MT4 charts, just coming from a regular MT4 broker. They are entirely free. That is one of the great benefits of MT4 charts. And whilst when I first looked at it, looked at MT4, I thought, oh dear, you know, it's a fairly basic setup. But do you know, as the years have gone past, my trading has become more basic as well. There was a time when, you know, I got a few grey hairs, probably more than a few grey hairs. And I go back to the time when we used to sort of get our charts through the post every week. The charts would come through. We'd update them by hand. So that process I always found was very, very, very useful indeed. And it enabled me to get right down into the nitty-gritty of what was going on. Now, back in those days, I sort of was playing around with indicators, devising new indicators and what have you, and I would fill my chart with stacks and stacks and stacks of various little squiggly lines at the bottom of the screen. And what I actually found over a period of time was that I couldn't really see what was going on with price action. And of course, that's where it starts and it ends. It's price action is king. So I started to strip out a whole series of things, and I found myself being able to not only simplify my screen so that I could actually see the wood for the trees, and I started to really concentrate on price action. Now, price action is looking at what is going on with the individual candles or bars, whichever you want to use, and I tend to, from time to time, I will alternate between them. And I'm also looking at the momentum that there is on the swings. Now, we can see over on the left-hand side of the screen, and this is what I really want to point out to you, is that we've got a swing which is going from left to right, it's going from low to high, and you know, this is a classic swing that we get, where we get these A, B, C moves, and we get them all the time, in all time frames. Now, these just happen to be daily, which I'm predominantly trading on daily charts these days. We get these A, B, C moves, and we get them time and time and time and time again. So we get a move up, we get a correction, and we get another swing. And just by recognizing some of these, we can turn them to our advantage. So that if we see a breakout move, this one is over on the left here, you can see the previous down move. This is the breakout move higher. We always get a pullback, always get a pullback, and we can then get in on this next leg and be reasonably assured that we're going to get a good run. And that's the sort of thing that that I'm looking for, and we find, and we're also looking for just general trading ranges when we just stay out of the market. So over here on the left, we've got this nice trend moving up, and then in the center of this, more or less from sort of mid-August onwards, the euro just moved into sideways move. And in this area, we can knock ourselves to pieces if we're not careful. So we've got to do what most traders find incredibly difficult to do, and that is absolutely nothing. So we just leave it to one side until we get some pretty clear signals that things are moving. And we get the breakout. We get the breakout. So the red line, lower red line, picked out the level at which we were going to be wanting to put a trade on, and sure enough, we got the move. Now we did get a little pullback here, but we actually got in early and gave us a nice little run on down. There was a little bit of a jump back, which meant that our stop profit was taken. Very pleased to have a stop profit, and then we've got another little run on down. And what I want to just mention to you right now is that the indicators are telling me, and price action also is telling me, that right now we could be possibly moving into sideways mode, or indeed a move on up. So the short trades that we took, the sells that we took, have now come to an end, and we're looking for the prospect that we just might get a move on up. And indeed, I've actually gone long based on intraday trading. This all happened yesterday, and it may want to move up dramatically. I just don't know. It may just move sideways. I don't know. And it may move on down. I don't know. We as humans seek certainty. We do not work well with uncertainty. And the markets produce uncertainty for us all day long. It's endlessly uncertain. So psychologically, we've got to work on ourselves to accept that uncertainty. And the only certainty we can have in the markets is that we will lose money from time to time. And if we can cap those losses, then that's got to be right. In fact, I was listening to Alan talk about a question that came forward for him, about these risk-reward ratios, and I'm absolutely with him there. Risk-reward ratios are all very well, but if you say, oh yeah, I'm only going to take a trade if there's a 3-to-1 risk-reward, well, my risk on this trade, well, at the moment, I've got to stop in at break even, so I've got zero risk on the trade that I'm taking long. But the initial risk on it, that initial risk had around about 100 pips of risk. And I would then need, 300 pips of profit? It's got to go up, got to go up by 300. Well, I've no idea if this is going to go 10 pips in profit, 20 pips in profit, 500 pips in profit. I have absolutely no idea. The market will give me what the market will give me. But I tell you what I can control. I can control that risk. And that is without a doubt, in big, big capital letters, the most important thing to control. And that is the risk at any one time. So it's the initial risk, which now is zero for me. I've just taken that risk right off. And as for the risk of giving back my profits, right, well, got a very simple rule there. Never let a profit become a loss. Well, I've achieved that so far on this trade. It's not going to, unless there's some dreadful fat finger, algo-driven flash crash, I'm not going to lose money on this trade. But the amount of risk in relation to my capital is all important. And I work on the basis that I don't want to be risking anything more than around about 1–1.5% on any one trade. And I would typically run 3 or 4 trades at once. So my overall risk is going to be around about 4 to 6% thereabouts of the capital that, if the real worst happened and I lost all of that capital, well, it wouldn't affect my lifestyle in any way. So I've got this totally separate trading fund, and that really is the only way to go. Scared money loses money. So if we're using money which we actually have lined up to pay the mortgage next month or the rent, we're going to lose. We're just going to. It's a given. It's a given. We've got to be able to trade with money that is not going to be scared money. It's got to be money that is stuff that we've just tucked aside, and it won't make a blind bit of difference if we lose or not. So I've achieved on this trade that I'm not going to lose money, and that's the position I want to get into ASAP on any trade that I do. So we're just looking at the, let's just do a little bit of analysis here. I'll quit the sermonizing because we all know these things. We all know that we've got to cut our losses early, but from time to time we don't. So let's just look at the weekly chart of the euro. It's just collapsed on down, and you can see my two main indicators. I've got a swing trend. It's a dead simple price action following momentum indicator, and it moves down. When it's red, I want to be short. And also I've got this activity index down at the bottom. There's nothing sort of clever about any of these. This is purely based on tick activity, on volume activity. So when it drops below the zero line, and you can see the zero line changes from blue to red. When it's below the zero line, we are in a downtrend. Simple as that. So if I just plonk a vertical line there, that's where the sort of official downtrend started, according to the to my activity index. And it actually came to an end there. So look at that. What a fantastic trend from, what is that, 138.27, 138.27, all the way down to, well, it got right the way down here to let's call it 113. A lot of pips. We're talking not just hundreds, we're talking about 1,000 pips. So it just ran on down and down and down and down. It then started to move sideways, and into my analysis, I bring in a little bit of fundamental. I want to know what's going on in the world. I want to know what the main drivers are likely to be. I want to know when Mario Draghi is likely to come up with another major announcement, and clearly I want to be aware of what's going on in the US and what their announcements are likely to do to interest rates, or at least perception of where interest rates will go to. Because the Forex markets, they're neurotic. They jump around. The psychology of the market, well, it's like dealing with a neurotic who has got ADSD and is just jumping around all over the place. And you've got to just, sometimes I find it quite useful to try and get under the skin of what that underlying psychology is within the markets. So technically, that's it. That's what I use. I use the swing trend activity index, and if price action is in a trend, I am trading it short. And if it drops into a trading range, then I'm being very, very wary indeed. And depending upon my time frame, I may or may not want to get involved in a sideways market. Now you can see that I've got various A, B, C, D, E's and so on, and I bring in every now and again a little additional, a little bit of Elliott wave, as a matter of fact. And but that's not the main thrust. The main thrust, I just want to trend simple, simples, as they say in one of the most entertaining adverts that there is out there. So we come back to the daily chart. What we can see then is that we've got this sideways move. We've got this slightly bigger picture there of an E, which I've got a question mark. At E it was supposed to move on down. Well, it's done just that. And what we've sort of got is one of these ABC moves. It eventually moved on down. Look at that. We can call that one part of the move. And then the other part of the move, I don't know, has it got more to go? Possibly. But for the moment, it has stopped going on down. And do you know what? As traders, we have to respect what the market is doing. You know, okay, my opinion longer term is that the euro is going to go further down, but I've got to park that to one side and base my trading decisions on what is actually happening. And what is actually happening is that it's not going down any further at the moment. We've got a classic hammer candle at the bottom there. Okay, what are we now? That was Thursday, that was Tuesday. On Tuesday, we get this hammer. On Monday, it was a doji day, couldn't quite make its mind up what was going to happen. Yesterday, we had this little bump up, and today, it's attempting to move higher. So I've closed all my shorts, and as mentioned, I'm just trading it on the long side for the moment until it all changes. Right, so there we are, quick insight into my trading. Now let's just move over to cable, because as Alan was saying, cable, everyone is focusing on cable at the moment. Now, just by looking at this little move, well, yeah, you know, we've been short on this, predominantly short. In fact, you can see where, you know, there's no magic in this. You can see where I've gone short. And again, the two indicators are kind of play. In fact, if I put that line across there, that's where the downtrend really got going. And we're just waiting for then the move to actually happen. We get one or two little pullbacks and so on. And look at that, the red line remains red right the way through. We had the the flash crash. Of course, the jury's still out on exactly what caused that, but you know, the chances are it was algo driven, and there was just no buying liquidity put into the system. But some clever quant probably thought that, we'll wallop into. There was some sort of overnight lack of liquidity, and he thought, oh yeah, we'll just sell into that, and it will collapse like crazy. And if he had any sense, he would be the only buyer right down there at the bottom. However, what we've now got, look at this, we've got a sideways move. It is just moving sideways, and if we just see this in a little more detail, we can start to analyze what is going on here. And by just using a couple of dead simple lines, then we get an idea of what's been happening in this trading range over the last couple of weeks. This range will break out at some point. At some point. It looked a little as if it was going to break out on Tuesday, but it didn't. We end up with a long tail day. Love them. Long tail days tell me that there are lots of buyers down below, and consequently there is support there. Simple, dead simple. Yesterday we get a day which more or less remains within the extremity of the previous day of Tuesday, and today we've had an attempt to move higher. So based just on what was going on intraday, then yesterday it told me buy it. Came right down to the hourly chart. In fact, let's show you that. Came down to the hourly chart, and we had this sell. This was just prior to Carney speaking to, was it the House of blah, blah, blah. Anyway, he was speaking in Parliament, you know, one of these committee type things, and this was prior to his talk, because it looked, or at least the psychology of the market seemed to think that, oh dear, you know, there's something dreadful going to happen. Didn't actually happen, and the market rallied up. We then get a higher low, and let me tell you, higher lows are what you want to be looking for in markets. You get a big sell-off, you get a higher low. Let's use this line. And when price did not break back and go to the lows, it just became a buy. It became a buy. And again, the indicators that I use, you know, eventually they sort of caught up, and sorry, the one after that just showed us that we were in an uptrend, and away we go. So the initial risk on this was actually, you know, it was a fair old lump of risk. I was prepared to just take an initial risk, but price was actually moving up when I put the trade on, and now I've got a stop which is just above. Actually got it on my other screen, and it's just above there. That's where my stop is. Taking half profits, of course, and that's the way to trade successfully. You wanna put a trade on at an optimum time, and then take part of the trade off when you got quite a reasonable profit. Well, it ran up, and I took quite a reasonable profit out of it. In fact, you know, starting to show signs that maybe, you know, it was going to want to collapse back. Managed to take partial profits on it. We just let the rest of it run, entirely risk-free, for as long as it wants to run. And then eventually I will close it. And that's it, end of story. So, dead simple way of trading. It's, generally speaking, I call it the 20-minute extreme trading process, because it takes me about 20 minutes just to scan through a whole series of charts and you know, just see what is going on without any you know, worrying about this, that, and the other. In fact, worry is the killer in the markets. Now, let's just look at another one that looks really, really interesting at the moment, and that is the JAPY, the US dollar JPY. Now, we all know what this was about. The US dollar went up dramatically against a weakening yen, and you know, it was signaled in advance. In fact, the Japanese said, you know, the finance ministry said, look, we want and we will do whatever it, oh yeah, but not pinch Mario's statement, but we will do everything that we can to get a weak yen and consequently get inflation. Well, they got a weak yen, didn't get inflation, of course, but that's another story for, you know, the folly of QE and negative interest rates, etc. But, you know, it just told us to buy it, and we bought it. And in fact, we had two runs at this, and the second run gave us 800 and I think we got out at 804 pips, which was actually the best single profit of the last couple of years that we had out of one single trade, with needing to do absolutely nothing about it. Anyway, we've got it moving on back down, and the weekly chart then is showing us that we got a downtrend move. We've got a channel. We can see that, you know, price just bounces between the channel. So in a downtrend with a channel, very, very useful. Pops up to the upper part of the channel, then we sell as it resumes the trend on down. Except that it didn't. Down here we get a low, higher low, you know. Well, that one did drop down a little bit. We then get another higher low, telling us that this was not going to go any lower. And lo and behold, look at that. On the weekly, it's now moved above the zero line, suggesting that it might want to go higher. We had a sideways move over here, and this sideways move, look at it. It broke out, and it broke out yesterday. Well, it actually broke out previous day, broke out on Tuesday, but it then came all the way back, leaving a price action candle that told us that, whoa, look, there are sellers there. Somebody doesn't want this to go higher at the moment. But they then got themselves a little bit overwhelmed, and there's a little bit more activity today. And the real key will be if it's going to break above the Tuesday high. But we're in a trend, we're in a move. My indicators have all perked up, pointed up. Price action has moved above the range it was stuck in. It became a buy. It became a buy, and so there we are. Now, you know, 800 odd pips is great, but we're quite content to take a couple of hundred pips here and there. You know, a couple of hundred pips. And, well, I put a blue line in. I don't know if it's going to get there, but there's a fair chance there might be 300 pips in this one. Might happen, might not. Doesn't really matter. As long as we can get in on a trade, get the stop to break even, having taken some profits, that's the key thing, we can just let it run to wherever it's going to run. So that's the process. So let's just, actually I must just keep an eye on the time, because I think we can accelerate through this just a little bit. Let's go and look at one or two other.
Before we do that, just a couple of questions.
Sure.
Gene says, with 10 days moving average sideways, 10 days moving sideways, sorry, was there a reason you didn't wait to short it on the cross of your resistance level? This is a chart we were looking at 5 minutes ago.
Yeah. Well, yeah. We can trade ranges, and in fact, if we just go back to cable, then yeah, I mean, the chances are that looked very much as if it was going to be a sell, and we had to be just a little bit careful because, and this is another standard rule in the markets, reversals so often will occur where there have been previous reversals. And what didn't happen was this move down, assuming you're talking about this one, but this move down did not break that low. Well, it did by the odd sort of few pips, but it immediately came back. It absolutely immediately came back. And, that was on Carly's talk there. So, yeah, there are times when we'll get it wrong, and we'll perhaps take a move such as that, take it short, okay? And I could well have, if I'd have taken that, I could well have been nursing a 100 pip loss. So what am I going to do next after that? Am I going to think, oh, blimey, I've just, 100 pips. How much money does that represent? Oh, how much? And I could sort of wring my hands and head in hands and think, oh no, oh goodness me. I think, let's have a rule. If I lose 100 bits on a particular trade in a day, I'll wait 3 days before waiting for the next best trade. No, forget it. We're almost in battle. We've got to be professional. We've got to get straight back up and look for our next trade. So we've somehow got to park emotionally any losses or any immediate loss that we have taken. There's a thing called recency bias. We are programmed to make our next action be based on what our previous action was. It's wrong in trading. It does not work. It's like the kid who's learning to ride a bicycle. You fall off it, there's only one thing to do. Don't take it home to mummy and say, oh, I've scraped my knees, mummy, I don't want that bicycle anymore. Give it away. No, what we've got to do, we've just got to forget about our knees, get straight back on that bicycle, and away we go. Anyway, sorry, I don't know if that analogy helps at all.
Great. So, Stuart was asking about a line on the charts that I think he was referring to the red lines that were.
Oh yeah, the horizontal lines.
Mm-hmm.
Yeah, horizontal lines. Well, I actually use these to pick out significant areas. Now, let me just show you on this particular chart, because this thing has been absolutely amazing for us over a period of time. So, a trend. Let's just look at a trend. We've got this low right bang in the middle of the chart. Price goes up, and what it features is a succession of higher lows and higher highs. Higher low, higher high. As price goes higher, okay, we are then looking for the next correction to be above the previous correction. And indeed, that's the place where we're going to put our stop profits as well as price moves on up. So that's the definition of a trend. So if a trend is likely to reverse, how do we find a reversal? Well, we just put a red line underneath the last correction or the last higher low. Now this red line, do you see the very high candle? Look at the low of it. Well, that was a higher low because price subsequently went higher than any of the candles before it in that trend. So that becomes a really significant level. If price breaks down below that level, the chances are we may move into a downtrend. Now the jury's still slightly out on this one, but price action is doing all the right things for this Australian against the New Zealand to go lower. So we've got an inside day, it breaks lower. We then have this engulfing day, it pushed lower. Well, since then it's been more or less negated. Price went above its upside, but look at that. Yesterday it left behind a shooting star. So at the moment this is just moving sideways, and it's shown signs that it wants to break the trend and on down. So that's how I use horizontal lines. In fact, it enabled us to pick just about the level at which we wanted to get in long on this one. We picked out the very, very last lower high in the downtrend, which was a brilliant downtrend, by the way. It served us extremely well. And there we are. Just a little point about trends, because they run on and on. You know, if you know anything about Elliott waves, 5-wave move, we've actually got a 5-wave move down here. Wave 3 is always the good wave, and we managed to get the best part of that. Moved on down. There was a spiky day. In fact, it spiked most of the markets. They jumped back, and this spiky day told us that yeah. Well, just look out, take a profits there, and wait. There was more to go on the downside, and yeah, you know, I mean, there were traders who actually did get into this, and in fact, we did actually have a small position, but only a very, very small one. And when we get a downtrend, which is sort of pretty mature, then there comes a time when we think, well, let's not get too involved because a reversal could be coming up. And that's exactly what did happen. We got that little reversal as that false breakout showed us. So that's how we use the red lines. Dead simple, just draw them in by hand. And it takes me right the way back to those days when we used to draw pretty well all that stuff purely by hand. Right, now there were one or two other things I wanted just to mention. Australian against the CAD, some of the crosses work so well. And let's move on a little bit, because you know not everyone is comfortable with trading some of these crosses. Before I go from here, quite often you can get a real double effect. So we had a double effect over here. This is the pound against the Swiss. So if you can get a time when the pound is weak and the Swiss is strong, then you can multiply your pips dramatically. The ATR on something like the pound against the Swiss, pound against the yen, is going to be sort of 250 odd pips. And they will really bring home the bacon. Of course, the risk is there, so consequently the position size is going to be much smaller than perhaps it would on something like the euro against the US dollar. Now, let's just move over to this little lot, because this is where it's all getting interesting. Things are now getting, how many weeks away are from, oh, we're not many weeks from the election now. Tuesday the 8th, I think it is. So we are a couple of weeks away from the election. Now, what is going to be happening at the election? Well, you know, it could go either way. It could be a little bit like Brexit Remain. There could be something really quite dramatic happening. And we look back over here on the dollar index. This is the dollar index. And what I'm looking at, we've had a real good rally. I use a bit of Fibonacci, by the way. Not the main part of the analysis, but it's all corroboration stuff. And look at this. We've had a real good run up. And it's come to an end around about the region of where there was a lump of price price action, previous highs. That's where you want to find, you want to look for reversals at old highs and old lows. And sure enough, we get it. And adding a little bit of weight to it, I've got this automatic fib finder that gives me the bat level. So if anyone's into bat patterns and the various sort of butterfly patterns, Gartby patterns being probably the most well-known, they work time and time and time again. Anyway, the point I want to make is that it's now looking as if it wants to reverse back down again. It's getting a little bit worried about the election, and it's also getting a little bit worried about what is going to happen in December to US interest rates. The last rise was last December. They've been talking about increasing rates all year, but then we had some confidence figures that were showing that US business confidence is not good. And consequently, you know, that seems to have tied in quite neatly with the wobbles that we're currently getting on the dollar index. If that dollar index tanks down, we are going to find that the euro, etc., well, they're just going to go ballistic on the upside. What about the stock markets? And well, I'm with Alan here. I don't know. It's just going sideways. But what we find is that on the run-up to US elections, the stock market remains stable. It remains stable and it moves up. Well, we most certainly have had the stock market moving up. There we go, monthly chart. Gone to new highs this year. But what happens in the first year of the new incumbent, and it doesn't matter who it is, you know, Democrat, Republican, don't think it actually makes any difference in the States, then there's most likely to be a correction. So the bad news is allowed to come out. You know, people say news can't be manipulated. Yeah, get real. All news is manipulated. We are presented with the news that we are supposed to hear. And consequently, we find that in an election year, everything is pretty damn rosy, and it certainly has been about the US economy. But there needs to be a crash over the next sort of few years so that in the last year of a presidency, things can be painted to be really, really rosy. That's how the world works. And so consequently, 2017 is going to be a real iffy one, particularly for the stock market. And of course, you know, tails and wagging dogs, well, all of these move sort of in lockstep, and I guess that we'll find that, you know, all of these markets, FTSE, DAX, etc., will start to take we'll start to have a very uncertain 2017. Let's put it like that. Now, finally, I'm just going to come to an end with gold because fantastic market. Gold and silver. Silver, the gold-silver ratio favors silver as for the upside, but I just want to put in a note of caution. A lot of people, certainly the alternative blogosphere, is telling us that gold is going to go to 10,000, you know, ridiculous numbers. I say ridiculous number, probably not ridiculous numbers. Back in 1981, you know, 800 was a ridiculous number. But what is the market actually showing us? On the daily, we've got a lot of overhead supply there above 1300. We've had a breakdown. Technically, it almost looks as if it wants to go on further lower, except for the moment it's maybe perking up. If the dollar weakens, it's a given that gold will go up, and we might get a decent rally. But do you know what? If we look at the weekly, it's not looking as if this decline has gone far enough yet. Do you remember what I was saying about those ABC moves? Well, we've actually had the A move, and I wouldn't be at all surprised if we've still got to get another tumble here at some point. if we get this tumble coming back towards the 1100 mark, wow, is that going to be a buy? Because, folks, there will be inflation. It will be massive. It will be massive. And if the gold price can come back 100 or so, oh, what a tremendous buying opportunity. It's setting itself up now. We've got a neckline in, and let me just use this. The neckline is suggesting, well, that's not actually quite perfect there, is it? Ought to be around about there. If price were to get substantially above 1300, then we're going to get this moving back up to the old highs at least. So there we are, folks. A lot going on at the moment, a lot going on, and you know, things are never quite as you seem, as they seem. Get under the skin of the psychology of what the market is doing, but most importantly, our own personality as traders. And as soon as we start to understand what drives our behavior in the markets, we will become better traders. But just remember this, folks, never let a profit become a loss. And that will make quite a difference to your bottom line. Right, so what I will just mention that if anyone wants to take a little more interest in this, 20-minute extreme trader is actually the product. But do sign up for my newsletter, because you know you'll get a whole stack of information coming through from me. We also run traders class, which might appear in a moment. And if we go back to the product, 20-minute extreme trader, there is a special deal on here. Go to clickevents.co.uk. There's a link on the site there. But what I want to mention to you, it's not big money. It's not big money. The cost of this thing comes out at £279. It's our most successful product. People love it. And there's a special deal on at the moment. In fact, it's been on for a little while, and it's going to come to an end soon. It has to. So it's a payment plan. You just pay half, £139.50 now, £69.75 after 33 days, and another 33 days after that, pay the final little bit of a balance. But you also get traders class, which I send out videos at least twice a week, at least 25 twice a week, 3 months worth of support, which is usually, it's 97 quid. It's 97 quid's worth. People pay 97 quid for it, but you get it within this deal for 3 months. And it's ongoing education. I show you the markets that I'm looking at and the reasons why I'm looking at them. And it keeps the focus for you on this whole process. So there we are. That's Traders Class. That's my mugshot. There we are, folks. It's I think you'll find it quite a useful thing to get hold of. Just pop your email address in, either Quick Events or the Traders Class, Forex Trading for You. There's a whole lot of background there on why you should be trading Forex as part of your trading. Right. Okay. Well, I think time is probably getting within a minute or two.
We are. Thank you for rounding up on time. We've just put that link in the chat box. I'm sorry, the first link I posted was a mistake. I made a typo, fat finger mistake. We've now put it again. So it's clickevents.co.uk/extreme swing trader. So that second link will be working fine. Just. Oh.
All right. Many thanks indeed, Simon. Wasn't you trading cable the other day, was it, by any chance?
No, no. I wish it was. I wish I was trading these sizes to move the market like that, but alas, it wasn't me. Right. I think I'm just going to make sure I've got the right website, because it doesn't seem to be going. Extreme Swing Trader. What am I doing wrong? Click Events.
Well,
.co.uk.
.co.uk, and you can then just main.
It's the .html. Okay, sorry, my mistake. I hadn't put that .html at the end. Here we are. Third time lucky. I will be posting that straight from the browser. So that is definitely working now. Yeah, so if you go to that link there. Great. George, thank you again for joining us and for rounding up on time. Brought us back on schedule after running behind this morning with all the technical hiccups that we had. So it's been great to have you on board. And again, you're coming down to join us at the Around the Clock Trader Live on the 5th of November.
Absolutely, yes. I'll certainly be there from mid-morning on. I have to leave a little early, but I'm certainly around, so if anyone wants to come and have a chat with me, be only too pleased to talk about trading. And
you're going to do a seminar as well, which is great. So if you can come and join us, you can spend some time with George on the day. Fantastic. George Hallmey, Click Events, thank you very much again for joining us, and we'll go across to our next speaker now. Thanks very much.
Bye for now.
Okay, so thank you very much, George, there, and welcome to everybody. I can see we've had a lot of people continually coming into the room. Welcome. If you are just joining us in the last hour, that's been George Hallmey from Click Events talking about his swing trading strategies. My name's Simon Campbell from Round the Clock Trader, and this is Round the Clock Trader, the webinar event where we feature 12 lessons every month for you to get an understanding of what's moving in the markets and what strategies are working. We have our next speaker waiting to go live. Some of you, of course, have been on the event before, will be aware of David's strategies using the VectorVest system. David Paul is the Managing Director of VectorVest here in the UK. And if you haven't heard of David Paul before or VectorVest, now is your chance to find out why so many people are using it to help them stay on the right side of the markets. So I'll go across to David now and unmute his mic, and hopefully, David, you can hear me coming through the speakers.
Yes, Simon. Good afternoon, I suppose. How are you doing?
Good afternoon, just indeed. Thank you for joining us. We've had an eventful morning with computers crashing, microphones not working. So I'm pleased to say that we're back on track, and you're coming through loud and clear, which is great. So
well, that's great because I'm a very long way away today. So
you're in South Africa, are you?
I'm in Johannesburg. Yes, I just got in yesterday, I think, and I'm here doing VectorVest user groups for the next week, and then I'll be back in London for your event next Saturday.
Fantastic! Oh, great! You must be collecting air miles by the thousand every week.
Yes, yeah. The lady in the British Airways lounge knows me by my first name now. So, but it's hot here today. If you hear the birds singing, it's because I've got all the windows open and all the doors open, trying to get a breeze through the place.
We're very jealous. It's very autumnal, as you know, here in the UK. Well, David, we'll go across to you. You sound just as clear as you do when you're at St. Paul's office. So let's go across, see if we can continue the good fortune with the technology and make sure that we can see your screen as well. You should have a prompt now.
I've shown my screen, so hopefully you can see the blue VectorVest screen.
Great, we can look at the blue slides. If everybody can home, just give me a quick confirmation as well using the questions box that you can hear and see David's screen. Okay, that's great. Fantastic. Now, Ian, David, Paul, fantastic. Great, everybody is here. So, David, the VectorVest system, obviously, I know extremely well, having worked with VectorVest for some years. I saw you at the the show a couple of weeks ago, and of course the markets are quite volatile. So let's see how the system is working. Without explaining what the system is, I'll hand over to you and let people see first of all how it works and how you can apply it to your own trading. So David Paul from VectorVest, over to you.
Thank you, Simon. Thanks for having me. Good afternoon, everyone. I'm David Paul. I'm the Managing Director of VectorVest in the UK and in South Africa. And I've been doing that now for the last 5 or 6 years. I put on my first trade in markets way back in October 1982, very long time ago. And it was a winner, I'm glad to report, and I presume because of that I've been trading ever since. I gave up my job in 1988, and I've largely been trading on my own since 1988. Along the way, I've pretty much tested every particular trading strategy that you can think of. I made an awful lot of mistakes, and I've fixed those mistakes, I'm glad to report. So what I do myself is mixed. I allocate, at the moment, I'm 61, so I've become a little bit more conservative than I used to be, but I've allocated about 80% of my capital to medium to long-term investments, and that's largely what I'm going to talk about today. And that's based on the proprietary VectorVest worry-free investment philosophy, and that's what I'm going to focus my talk on here today. At previous talks with Simon, I've talked about shorter-term trading and swing trading. And with the 20% of my capital that I'm prepared to take more risk with, then I certainly trade short term and trade it quite aggressively when I see something to trade. For example, this morning I shorted the FTSE at 7,000, and I took 50 ticks quite quickly, and got my stop to entry. I have no idea where it is now, so the 6925 level is really important. I trade short-term based on the harmonic patterns that I believe our previous speaker referred to, although I just use 1 or 2 of them that I've made my own over the years, namely the Gartley pattern and the 3 drives pattern taught to me by my dear friend Larry Pacevitis many years ago. But I've made them my own. I also have a look at the butterfly pattern, which I have my own cut on. So VectorVest is pretty much, I think, the only company in the United Kingdom that in fact sells investment education and investment software that's fully authorized by the FCA. And although I'm qualified to give financial advice, I'm not allowed to give financial advice unless I've sat down with everybody and done a long and very detailed fact find to ascertain your stomach for risk. And thus the disclaimer, okay? I'm allowed to talk about what I do myself, but I actually cannot give financial advice in the absence of that fact find. So that said, we can move on. So what we're going to try and talk about in this very short hour is 1, what the VectorVest system is all about. 2, timing the London stock market. There is a time when it's fairly easy to make money in stock markets, and there is a time where it's impossible or very difficult to make money in markets. So we want to know when it's safe to be in the market and when we should in fact be in cash, or whether the bravest should be in fact shorting the market. And then I'm going to talk about the worry-free investment methodology that I'm using, and literally hundreds of people are using with the bulk of their investments in a very stress-free fashion. Okay, so even if you are trading aggressively like I do with 20% of my cash, I think you're going to have to put that cash somewhere, and the worry-free investing will allow you to build wealth and still play an awful lot of golf and take a couple of months off a year from that aggressive investing. So the whole thing that actually weaves through VectorVest, folks, is this mixture of fundamental analysis and technical analysis. So at VectorVest, the edge is that we put together the fundamental position of a share with the technical position of the share, with the technical position of the overall market. And quite simply, ladies and gentlemen, when all three are saying yes, and I can tick all three boxes, then I can simply make a better decision, a decision with a higher probability of making me some money. Now, by the fundamental position of a share, my definition of fundamental analysis is it's the search for the true value of a share. And a big part of VectorVest is all about putting a value to every share in the market every single day. And as a default, we want to be invested in shares that are trading significantly underneath their value. The technical position of a share and the technical position of the overall market, well, I define the technical position using a definition put forward by the technician Martin Pring. Technical analysis is the study of trends and turning points. So essentially, ladies and gentlemen, in its default fashion, VectorVest advises to buy into shares that are undervalued, that are aggressively growing their earnings safely, that are rising, and we want to buy into them and accumulate those shares when the general market is rising. Now, when I first tripped over VectorVest, that just made so much intuitive sense to me that after going to a VectorVest seminar in West London, which Simon was running, I in fact managed to get the agency for VectorVest in South Africa, and I built VectorVest South Africa up into a reasonable size of an entity, and 4 years ago now Simon decided that he wanted to move into the business that we are enjoying today, and VectorVest asked me would I like to take over the same role in the UK. Interestingly, I started the VectorVest South African business for my son. And my son, at that stage, was 22, I think, and he was out of work. He just couldn't get a job. He started to trade. I gave him some money. He started to trade with VectorVest. He put together a track record, and within a couple of years, the track record was such that he managed to get himself a job at a small hedge fund. And now, using the VectorVest principles 3 or 4 years later, he is a fully fledged portfolio manager managing quite a lot of money at that particular hedge fund. So very proud of him indeed, as I'm sure you are of all your sons. Okay, so that's the VectorVest edge, folks. So the 3 things that we want to try and answer based on that is, what's a share really worth? Remember, fundamental analysis is a search for the true value of a share. How safe is the earning stream? Now, and when to buy, sell, or hold. Now, I need to go through these metrics. I'll go through them relatively quickly. VectorVest puts a valuation to every share in the market every single day, an exact number. We buy the fundamental position, all the numbers from Thomson Reuters. And over the last 26 years, Dr. Bartolito, who put VectorVest together, has in fact evolved an algorithm that takes all of this data, sucks it in, and spits out a valuation for every number, for every share that's listed on the London stock market. And as a default, we want our shares to be trading significantly below that level. So it looks at, as the slide says, price, value, earnings growth, and all of those things, and works out an exact value for every share in the market every single day. Now, another measure of value is a proprietary VectorVest measurement called relative value. And relative value measures the long-term price appreciation potential over a window of 3 years in relation to the risk-free rate, which we define as a treble A-rated corporate bond. So here's what the program does. It projects earnings for every share in the market for a window of 3 years into the future. It assumes that those earnings will be fully discounted into the price, and it works out what the price will be. It takes the projected price and subtracts the price yesterday to calculate the upside, and it divides that upside by a treble A-rated, what a treble A-rated corporate bond will pay over the next 3 years, and the resultant is relative value. If your share has a relative value of 1.3, that means that we believe that that share has a high probability of outperforming a treble A-rated corporate bond by 30%. I believe it's the most important number on VectorVest. Now, the next number has got no doubt about this number. It's easy to calculate because we look back in the balance sheet, the income statement, the cash flow statement, and we work out the safety and the predictability of the earnings stream. It's an exact number because those numbers are exact. We mathematically massage 17 inputs, which include the dividend history and the dividend safety, and work out a number that runs between 0 and 2 that represents the safety of the financial performance. Above 1 is good, above 1.3 is excellent. Above 1.3, this is a company that's making lots and lots and lots of money safely. And as we'll see later, the relative safety is the basis of the worry-free investment strategy. Now, if you are an aggressive swing trader, safety doesn't really matter that much because you will be managing risk, I hope, with stop-loss orders. Okay. So my son, who mentioned a moment ago, pretty much doesn't look at relative safety at all. That's because he's sitting in front of 6 monitors all day from 8 o'clock in the morning till 6 o'clock at night, managing risk proactively. Okay, now in our worry-free portfolio, we don't want to be sitting in front of monitors all day every day. Okay, and that's why in the worry-free portfolio, we only look at shares with the highest relative safety. The third metric is relative timing. Again, a relatively easy number because we look at the trend and we mathematically massage the trend between 0 and 2. It looks at the trend day over day, week over week, and month over month, and it's a relatively short-term measure of the trend, changes quite quickly. Again, if the trend, the relative timing is above 1, the share is rising. If it's below 1, the share is falling. And the further above 1, the faster it's rising. And next comes the master stroke, where Bartolini will then put together relative value, relative safety, and relative timing into the one single number. And for the first time in my career, I saw one single number that in fact represented both fundamental analysis and technical analysis, and I didn't think that could be done. And as a default on the program, all of the shares in the UK market, South African market, American market, any market where VectorVest is active, they are rated by descending VST. It's a spreadsheet, so you can rate them by anything you want, but as a default, they're rated by descending VST. Now, I did this over the last 18 months plus. I've used our proprietary search function, Unisearch, and all I've done is that I've asked the computer on the 1st of January 2015, which is more than 18 months ago now, to look at all the shares that were trading below their VectorVest valuation and sort them by VST. So it looks at all of the shares that are trading below. Simon, are you there? Can you hear me okay?
I can hear you fine, David, yes. Can you hear me? No, we got another problem, David. David, we're still
Simon,
here.
Can you hear me okay?
I can hear you again now, yes. Can you hear me?
Yes, I can.
Okay.
That's quite disconcerting. So I did this test where I've looked at all of the shares that are trading below the VectorVest valuation since the 1st of January 2015, and I arranged them by descending VST. And just by looking at value alone and ranking them by VST, that portfolio is up nearly 3 times what the market has done. So just by looking at value alone, there is a significant edge. So by rating all of this, now this would be an aggressive search because I'm not looking at relative safety. But if you were to, in fact, look at all of the shares on the London market and just look at the shares that are trading below the VectorVest valuation and then, in fact, sort those by the highest value, safety, and trend, you have an edge, a very simple edge. I've done it over the last 18 months because there's no timing in there. It will take a few months for that edge, in fact, to come and manifest itself. But that's quite something. It's up 3x in terms of the market. So we calculate a stop loss for every share in the market every single day. And the stop loss is quite sexy in that it's based on a 13-week moving average, but it's adjusted for the fundamentals. If the fundamentals are good, we widen the stop loss. We give the share more room to move. And every day, ladies and gentlemen, we put a buy, sell, or hold to every share in the market every single day. These are largely trend-following tools. The only fundamental thing is that the VST must be greater than 1. So there's a little bit of fundamentals in the VST. The VST must be greater than 1, RT must be greater than 1, and the price must be moving away from the stop price. For a sell, it's quite simple. The price is less than the stop price, and a hold is halfway in between. Now, this can be used to time the market, and we can easily search for those shares where the recommendation moves from hold to buy, and that's quite a useful thing to know every day. But the most important part of the buy, sell, and hold is that it allows us to measure the breadth of the advance. And every day, VectorVest calculates the number of shares on a buy recommendation by the number of shares on a sell recommendation to calculate the buy-sell ratio, which is our measurement of the breadth of the advance. So with all of that said, I actually want to go in to the program itself. If I go to the program itself, Simon, you can still hear me okay?
I'm hearing you fine, David, yeah.
Okay, I don't know what happened there for a second.
Just faded out for a wee while, but we didn't miss much. It was only 10 or 20 seconds, I think.
Okay, all right. I don't know how it fell apart there, but I'll keep my eye on it. This is the front page of VectorVest, ladies and gentlemen, and it's all about timing the market, which we're going to go to in a second. But I want now to look at viewers. And when you go into the program for the first time, this will be empty because we can look at stock viewer, we can look at all our industries, we can look at sectors and various dividends, etc. But if you click on stock viewer, it'll populate this with all of the stocks on the London stock market and on AIM. I've only loaded the top 50 of 2,158 shares that we're following on the London market and on the AIM market. They are, as a default, sorted by VST. It brings the top combination of value, safety, and trend to the top of the pile. CAS is there, and there's the code. It's listed on the London Stock Exchange. A little X beside it means that there's options on it. Now, it's trading at £2.82. We believe it's worth £4.24. This is the value, and that's the first proprietary number in VectorVest, is this valuation. And we like to see shares that are trading below their valuation. That's good. That's the first tick. It was up 2.1 pence yesterday, which is 0.75%. That's hardly proprietary. You can get that anywhere. Now, the second proprietary number is relative value. And remember, the relative value is a measure of the earnings upside over the next 3 years in relation to what a AAA rated corporate bond will pay over the next 3 years. At 1.54, anything above 1.3 is excellent. At 1.54, that's up in the bloody marvelous area. That's really, really very good. I really like this number. Now, my son looks for shares that are undervalued, looks for shares that are high RV. He doesn't worry too much about RS because he is in fact managing risk proactively, and over the last 2 or 3 years, he's managed to unemotionally get that right. It's difficult. Those of you that have tried to put stop losses into place will know that it's so easy to give it another tick, give it another tick, give it another tick, and that must have happened to pretty much everybody listening if you've got any market experience whatsoever. This is a gold miner, folks. I assure you that any weakness will be sorely and heavily punished. Relative safety in CAS is 0.89. On a scale between 0 and 2, less than 1 is not so good. It means that there's been ups and downs in this data stream, in this earnings stream over the last 5 years. And it is a gold miner, folks. The gold market was in decline for 4 years. There's all sorts of things that can impinge gold mining profits, from the price of bullion right down to currency, right down to safety, hedge book, anything. So not surprising that the relative safety is less than 1. So undervalued, high RV, low RS, certainly wouldn't be a part of a worry-free portfolio, but nevertheless it's flying up the page. It's got an RT of 1.82, and by putting those 3 things together, it's got the highest VST in the pack. It's on a buy recommendation with a stop loss at 228. These numbers are our best shot at the future, and we reckon it's going to grow earnings by 37% next year, which is clearly built into this RV number. It's a big part of the RV number. We go across here to dividends. We can see it doesn't pay a dividend. Now, immediately, ladies and gentlemen, a company that doesn't pay a dividend will in fact be marked down in relative safety, because we firmly believe that a company that pays even a small dividend and has got a history of growing that dividend is a much safer financial position. Okay. Well, I can hear you, Simon, if you, and I'm hoping that means that you can hear me. So let's look at a more safe company, JD Sports. JD Sports, we all know them on the high street, trading at 15.50. We believe it's worth 19.88, off 10 pence yesterday. It's got a relative value of 1.5 and a relative safety of 1.41. Now, it's rising, it's on a buy recommendation, and ladies and gentlemen, this has been in the top 10 as rated by VST for the last 2-3 years. In that time, it's gone from £5 to £15. So CAS, undervalued, high earnings potential, low relative safety for speculation. And we've got JD Sports, which is undervalued, high RV, high RS, a share that would certainly feature and does feature in my worry-free portfolio. Now, South 32 is an interesting company. I do a blog at vectorvest.co.uk/blog, and I called South 32 about a month ago. It was a fairly speculative call. I think that Simon sent that out as well. 162, we believe it's worth 195, so it's undervalued. That's a tick. Now, South 32 are the marginal assets that were sold out of Billiton, or BHP Billiton. Down 2 pence yesterday. Relative value is a fairly respectable 1.26, and the relative safety a very respectable 1.15 for a mining company. This I've got a big exposure to base metals, and they tend to be steadier than gold. RT 1.63 moving up the page strongly on a buy recommendation. That has been a good, prudent, in the middle between being very conservative and very speculative. RSA Insurance certainly would feature in a worry-free portfolio. 549, we believe it's worth 829. Relative value of 1.57, relative safety of 1.41. Yes, Simon.
David, Andrew's asking, he says, would you stay in the CAS until it reaches its value of £4.24.99?
I think that one, in a speculative share like this, one has to have some form of agreed stop loss strategy. And I think that one way of doing that would be that you trail the stop loss up behind the share at the VectorVest stop loss, which will change every evening until you reach the target. You could certainly do that, that's for sure. Okay, you can in fact use the VectorVest stop loss, which is a good stop loss, or you can in fact use a trailing stop loss. For example, many of the people that come to our London user group use a trailing stop loss of 18%. Okay, my first mentor way back in 1982, he taught me to use a trailing stop loss of 25%, and I'm going to test that later on in the presentation. Test very well indeed. But yes, in principle, that is if you were a long-term investor, not a swing trader. If you were a swing trader, Andrew, then you'd be doing your best to pick the eyes out of the move. Remember, markets rarely move up the page in a straight line. They move up the page in a series of rising bottoms, and swing traders would be looking to, in fact, pick the eyes out of the high momentum moves. But I think that if you were to stay in CAS and maintain a stop loss at the VectorVest stop loss or a trailing stop loss, that would be a very good strategy, yes.
Okay. What about the Tesco price? And Robert's picked up that Tesco up there, second from the top.
Yes.
Had a price of 213 versus a value of 177, and yet it's second in the list. Maybe this helps just to clarify how this list is compiled by the VST.
Well, yes, it's moved above our valuation, that's for sure, and it's trading above our valuation, and that we don't like. It looks as if it's moved too far, too fast in the short term. So if you can think of this value as the value that we place on the share today. Now, if we go across here at 1.46, the relative value is 1.46. Now, here's what this is saying. It's saying that although we believe the share is overvalued today, if the earnings come in as we anticipate, at some time over the next 3 years, at 213, it looks significantly undervalued. Okay. So if you'd bought it a little while ago, when it was undervalued, and you've got a 3-year window, then you should do your best to sit and pull the stop loss up behind you at the VectorVest stop loss. If you're not in, it looks as if the thing has gone a little bit too far, too fast. So that's how that's interpreted. That's quite difficult, and I'm glad that the person has brought that up. Another share that shows that is Fever Tree, although it's slipped out of our top 10 at the minute. Fever Tree trading well above the VectorVest valuation, but got a very, very high RV. This is saying that in a window of 3 years, if the earnings come in as we anticipate, that at 213, the share will be significantly undervalued. So if you've got Tesco, I would hold on to it with the stop loss just about here. Okay. We believe it's going to grow its earnings 32% next year. Okay. I seem to be there 3 or 4 times a day. Any other questions there, Simon?
Boohoo, massively overvalued?
Well, yes, Boohoo, massively overvalued. The relative value 0.75. Clearly, the market's not stupid, Simon, and the market must know something, or somebody knows something that hasn't got to the books as yet. The VectorVest valuation is a conservative valuation, which is all about what's been published in the annual and the interim reports. So it takes those cold, hard numbers and it works out a valuation. Now, the share is trading at 5 times that. So somebody must know something. Now, here's what happens in a share that's trading above the VectorVest valuation. Invariably, the market has bought into the rumor. If management do what they say they're going to do, then this price could be justified. But if management don't do what they say they're going to do and they drop the ball, then the share will get a smack. So there's just more risk in buying share that's trading above the VectorVest valuation. There are lots and lots of shares.
We seem to have lost David again. Momentarily, we can still see the screen moving. We can still see your mouse moving. But we can't hear you. There we are. You're back. You're back.
I really, this normally works beautifully from down here. I've done it dozens of times. Can you hear me now, Simon?
I can hear you fine now. It just seems to drop off momentarily and then reconnect. So.
Okay. Well, I was talking about Boohoo. Boohoo being trading significantly above our valuation. The market's not stupid. The market knows and is happy to do what management says it's going to do, and have priced it accordingly. If, however, the management drop the ball, then this share will get a good old-fashioned smack. There's just more risk in trading above shares that are trading above the VectorVest valuation and a long way above the VectorVest valuation. So I wouldn't have anything to do with it.
Okay. Andrew says you mentioned Hastings Group as a buy a couple of weeks ago. Can we see what that's doing now? And
well, the Hastings Group took a little bit of a problem because the main shareholder, in fact, decided it was time for him to take his money out. And he did that after the share had gone ex-dividend, and the share has pulled back a little bit. It's still in a hold recommendation, and it's pulled back to about 210. We still believe that the share offers an enormous value. It's trading at 210. We believe it's worth 387. Off 2% yesterday in a very, very bad day. Relative value is 1.63, which on a scale between 0 and 2 is absolutely excellent. Relative safety is middle of the road, 1.14. It's still in a hold recommendation. Okay, so it needs to be watched, that's for sure. There is an overhang of shares, but fundamentally nothing has changed. There is an overhang of shares from that guy who's selling out his holdings. So that was maybe a little disappointing and came at the wrong time. There's always one, for sure. There's always one.
And just quickly before you carry on, Ian says, what about the stop loss, for example, on the CAS share? Could you see what stop loss it would be on the spreadsheet there, on the stock viewer?
Okay, well, the stop loss on CAS is 228 at the moment. And this happens, the share has moved a long way and has pulled away from its stop loss, which is based on the 65-day moving average. So the stop loss is there to try and keep you in the position. So it could pull back quite a bit before the stop loss is hit. So the stop loss is based on a position trade. If you were a swing trader, then you would have to think about another type of a stop loss. The stop loss is doing its best to try and keep you in the big move.
Mm-hmm. These stop losses are calculated to widen on the slightly more robust, safer companies. Is that right? If I remember that right, and maybe tighten up when the company's a little more risky. Okay, well, yes, I think we've all lost sound again momentarily. It just seems to be a case where I think David will be back with us in just a second or two, like the last time. Well, sorry about this, folks. This is turning out to be one of these days where we have been besieged by technical mishaps. And of course, it is always a risk when we're working live and bringing people in from different parts of the world. and I have to say we get away with it quite lightly. Most months we run a fairly tight ship, and we've been lucky, but today clearly we just seem to be having all sorts of problems, starting with myself with a computer failure at 10 o'clock.
Can you hear me okay, Simon?
Oh, now David's back. Yes, hello, great. Okay, so I was just mentioning that the stop losses, if I remember correctly.
Can you hear me okay?
Yes, oh yes, I do. We can hear you, David. Don't just... We can hear you fine.
Can you hear me okay, Simon?
Yes, David, we can hear you fine. I don't know if you can hear me, though. Yeah, let me try and communicate with...
Can you hear me okay?
Yes, David, hi, we can hear you. I take it everybody can hear me still speaking. I think the problems with David's internet connection. Yes, Andrew, thanks. Clearly having one or two issues there with the internet connection, but I think David's getting himself rebooted back in, so hopefully we'll be able to...
Can you hear me, Simon, at all?
Yes, we can hear you now again. Can you hear me?
Simon, can you hear me okay?
Yes, I can hear you, David.
I don't know what's going on here today.
Can you hear me again?
Yes, I can.
Oh, great.
I can.
Great.
Timing the London market for consistent profits. This internet makes the trading seem quite easy. The mantra, of course, is to buy rising shares in rising markets and sell falling shares in falling markets. We've been timing markets for a very, very long time, and we've got lots and lots of systems for investors, which is what I'm going to talk about today, and systems for short-term traders, which is systems that I've talked about in the past in this forum. Our systems are all rule-based. There's no subjective input whatsoever, and they largely look at three things. They look at the price of the VectorVest composite. Now, the VectorVest composite is an equally weighted index of all 2,150 shares that we follow. We look at the breadth of the VectorVest composite, and we look at the momentum, or the RT, of the VectorVest composite. And we put those together into two main trading systems. A short-term trading system, which we call the primary wave, which is based around a 5-day rate of change of price, momentum, and breadth. And the underlying trend, which is based around a 21-day rate of change of price, momentum, and breadth. At the moment, as I speak, the trend on the LSE is down, up. Now, in VectorVest speak, the trend is summarized on those two words, and that's communicated on the front page of VectorVest every single day. The first word refers to the primary wave. Remember, it's based on a 5-day rate of change of the price, the breadth of the market, and the momentum of the market. Is down, but the longer-term trend is up. And the longer-term trend has been up since February this year. So the underlying trend is used by position traders, and the primary wave used by swing traders. Okay. The front page does its best to communicate all of this, and the little traffic light, in fact, diagrammatically shows the primary wave. And at the moment, you can see there, or maybe you can see, that the trend is in a down-up situation. It means the short-term trend is down, the long-term trend is still up, and the advice, VectorVest is not advocating buying stocks at this time. Okay, so let me the VectorVest composite itself. And this is the VectorVest composite, remember, an equally weighted index of the 2,100 shares that we follow. This was the sell-off into the middle of February, and since the middle of February, the London market is moving up strongly. That's the Brexit decision, and this is the move up since Brexit that surprised everybody. Now, in the blog that I do every weekend, I've been asking people to watch very carefully because I don't like this rising wedge formation. I really don't like it at all, and it broke yesterday down below the trend line defining the rising wedge. And as I say, that 6925 level on the FTSE needs to be watched very carefully indeed. That's this little support level in here on the composite. Now, the long-term trend is measured by a proprietary oscillator called the MTI. And the MTI, as I say, is a 21-day rate of change of the price and a 21-day rate of change of the breadth of the market, all rolled into one. Mathematically massaged between 0 and 2. And when it comes up through 1, and the market has traded upwards for 2 weeks in a row, we put one of these little green triangles on the chart. And that, ladies and gentlemen, is the longest, most conservative measure of the trend of the market on VectorVest. And this year, we've just had 2 signals. In the second trading day of the year, we had a down signal. And on the 22nd of February, we had an up signal, and that up signal is still in place. There are worrying things, which is this divergence between the MTI and the price itself. The price is rising, the MTI is falling, and that is what technicians refer to as bearish divergence, and it's a warning signal. And I have been, for the last 2 weeks in the blog, I've been warning people to be very careful with open profits based on this. And the market would seem to be breaking down. So far, on VectorVest, just the short-term trend has moved down, but if it keeps going, then sooner or later we'll get one of these red triangles. This is the slowest, most conservative signal on VectorVest. As you can see, Brexit didn't even kick it out. So a worrying situation. If you're following the longer-term trend, then do your best to stay in the moment and hang in there. If you are a swing trader and you're following the short-term trend, then you're already out. I can't answer which one you want to actually use yourself. Now, when the MTI gets down to about 0.65, that's a great time to take a deep breath and buy some shares. Really difficult to do, because in February, if you remember, this market was steaming down, and to take a deep breath and to buy down there is far from easy. Now, when the MTI gets up to about 1.5, 1.6, especially when it shows this divergence, about 80% of the time that causes a fairly decent pullback. So unfortunately, there's about an 80% chance that we're going to see a little a pullback. We have no idea where it's going to go, but I think we're going to see a pullback, and there's a good chance that this is the annual high. Okay, so just be very, very careful out there. Watch your profits. VectorVest have a rule that we should never give back any more than 50% of our profits. It doesn't matter what happens. So I personally have to be very careful with the open profits that I've done. I've done really well since Brexit. So I'm damned if I'm going to give those back. Internet or no bloody internet. So that's just what I said here. So worry-free investing. And this is where I want to put, and I'm going to put 80% of my capital over the next few years. It's simple, it's intuitive, and stress-free. It takes a few minutes a week at most. Most of it can be done on your telephone. So if you're on the go, you can sort of keep your eye on it on the telephone without a great deal of effort. Now, I think my old friend Francis this afternoon is going to talk about why only 9% people make money as traders. I'm going to try and fix that for you. But I think the 9% is on the high side, and I've heard 5% in fact quoted. Trading can be tough, and you need to be very resilient. But ladies and gentlemen, everybody can win with this method. Okay, everyone. It's simple, it's intuitive, and we're trading once every 6 weeks or so. And in the words of my old rugby coach, let the ball do the work. Okay, here's the methodology. It looks at relative safety. And I've spelt out what relative safety is. We look at earnings consistency, we look at the company size, we look at price behavior, we look at longevity, I'm not quite sure how to pronounce that. We look at the dividend, very, very important, dividends. A company paying a dividend regularly, increasing that dividend regularly is really, really, really important. And look at all those ghastly accounting ratios. I have a PhD in mechanical engineering, so I call them ghastly accounting ratios. The only one that I look at in my own work is the debt to equity ratio. So we look at all of those and we set them in and we spit out a number between 0 and 2 which represents the safety of the earning stream. Now here is the schematic of how this works. When we get a confirmed up, or if there's a confirmed up in place, we buy 10 plus high RS stocks. So rather than sorting all of the stocks in the London stock market by VST, we sort them by RS. We use the VectorVest stop loss. Now, if a share hits the VectorVest stop loss and the market is on a confirmed up, we get rid of that stock. We run the search again, and we replace that stock with a share at the top of the list that we don't own already. And we maintain 10 positions, 15 positions, no more than 15, I think. Markets breathe in and they breathe out. When we get a confirmed down, one of those red triangles, we simply don't buy any more. We watch our stop losses as before, but when a share is stopped out, we don't replace it, we just add to the cash in the portfolio until we get a confirmed up, and then we just run the thing again. It's as simple as that. Now, we've tested this till we're blue in the face. The 3 facets of this: we want to try and get capital appreciation, we want to get dividends, and if you understand them, we want to get income from selling covered calls. Now, that's very easy to do in the US, not as easy to do in the UK. We would sell covered calls for those people that understand them when the MTI is in the position that it's in at the moment. In other words, above 1.5, 1.6. When it's up there, there's a high probability that the market won't go any further and our shares won't be called away from us, for those of you that understand options. And we do that probably 2 or 3 times a year. And to raise our income from a dividend, let's say, of 3 to 4% to 10% is quite possible by doing that very conservatively. Simon, can you hear me okay?
Yes, David, you're still coming through loud and clear.
Okay, my heart rate is about 160 here.
It's fine. No, it's all been...
Internet stresses me out more than anything else.
Or rather, lack of internet.
Lack of internet, you're quite right. Now, we've tested this in the US for the last 20 years. And over the last 20 years, we placed 177 trades, and this was done till to June this year. And there's 10 positions currently open. So that's 20 years, 24 months, 177 trades. So what's that? Not that aggressive trading, I think you would agree. I'm too stressed out to do the sum. We collected 544 dividend checks along the way, and that amounted to a 51,000 dividend income off $100,000 capital. And we've tested this. And over the last 20 years, $100,000 has moved up to $683,000. And as you can see, it was flat for a while. That was 2007, and this is this range that the market's been in for the last little while. But it's done exceptionally well with no disasters. If you were a fund manager doing that, you'd be very happy. The S&P has appreciated in that time by 9%, and that portfolio was up 18% by trading every 6 weeks or so. Not counting dividends, and not counting any income that you would get from cover calls. Now, ladies and gentlemen, even if you are the most aggressive trader, and I personally trade quite aggressively, right down to 5-minute charts at times, although I try to avoid them, but my trade this morning in the FTSE was based on a 30-minute chart, a bearish Gartley. You can see it. Even you're trading aggressively like that, you need somewhere to put your cash, and this is a very stress-free methodology of building an income and building capital with very, very little risk in the safest possible UK shares. Now, I've done the same thing in the UK. Again, the rationale is exactly the same. When we get a confirmed up, we buy the 10 highest RS shares. If the confirmed up is in place and we get stopped out, then we replace with a share that we haven't got immediately. If we get a confirmed down and we get stopped out, we just add to cash and only replace when we get another confirmed up. In the first test, I'm using the VectorVest stop loss, and that's exactly what happened. Again, at this stage, we started with £50,000, and since the start of 2009, that we've trebled that. Not counting any dividends along the way and no income from cover calls. Again, that was the Euro crisis where we went flat. Okay, and that is Brexit, and we're now recovering from the Brexit debacle. So that is the standard VectorVest worry-free portfolio since 2009. No disasters. 18% return. Now, dear. Simon, can you hear me?
Yes, David, you're fine. Oh dear. I think we may have lost David again. We've just got a couple of minutes to go. Douglas says, how has Brexit cable devaluation affected your portfolio, and do you hedge in other currencies? We'll see if we've got time to get onto that, Douglas.
No, we don't hedge in other currencies at all. This is just straight pounds. Simon, can you hear me?
Great. Yes, coming through fine.
This is just straight pounds. Now, I've run a similar test rather than using the VectorVest stop loss, using a 25% trailing stop loss, and that does a little bit better, and that's produced the £50,000 to £173,000. And we haven't done any hedging here. This is just the process as I related a few slides back by buying the 10 safest stocks upon a confirmed up. In this case, using a 25% trailing stop loss. If the confirmed up is in place, then and we get stopped out, then we replace. If the confirmed call is down, then we raise cash until we get the next confirmed call. So no hedging whatsoever, and that's what happened on Brexit just here. Okay, just there. We get stopped out of quite a few shares, and then we had to run the exercise again. I've shown this around the city, and people don't believe me, but anybody can test it for themselves. Now, the Wi-Fi, Worry-free investment since the 19th of July. And what's special about the 19th of July? 19th of July is my birthday, and Dr. Dolido says that it's good to start this on your birthday. So I did this. I ran it on my birthday, and all I did was, rather than resort by sort by VST, I've sorted by RS. And that's what happened. And as you can see, there was 2 shares, Bellway and the DART group, that were on sell recommendation. So I ignored those, and I bought the rest. 10 of them, the top 10, that's all. Cranswick, Reed Excelsior, JD, Hallmey, Electric Components, Reckitt, Sage, WPP, Bunzl, and Tate & Lyle. And that's what's happened since. It's hasn't done as well as I would have liked, but it's up 8.69%. The market's up 6%, and that's a 32% annualized gain since that. I've got 6 winners and 4 very, very small losers. None of them have gone anywhere near their stop loss. Okay, so I'm quite happy with that. Already outperforming the market, and I think that if the general market does sell off, quite a few of those shares will not smell their stop loss. Okay, so what I've tried to present today, even with the ghastly internet, is a very safe method of building wealth and building an income. For those of you that are struggling in trading and are a part of that 95% that are not making any money, I can pretty much guarantee that if you do this, you're going to find it fairly easy going. For those of you that are successful as aggressive traders, you need somewhere to park that cash, and this is something that I think that you should investigate. It's certainly where I'm going to park my long-term portfolio over the next couple of years, both in South Africa and in the UK. You can test it for yourself, and you can replicate all of the stuff that I've just done. I'm happy to offer you a 5-week trial of VectorVest US and UK for £5, £5.95. VectorVest is then invoiced at £44 a month on a month-by-month basis. And if I can't make you money, you can stop it at any time. That's my promise. Okay. And if you go to vectorvest.co.uk/RTC, then you can avail yourself of that offer. My apologies for the quality of the internet. I've been using this internet here for years, and I've never had a problem with it before.
David, it just seems to be today, and around the clock traders today seems to be the target of all these gremlins.
We jinxed.
We've come through it. We've made it to 1 o'clock. So thank you very much indeed. I've posted that link in the chat box, and of course we'll follow it up in our email following the event. So thank you for that. Struggling
thank
on.
You, Simon. And I'll see you next Saturday.
We will do. Enjoy and safe travels. Thank you very much.
Cheers, Simon. Bye-bye now. Bye-bye, everyone.
There we are. Thank you there to David Paul from VectorVest. So we're going to go straight across now to Steve Ruffley, who is already in the room, which is great news. Steve's going to give us a very quick review of the live markets at the moment and see where we're up to this month. So I'll take the microphone off there and say hello, Steve. It's Simon here. Can you hear me okay?
Yes, can hear you fine, Simon.
Ah, great. Good afternoon. I don't know. I think you've just joined in the last 10 minutes, but we've had quite a morning with
right.
computers crashing and internet coming and going. It's
right. The end of the world.
It's just been one of these days. So I'm glad to hear that you're on the line and we can hear you, which is great. So we've got half an hour for your review. So we'll do our usual changeover while the internet seems to be working fine. I'll make you the presenter so that we can see your chart. Just responding to Andrew, yes, these sessions are being recorded throughout today, so they'll be available to you to review. We'll send you the links on email just as soon as we can. So back to the current thing, we can now see Steve Ruffley's charts, and quite a lot going on today, Steve. Is there what's been catching your attention today?
Well, again, it's mainly fundamentals out of the UK, so not really kind of a surprise figure, but kind of resilient growth is the kind of message from the UK, that despite the Brexit and the fears, etc., that UK GDP was still up by 0.5%. So that sent a bit of a spike up in the FTSE, big spike up in cable, and we're just really, I mean, it's this kind of, I don't know, it's kind of no news is good news almost. The kind of world's set itself against the UK in the short term. We've got all these rumours that, banks are preparing to leave, that this, that and the other, and, we're not going to be able to do these trade deals, as we say, and these leaked, bits of information from Theresa May going against her own advice, etc. It's just the way the markets work, and the guys in the city and the people that move the world, they're all like little girls sometimes, shedding little rumours and kind of picking up a little bits of information. But the fact of the matter is, again, we're still in this state of uncertainty until Article 50 is triggered, and even that won't bring long-term certainty. It will just mean that the process, has to be achieved in a time scale, and that gives us some boundaries, because this is the whole point. I mean, again, I have to go back. I never listen to other presenters. Listening back to the other presenter, then it's kind of worry-free trading. Yeah, it's that easy. Everyone in the world have the money in VectorVest. I'm sorry, there's no such thing as worry-free investing. There's no such thing as stress-free trading. Trading's meant to be stressful. That's why, it's part of the reason why people do it, because you get that buzz out of it, because it's meant to be stressful. You're meant to put risk. So, at the end of the day, all this kind of idea that, you've got loads of fund managers in the city looking at that piece of software, it's like, yeah, of course they are. If they were that interested, they just buy it, they buy the company. My experience, unfortunately, when you look at trading, you look at the charts, this is what you get. You get the same information as everybody else. If you want to, buy and hold shares for a year, 5 years, 10 years, great. When I ran a big investment department at PwC, that's what we used to tell people. You've got £1 million to invest, split it out into a diverse portfolio. Buy some bonds, buy some currency, buy 10 safe stocks and sit on them. But you don't check it every day. You don't check it every 6 months. You check it every year, every 2 years, 5 years, 10 years. The whole problem is that that way of thinking. It's old man thinking. It's old-fashioned thinking. The world's changed beyond all recognition since the credit crunch and this kind of stuff. And people now want safe returns, reasonably safe returns, quickly. So at the end of the day, you can look at what happened, in a long-term portfolio, and you see the crash on Brexit, you see the crash on, the credit crunch, etc. That would just be more apparent coming up, because nothing really changed the situation in the world. All we've done is negate any kind of natural correction in the markets by pumping the markets full of quantitative easing, by keeping interest rates at record lows. So people can service a life that they simply can't afford. And that's happening in America. It's happening in the UK. It's happening in Canada. Canada's got something like 3 times GDP in household debt, because Canadians have just done what everyone else has done. They bought a house, they've let it appreciate over 10 years, and they've spent that appreciated money on other houses or other things. So the money's not really there. And you think that's a problem? Think about what China is undergoing. So this idea that you can just sit on your shares and watch them grow is absolutely right. But unfortunately, you could see your 5 years of gains wiped out in 1 year. So as I've said a million times when it comes to trading, it's not about being right. It's about being right at the right time. So yes, you need to be able to watch your portfolio grow, but then pull it out when you think things are overcooked or ready to kind of pull back. And that's why I'm not a fan of that style of investing, because I like the freedom. I like to see the markets move. Like the DAX this morning, it just jumped up. No real kind of news, to be honest, but if you're buying these low levels and you're getting back to simple trend lines, there's 116 ticks. Now that's about as simple as a chart as anyone can make it. Not hard. So what we're looking for is the market dips down, hits a good level of Fibonacci, 100% retracement, test, bang, up. So if you're trading any kind of decent size, if you've got 50 grand to throw around and you can put that into a spread betting account, that 50 grand, you could make 15,000 quid easily. If you're an aggressive trader, I trade anywhere between 100, 600 pounds a point. If I'm buying here and get out of the 50%, yeah, buying the low, getting out, making 60 ticks on that, that's my money all day long. And, these are not circumstances that come around all the time, but this idea of beating the market, it's just, this is what's dragging everybody into inevitable doom, inevitable bubble, because everyone's trying to beat the market, trying to, get these returns and, this safety of money. Shares are a risky investment. The longer you're involved in shares, the more risk you're taking. So my argument for day trading is you're involved in the markets for the least amount of time. So you're in the market, you're taking your risk on, you get your profit or you get stopped out and you're done. You look for the next opportunity. And I could do that 5, 10, 15, 20 times a week. And I'm always going to make money than sat there watching shares grind out, going up 0.5%, going down, over a period of time. And I'm not saying that it's not a sensible way to invest some money. I think the point that the last presenter made was if you've made money being an aggressive trader, put some into that for the longer term. But then, that's for your future. If you want to make money right now, it's here. It's on your screens. It's in all these candles. These are just hourly candles. Doesn't matter how you look at them. Break it down to the 15-minute. Even better. Look for a green candle. Look for it to close. Find support. Hits the 50%. Hits the 100% expansion. Happy days. 1, 2, 3, 4. All you got to do is hold a long trade in the stocks because, again, they're going up. That's why people are making money. Yeah, and then get out when it turns red. So, that's, if you're buying the lows here, you're making 40 ticks. You're making 75 ticks, 113. If you even get out of the 50%, the top of the Bollinger Bands, you're still 83 ticks on side. Now, if you're managing your money, managing your risk in a proper way, then you're always going to make more money in this way of trading by compounding wins and consolidating those wins from spread betting. And I love all these kind of statistics that people like to throw around about spread betting. Spread betting intraday trading, yeah, all right, it's hard. It's damn hard. But this 95% of people never make any money. Where have these stats ever come from? Because I don't know. Because it's not about 95% of people don't make money. I think the stats are 95% of people don't take money out their accounts. Okay, and that's a different thing. It doesn't mean they lose the money. It's just like they're constantly trading, so they don't take, that lump sum of money out their accounts. And I've been a chief market strategist trader for 6 years. I've taught hundreds and hundreds and hundreds of people to trade. Yeah, and I see people that join my mentoring schemes that have an amount of money in an account and make money, go on runs of making money every single day for a month. Yeah, and then they'll have a drawdown, they'll have to rethink, and they'll carry on. But they're still making money. The City of London wouldn't exist. Trading floors wouldn't exist if you couldn't make money intraday. I think that what people tend to forget about trading intraday is it's just another style. Yeah, if you're looking to be an investor, or you're looking to be someone that works from home as a trader, there are different ways in which you can do it. But the whole point is why a lot of people, and that's where I come in, a lot of people fail. It's for two reasons. The first one is they're undercapitalized. Yeah, they go into trading thinking that all the things that's been read on Google, or these silly little courses that people charge £2,000 and it'll change your life. Yeah, you don't need all that kind of stuff. All the information is for free. Yeah, and you have to be realistic. Number one is people don't put enough capital in their account to fund their trading career. That's why they lose. Most businesses fail because they're undercapitalized. You don't buy yourself enough time. Secondly, you have unrealistic expectations. You're looking to make a living from trading. You put £5,000 in an account because you think that's a lot of money. To realistically make a living from that, you've got to be making 20, 30, 40, 50%, a month return. Not going to happen. Of £5,000. So these are the reasons why. And then people, again, that's when people put bigger money, like £50,000 into VectorVest or £100,000 or whatever, because you see those little movements are less painful to take. Now, I deal with clients who are billionaires, right? So what they hate is seeing big shifts. They don't mind making bits of money. They're not even interested in making money. That's just what they do. If they make £1 million on, a property, so what? If they make 2% of their shares, in their share portfolio a year, so what? Not interested. If you lose 5%, then you're over the coals. These guys hate stuff like that. And that's what you've got to understand how the world works, is looking for, because there's so much money out there, where is it safe? And nothing is safe. Nothing. Property, not safe. Bonds, not safe. Shares, not safe. It's all degrees of safety. So that's where the balanced portfolio comes out. So when you're putting, again, buying shares for long term, that's just one area of your overall portfolio. So that's right. Don't put all your cash into shares. Don't put it all into bonds. Don't hold it all in cash. Again, if you want to kind of have that ability to have freedom to make money, and I mean this, to actually physically make money day to day, the only way sensibly you can do that is by putting a big enough amount of money into a spread betting account to service your needs, to be realistic. If you want to play at spread betting, you will lose your money. If you want to put a little bit of money that you can afford to lose, i.e. £500,000, you already have lost your money because you've said that. But if you put anywhere between £10,000 and £50,000 into a trading account, doesn't mean you're going to lose that. It just means you have more time, you have more ability to make money in the markets. And this is why, again, I get quite annoyed with, not annoyed, but I couldn't care less. I don't get annoyed about anything. Why should I? Makes no difference to me. It's the world's perception that certain things are bad and certain things are good, right? Only way of finding out, what is good or bad is if it's making you money. It doesn't matter how you do it. It doesn't matter if it's not technically the best way to do it or it isn't technically in the rules. As long as you make money from it, it doesn't matter. And this is the whole point of why I do my free webinars over the years, is to give people an idea of what is possible. And then you've got to go out and achieve these things. And if you look at, again, the UK, for instance, we see that the market, it's never happy. It's never been happy way above 7,000. So you find good areas, 50% Fibonacci, and you sell it back down and buy it. And again, you're not talking about huge wins here, 24 pips, 58 pips. But if you have a £50,000 account and you're chucking a couple of hundred FTSE around, you're going to be making £2,000, £3,000, £4,000 out of these trades, and you bank it. And it's not about being right. It's about being right at the right time. So the FTSE, again, Brexit is on the horizon. Article 50, uncertainty, trade deals. FTSE's never been comfortable. Look on the higher time frame charts above 7,000. So what happens when it gets 7,000? Oh, I don't know. Sell it. And then if it gets down to the low points and you see some good news, buy it. It's not about having the right opinion. It's about being right and making money. I'm not bothered about being right. I get asked to do Reuters polls, Bloomberg polls, predicting stuff in 6 months, 12 months. I don't know where I'll be in 6 months or 12 months. I haven't got a clue where the market's going to be. I had to recondition myself over the years to stop being one of these people that sits around the pub trying to be right. I'm not interested. Yeah, I'm interested in making money. I'm interested in making some money, and if I'm bored, I go out and buy a Rolex, or I plan myself a nice holiday, or whatever I do. I don't care, because I'm not sat there waiting for my little signals to pop up on my screen, go, bang, bang, you've made your 3%. Who cares about 3%? It's just boring. If you want to be interested, you want to be motivated, you want to get involved in the markets, then understand why the markets are moving right now, today. So the markets have moved today because of UK GDP. UK GDP was good. Everyone thought it would be bad because everyone's frightened of Brexit. What happens? The FTSE goes up, spikes up, and then comes down. Why does it come down? Well, because it doesn't like being above 7,000. And also, it doesn't matter how good the data is, the overriding factors are that Brexit's coming, and that will be a time of uncertainty. So you just keep selling the FTSE when it spikes high. Simple. Again, the pound did exactly the same thing. Spikes on the news, breaks above the 50%. We've got some great levels to sell, and it comes back down. People sit back, take and assimilate that information. We go, actually, yeah, the pound is pretty low. It has been hammered. So on that good news, we'll buy it back up. But it hasn't made a new high. So the pound will probably, if you look at the overall charts, continue the downward movement. Because every chart you look at, there's more red than green. We've had the consolidation here after the Brexit announcement. If it was going to stay strong, it would have happened by now. So it's much more likely to make lows than it is high. So when you get to your hourly charts, look for high points and you sell them. 15-minute charts, look for high points and you sell them. Simple. What else do you want to do that in? Euro dollar. Why is the euro going to get smashed again? Well, the whole thing is about contagion. I mean, these are messy charts, but the higher time frame, they're just for illustration. Unprecedented 9 months of selling, consolidation. But what's going to happen when the UK leave the European Union? Well, they ain't getting the UK's cash, for a start. There's a risk of contagion. Other people, other countries looking at the UK and going, well, actually, if the UK can do it, we can do it. And just generally, European Union isn't working. You tell me it was working. Well, the banks have finally, started to steady the ship. We might taper quantitative easing. We might do this. Still got negative deposit rates. Still got VW with the biggest corporate fine ever seen. We've still got Deutsche Bank shedding 10,000 jobs. What, third quarter profits of Deutsche Bank? What did they do? Like a big round of applause. Oh, well done, Deutsche Bank. But you're still going to cut 10,000 jobs. What's going to happen in the future? So I don't see anything good coming from the Eurozone. Italy, banking system collapsing. Greece, never going to be fixed, ever. Spain, still massive youth unemployment. Portugal, still massive youth unemployment. Where's the good news in Europe? I don't see it. So the UK leaving that, going on and doing what it does best, making deals with China, Australia, America, Canada, you name it. How can that not be good news in the long term for the UK? Short term, uncertainty. People get frightened because people are soft, people are sheep. They believe what they hear in the news. But you think about the credit crunch, end of the world times, property back to its highs. Yeah? Banking sector, not doing great, but still there. Doesn't need a bailout just yet. And that was 8 years ago. So what's it going to be like in 8 years? Maybe it's another absolute boom for the UK. We're under our own steam. We can do whatever we want. And yes, there is uncertainty, so the FTSE is always going to be susceptible to selling off for the highs. So is the pound, but so is the euro. So this is why you've got to look at your charts and have some balance. And again, I can tell you, well, I can tell myself, what I'm thinking in the markets just by looking at these 8 charts. And that is how you get an idea of what the market's thinking right now. It's not by looking at future signals. It's not by looking at, automated systems. Automation has a massive part to play in charting it, technology and trading, because computers can just do more things simultaneously than the people can. That's obvious. But if you think that a computer is going to sit there and just make you money, and that's the easy way, all you've got to do is pony up 44 quid a month, it just isn't going to happen. It just doesn't happen. If you're going to do these kind of things, you have to be paying a professional to look at it. You look at the hedge fund managers. Hedge fund managers are expecting a massive cut in wages. People are pulling out of hedge funds because they're not making the money. Yeah, and these are people that get paid millions and millions and millions of pounds a year. So you think that you're going to pay 40 quid for a piece of software and that's going to change your world and make you money? It's just for people down the pub, isn't it? It's just people down the pub that have no real idea. If you want to do things and make some money, it's hard. But if you do it in the right way, yeah, and you understand yourself, you understand the markets, that's how you make money. So you look at these 8 charts and you think, well, the S&P, still pretty strong, but what's going to happen? Is Clinton going to get in? Is Trump going to get in? Well, Clinton gets in. We're back to new highs. Back to new highs. Not far away, are they? Yeah, all-time highs up here at 2193. So Clinton gets in. Fortune 500 companies loved Clinton, didn't like Trump, so it's obviously going to be a good thing. Stocks are going to make new highs. But then it's known. We've got 4 years of Clinton. Is Clinton any better than Trump? Potentially less volatile as a statesperson, as a leader, but is she really a leader of the free world? Is that who you see Hillary Clinton as? She's an old woman. An old woman with old ideas. We've got an old woman with old ideas leading it. We've got the Fed, old woman with old ideas, trying to, get a grip on growth, inflation, and interest rates. We've got an old woman leading the UK. We've got an old woman leading Germany. I mean, when did the world become so reliant on old women? I'm not saying, this as a sexist thing. I'm just saying it seems to be very one-sided at the minute, and it's the old ideas that are dragging the world down. They're keeping the 1% wealthy, they're keeping the homeowners of the world wealthy. They're not doing anything else for the rest of the world, and that's why Brexit happened. Because when the gap between the rich and the poor gets to its big enough point, bad things happen. And as I've said, I don't think Brexit's a bad thing. Something you want to say, Simon?
Well, not me. Yeah, 1 or 2 people wondering why you're so angry this morning or this afternoon.
Passionate, not angry.
It's not angry. This is just the default setting. No, it is. I think you're. Yeah,
I'm just trying to be realistic here. I'm just trying to, I get to do these things. And I do a lot of webinars, I do a lot of seminars. I'll be over doing your presentation on Saturday, and I'm just kind of at the point now where I'm sick and tired of the media. I'm just sick and tired of people telling you can't do this, you can't do that. We're all grown-ups here, and people that listen to these webinars are people that not trying to be sold a free dream or sold free money. What you want to look at and listen to is somebody who tells you how you individual person out there can get involved in the markets and make some money. Yeah, I'm not trying to sell anything. I come on these webinars. I'm not trying to sell anything. I'm just going to tell you the way it is, and I'm honest. Okay. And I get paid a lot of money to be honest. So when you see the markets like now, the pound, what did we say? Yeah, you look for high points. The overriding fundamentals are going to send it down. So where's it going to get to? 1.22296. If it breaks below that, 1.22068. So right now, if you're short the pound, these are your targets. You make 8.5 ticks. 31.5 ticks. That's where the real money is. Your real money is in making 20 ticks on good size. Yeah, there's 10, if you have a £100,000 account, for instance, you can easily make 10% a day. Done it, seen it. Yeah, it is possible. Will that happen every day? No. But if you're patient and you wait, there's much more money and safety to be had by trading the right way intraday than there is by this myth that long-term investments are the way forward. Because that's the way the system used to work. How many pension funds actually have the money they claim to have? Yeah, they're all in deficit because they're all just doing the same thing. The money's to be made in the short term.
Right. What about a counter trend strategy? William's asking. Do you ever look to go against the trend?
Absolutely. I'm Mr. Counter Trend. No, I mean, the thing for me is, again, it's not trying to be about, you have to have an overall understanding of the overall trend, the overall direction of a market. But again, these are lessons I've learned over the years. It's good to be market neutral. So, you can get caught out by having a bias, by always doing the same thing in the markets. So a lot of people have got their fingers burnt in the DAX because they keep selling the DAX and it keeps going up. So the whole point is you're not trying to be right in direction. You're trying to be right at the right time. And all you're looking for is anywhere between 50 and 30 ticks. Yeah, and that's buying low, selling high, letting the market sell off 300 ticks and then bounce to 30 ticks. I don't mind, because if you trade in the right way with the right margin, okay, and you allow yourself to put enough money into an account to run the right kind of margin and risk strategy and use the right kind of size, then that's how trading's done. That's how winning's done. Okay, and it's not about tying loads of capital up and watching it tick away. It's about using capital for what the market's telling you. There's so much fundamental information. There's so much uncertainty. There's so much potential movement that's good. So again, what you can look for is the market getting to this level that I've just called out, 1.2296, and then maybe you think, well, it's good for a bounce. So look for a point to buy it, and maybe it just flips up 13, 14 pips back to this 161 spot 8 retracement. Maybe you want to trade it off the 5-minute charts. Again, it looks quite bearish for me, so I'll be more likely to sell it, but I won't sell it now. I'll buy it back here because I'll be more likely to get a bounce off this point than I'd want to sell it back down. And again, that's counter trend in a way. But the whole point is, it doesn't matter what I say. It's what makes me money. So I try and teach people and help people realize that it's not about buying the absolute low and selling at the high. And if something moves far enough, there is money in between just sat there. And all you got to do is have the right amount of size to get on it and get in and get out. So if you're in the trade for a 5-minute and you make 15 ticks, that's great. It might go 100 ticks after that. Doesn't matter. That's gone. You can always get back in. It's all about not leaving money on the table. When you're investing, all you're doing is leaving money on the table. You put your money there, you pulled your pants down, and you're at the mercy of the market.
Okay. Anything? I know you're a Fibonacci trader as well. You follow the Fibonacci levels. Anything that we should be looking for? Is there anything coming close to levels?
I mean, again, all the levels that you see on the charts right now, the hourlies, are all around Fibonacci. So gold, again, around the 50% Fibonacci right now. So as the stocks are, the Fibonacci movement, actually we've got a bit of US data coming out in 4 minutes, so maybe this is just a bit of a precursor to that. We've got initial jobless and durable goods. So that, again, could put some pressure on the market. So we might be seeing a bit of a preliminary movement. And again, it's another opportunity to make money. Just bring yourself an economic calendar up, and you can wait till most US data is out at 1:30 in the afternoon. I'll be trading live GDP at 1 o'clock tomorrow for Intertrader. So again, it's another way of being around in the markets when things are going to happen. The market, is looking to the Fed, who's data dependent, on interest rates and things like GDP, initial jobless, not so much, and durable goods, not so much. But if they're good, strong figures, that's really pushing Janet Yellen's hand that she's going to raise interest rates, in December. So that, again, could bring a bid to the dollar, which is already quite high. It could then put some pressure on the euro, high, so it should come down. Pound, naturally, been selling from the highs. And maybe a little bit of a downturn in the stocks. So again, you're always trying to figure out where we are in the cycle, what's moving markets, and why. And as I say, you just go back to your hourlies or 15-minute charts, you look for a 15, 20-tick move, get your money, get it out, reset, and just do that 2 or 3 times a day. The money's there. The money's there.
Steve, you make it sound so simple. Here we are. Okay, well, any more questions for Steve before he goes? Just a slightly shorter session today. Gina says it depends on the time trades you trade from. Do you have a chat room? Well, I guess I've just posted Steve's website, mt4switch.com, in the message box there, and if you go there, you can actually get some free mentoring with Steve, providing, of course, that you are an InstaTrader account holder.
What the deal is with me is that I've been the chief market strategist of InstaTrader for 6 years. So I've always been there, I've always done it. I do my education. No, it's free to the customer. So you can watch my webinars, my live trades, as in the one tomorrow, and it's free. If you want to speak to me, find me on Twitter. We can make some arrangement. If you want to be a trader that is a good trader and be great, a great trader and be better, or you want to understand this 1% that nobody wants to tell you, and the things you won't get from a £2,000 course or this kind of stuff, then if you open an InstaTrader account, I will give you my time. I will mentor you. But there's some certain rules. You've got to be serious. You've got to act professional. You've got to put some money in the account. Because I'm not going to sit there with someone with £500 in their account trying to tell me that they want to buy a Ferrari. It ain't going to happen. You've got to be realistic. So I will give my time, which is anywhere between £150 and £500 an hour, to people if they were serious about, improving their trading. But these are the rules. So again, I'm open to help anybody, and I've helped lots of people over the years, but it's all about being realistic.
Great. Steve, Ruffley, MT4Switch, go to that website, mt4switch.com. That's in the message box there, and you can get in touch with Steve through the site. So thank you. Thanks, Steve, for joining us again. Always good. And we look forward to seeing you in London as well for the live seminar at the Round the Clock Trader Live event on the 5th.
I will be there, mate.
Looking forward to it. Okay, I'm going to take the presenter back from you now, because we're going to go over to our next speakers in just a second or two. So there we go. Thank you very much to Steve. Now, 1:30. We are right on schedule. We've caught up, thankfully, with our schedule today, and I'm delighted to introduce our next speaker, or speakers, as I should say, Dr. Andrew Lumsden-Groom and his business partner Ken Stanion. Both work for House of Trading, the House of Trading. Both Andrew and Ken are new to this event, having confirmed that they will be providing a seminar at the live Round the Clock Trader in London on Saturday, the 5th of November. I contacted them and said, I wonder if you'd join us today on our Round the Clock webinar, which I'm grateful to say that they accepted. So just a short 30-minute presentation for those of you that haven't heard of House of Trading. We can go over now and bring them into the event and speak to them live. So I'll take the microphone off. So both Andrew and Ken have got their microphones unmuted. If I say good afternoon, Andrew, are you there?
Good afternoon, Simon. How are you?
We're very well, thank you. I'm so pleased to hear you're there. We've had a morning of internet upsets and computers crashing. It's very unusual that we've had to have these technical difficulties, but we've overcome them, and we're back on schedule. And we've got a nice crowd of predominantly Forex traders in the room today.
Brilliant.
So
right, I suppose I should get started then.
Shall I make you the presenter or Ken?
Me first, please.
You first. Okay, so let me do that, and we'll see the next screen when you be asked to confirm. Wonderful, wonderful. Okay, so we can see that clearly. So, Andrew, we haven't spoken before. We're relative strangers to each other, but I'm pleased that you're here. I haven't heard of the House of Trading, so this is a great opportunity for us to find out all about you and what you've been doing. So I'll hand the floor over to you.
Thank you. Well, hello, welcome to this House of Trading webinar about harnessing economic data and improving your risk-reward ratios. Just to fill you in a little bit on who we are, I'm Dr. Lumsden-Groom, and my head of trading is also with us today, Ken Stanion. And what we do is we provide market intelligence services to city trading floors. On top of that, we teach city traders and retail traders. We've been doing this for the last couple of years very successfully, and we've got some tips and tricks that we use in our teaching and in our market intelligence services. This webinar is going to be mainly about using economic data, because one of the things that we do for our institutional clients, to call them that, is provide data regarding economic events. As Stephen mentioned earlier, markets are highly driven by economic events, and they centre around price action regarding those events. So we end up in a situation whereby the ebb and flow and the natural tides of the market are highly linked to economic data. So what we're going to talk about today is just how you can lower your risk by using that economic data to your advantage. It's not all we do. We do obviously train traders as well, and we train traders for some of the biggest city institutions out there. We also train retail traders, but one thing I would say at this point is I noticed that Stephen mentioned that 500 quid isn't a great amount to start an account on. I would have to fundamentally disagree there. I think that as long as you're making the right percentages, good teachers should be able to bring you through and help you build that account into something meaningful. Our head of our trading floor did an experiment a couple of months ago where he took a £250 account and turned it into £9,000. Now, I'm not saying everybody can do that, but with the right support and right learning environment, you can really take an account of any side. It's all about percentages. If you can build those percentages month on month on month, you can get to a point where an organisation like ours will suggest you to a city firm or give you an account large enough so that you can get the data in to be able to go and become a city trader. For the House of Trading, that's our goal, is to find those retail traders that have the capability and the skills, or we can train them to have the capability of the skills, and effectively get them to a level where a significant stable income or a seat on a city floor is more than possible. So on with the presentation then, I suppose. So the House of Trading, harnessing economic data to improve your risk-reward ratios. So what moves the markets? As again Stephen said earlier several times, releases move the markets. For example, today we had UK GDP, and I think by now we'll have had durable goods orders and core durable goods orders figures for the US. Both of those figures will have moved the markets. I mean, we saw the move in the GDP, and we will now see the move in the USD. So the ebb and flow of the market is primarily driven by economic data, and that economic data comprises of 306 major releases a month, of which that works out to be around 14 major releases a day. From those 14 releases, we're down to about 5 that will move the market by 40, 50, 60 pips, and 1 that traditionally will move the market by around 100 pips or more. So it's always worth being aware of the data. Now, just for reference, the scale of the Forex market. The House of Trading, we concentrate on 21 major currency pairs, primary tradable currency pairs, all the major indices, and gold and oil in terms of commodities. We especially like Oil Wednesdays, where the data from the EIA comes out and effectively sets the pattern for oil for the following week if there isn't any OPEC speeches or anything like that. So data drives the market. It is the tide within the market, and if you can catch that tide nice and early, what's the old saying? A high tide rises all boats. So effectively the market is huge. Trying to keep on top of it is very, very difficult, and one of the ways we really suggest that you do this is by being aware. Grab an economics calendar from any of the major news companies out there, and you will be very grateful for it. We suggest to our traders that they spend 15 minutes every morning just going through the economic data. We have our own in-house economic calendar designed by our chief financial analyst, Pratik, who used to work for the London Stock Exchange, and his team. And then we have our own forecasting systems, which we'll show you in a minute. But effectively spending that 15 minutes every morning just working out what what's going on that day, when it's happening, just, if nothing else, even if you're a technical trader, just so that you know that this market is likely to be volatile, this currency could be volatile, or that there's going to be this move that you need to be aware of so you're not on the wrong side of it, is one of the best ways to lower your risk portfolios as a trader. Now, again, I agree with the previous speaker, Stephen, in the fact that day trading is probably the best way to make good income. Swing trading as well. I must admit, I do hold some stocks and shares myself, and the company holds them as well. But that is a long-term thing. You're looking at stable long-term returns by dividend, whereas day in, day out Forex trading does allow you to make a daily income and make your 3% or 10% or whatever it may be on your account. For smaller accounts though, it is labor intensive as you build those accounts up, and it is hard work, so you do have to put the energy in to get to an account size where you can start making enough money to do it as a job, but there's no reason why you can't do that if you can spare the time and put the effort in. So understanding the markets. There are so many currencies, commodities and indexes out there, and staying on top of all of it isn't easy. It really isn't. We have a team of 7 analysts that do this, and that's their job, and you'll see why it's their job in a moment. But economic events are the primary driver of markets, and therefore the primary driver of both your profits and your risk. Event-heavy weeks bring more risk to the market, but if properly monitored, can be the backbone of a trader's continued profitability, and that's what trading is all about. It's not about the big win or the 200 quid per pip that you're trading. It's about the percentage of profit that you're making on your account. Good percentages mean long-term profitability, which means eventually you can turn it into a career or a second income. That's the most important thing. So monitoring economic events allows you to lower your risk and take fewer risks whilst also being aware of those bigger profits, those 100 pip moves, 200 pip moves. So you can lower your exposure to risk by getting and staying on top of economic and market events. And I'll say this again, we're going to show you our currency sentiment forecasts, which are effectively a visual representation of an economics calendar. But you can just use an economics calendar. Spend that 15 minutes every morning and just use an economics calendar. I mean, I'm a doctor of socio-political economics and effectively a specialist in market economics. Ken's been trading for 14 years, and we have a great staff, and all of us agree that the best way to start your morning is to just spend that little bit of time to find out what's going on and to make sure you're on the right side of it, or not touching it if it's effectively too risky or the data isn't clear or you're not sure. I mean, for example, today's GDP figures, we forecast last week that we'd be looking for, well, we forecast on Sunday that we'd be looking for upward pressure in the pound, because given the wider data available, the UK economy was very clearly outperforming expectations. So staying ahead of that, making sure that you're aware of the markets you're in, the economic situation that those markets are in, and how those currencies are feeling, their personalities are all based on economic data. So 15 minutes every morning just to stay ahead of that, and it's worth the time. Technical traders can see their risk parameters increase tenfold in the markets if it's a data heavy week. After all, if you don't know what's coming, then you can't plan for it, and you certainly can't make money out of it. So combining economic events, say, I don't know, the pound USD today, for example, may make for an interesting pairing, and effectively what you're looking for is one set of positive data and one set of negative data, because then you can actively trade the combination of market sentiment. One currency negative, one currency positive means that we're likely to see market sentiment move the market in one direction, and that's the key, is knowing the environment you're trading in. I've been trying to come up with a metaphor all day about the idea of you wouldn't walk by the river at night if you didn't know where the path was, because you might just fall in. But I haven't been able to come up with anything that really works, so I hope that that does. Right, so from here we're going to take a quick look at the currency sentiment forecasts, which are a House of Trading specialty. Our team of analysts and myself, we designed this in conjunction with a couple of brilliant mathematicians from the London School of Economics, and actually a physicist, black hole string theory physicist, my friend Sally. And what we did was we came up with this. Now this looks very complicated, I know, it's very, very busy, but what you can actually see here is a physical, visual representation of what each event on that economics calendar that you use, or we suggest you use, actually looks like. So a positive event likely to push the market upwards, and a negative event likely to push the market downwards. But what we've also got here is your warnings. Now I'm not suggesting that you have to come and buy this from us because we're the only people that do it. We are the only people that do it, but you can do this with an economics calendar in 15 minutes a day. Not to this level, but you can certainly bring your awareness up of the market and the environment that you're trading in and are going to be trading in. So we have yellow warnings, for example, that say, if I can find my mouse, there we go, yellow warnings that say that there's low probability data, that the data isn't clear enough. If data is going to move by a tiny amount compared to last month or last week, it's probably not the most reliable. What we want is nice, clear changes in data from one figure, preferably a minus figure, to a positive figure, or the other way around. So for example here, we've got the German factory orders at 0700 BST, and we can see the blip to the upside up to a +5 on our sentiment forecast. Now that's the one that we chose to include because that's likely to be the big market mover, so it ends up in our news section at the bottom. But as you can see, the shape of this move, the shape of how we expect currency sentiment to play out, market sentiment to play out, it's much more complicated than that because we absorb the little releases as well, and we work out how the market progresses over that time. And you can do the same thing, again, not to the same extent, but because we use a very large economic model. But you can plan for these things. You can plan for markets that markets may feel upward pressure, and you can plan for the possibility that the market may move strongly against you if the data is not correct. But you can also follow the trend ahead of publication and after publication. We call that the hot 15-minute rule, getting out 15 minutes before an event and not getting back in until 15 minutes after. You do lose some pips in doing that, but it lowers your risk portfolio so much. And one of the things we do with new traders is suggest that they don't trade in that 30-minute period around an event, but rather follow the trend before and after. So for example, we can see that this event, the factory orders, is expected to create upward pressure within the euro, and the Japanese consumer confidence figures is expected to create negative pressure in the JPY. So we get this nice divergence between the two, which then translates into us looking at our technical charts and seeing if there's any technical indication that that's possible. After all, these are just like an economics calendar. They are another indicator. They're an indicator that allows you to see the market ahead of time, or what market sentiment feels ahead of time, then go to your chart and see if that's going to happen. And very shortly I'm going to hand over to Ken, actually on the next slide, where Ken's going to run you through a good week and a bad week or rather a heavy week and a light week in terms of economic data, and then run you through some examples that actually happened as to how the data pulls together. So not only do you have the warnings, you've got this divergence between the two, and then you get crossovers and things like that where the euro starts to fall and the pound rises. Now this actually plays out live in the market, and you can see it very, very clearly. So I think it's probably time. I think I have to ask Simon, could you swap presenters for me?
Hello, Andrew.
Hello, Ken. Can I hand over to you?
You can. Let me just swap my screen over to this one. Right. Show my screen. Okay, just check that. That's me moving that around now. Okay, good.
Over to you.
Thanks, Andrew. Thanks for that. Welcome, everybody. So we're going to have a look now at what traders are really interested in, is how to convert that currency sentiment forecast into something useful that we can add potential to our decisions in our trading week. So we're going to look at a typical heavy week of events first, and we've got this chart. This is a slightly different one to the one that Andrew was looking at earlier, and how to trade. Well, I'd call this a nice chart. It does look complicated, but there's certain things that are very general that we can look at and see potential for pairs to look at. Now, down at the bottom here, I don't know whether you see my mouse. I'm sure, hopefully you can. Now, we've got suggestions that we look at the currency sentiment forecast, and we put down our suggestions for a watch list. So we can look at these pairs down at the bottom here next to the announcement details for setting up for the next day and for the week, and see how things are looking. But obviously these are not. This is a sentiment forecast. This is looking into the future. It's probably the only forward-looking indicator that I personally know. Most indicators are lagging. This is looking forward. And so these events have not happened, and the market is always right. Forget that. Get that into your head first. The market is always right. We're trading a market, and we're trying to get the roulette wheel down to a few sections rather than 30 odd. Now, looking at this chart, we can see the first thing that stands out to me is the GDP going from a -6 to a +6 and remaining reasonably positive for a couple of days, or very positive sentiment-wise. Now, that in conjunction with the euro, which is going positive to negative, that may be something that I'd really like to have a look at. The sharp rise on Tuesday morning with the yen, with the Japanese yen, not too keen on these kind of shapes when they're very, very quick up and down. Don't know whether that will start to move, but certainly the rise here in the JPY over a certain period of time forecast, that looks interesting too. And this chart's full of opportunities to look at and to transfer onto our charts. I mean, we look at 21 pairs, and that's not something that traders that are experienced do. You get used to the instruments that you get used to your instruments. You practice looking at the chart, one or two charts that you like, and get used to the personality of how those are moving, how the price is moving on those instruments. So what we want to do is we want to choose the train, 2 or 3 trains perhaps, that we want to look at to move out of the right station in the right direction at the right time. We don't want to be late for that train. We're going to miss a few. You always do. Don't worry about it. Just move on. That's probably one of the biggest rules for traders, is to just move on when you miss something. Don't be the fisherman and wish you'd have caught the big one you may caught. You know, he caught it, you didn't. Move on. This green band across the center of the currency sentiment forecast, we call it the volatility band. We're really looking for currencies that are showing outside of that band on these events that have the potential of showing this sort of sentiment that we're showing on our chart. We're looking outside the green band. So let's now look at a light week. Now, economic events drive markets. So weeks that are light in economic data normally mean quiet markets. A lot of the work of a trader is to sit on your hands. There's a lot of work to be done while you sit on your hands. There's a lot of patience. There's a lot of stalking and making sure that anything you've seen on long-term charts, you're actually checking it on a daily basis to see how that's working and progressing, so that you'd be ready to take the trades on smaller time frames at the right time. However, if you get a really quiet week, I mean, the thing that I look for is quiet periods, quiet momentum, quiet volumes, quiet small price movement over a period of time, because it is going to change. And when we get that momentum push, when we get that movement of price, that's when we want to start looking at whether there's a useful entry point for a trade. So we'll look at one now where most of the action is at the end of the week. Now on this chart, it's very different. This week was very, very different. This is we don't particularly like this. There's not a lot to talk about until Friday, perhaps, where it's gone red, in fact. And so lots of warnings and lots of volatility and movement of price expected there. At the beginning of the week, we've got no differential between currencies, really. Not a lot happening outside the volatility band. We've got the euro that's dropping, and we do have this big change from a forecast low here of a -5 up to a +5, which is interesting, and continuing into Friday. So that might show us some useful moves. But Monday and Tuesday might be a little bit slow. So it's really great to see this at the beginning of the week, because you can set your emotional expectation levels and for the week ahead, and just get into that calm frame of mind that is necessary to be consistent in this work. Yeah, let's move on now to looking at a currency sentiment forecast and how it converts into tradable situations, what we're actually looking for. I've taken this one first because I did actually trade this way back whenever it was, October last year. And first of all, price-wise, these, by the way, this is Heikin-Ashi candlesticks. I do like these. It cuts out the noise, and freely available, and it cuts out the noise once you're in trend. I do actually like trend trading, although I do agree with Stephen before that there's a lot to be said for just taking the small moves and watching the smaller time frames. There is so much information, both fundamental and technical, to take in as a trader, that the whole job of making the fundamental data into a picture, like we've done here, into a visual representation, is to work towards making it obvious that simplicity actually works over the long term. Keeping things simple, keeping to what you do know. But as Stephen said, markets do change. Sentiments in markets do drive the price, and we have to be aware of that. Not only that, but matching the sentiment of how you trade, the way you trade, needs to be matched to who you are. You can't really change who you are. You can learn to control it. You can learn more about yourself, and that is one of the biggest areas that is. It's not very exciting to talk about your emotions. It's much more exciting to talk about profits, but it's really about performance rather than profits, how you perform as a trader and the consistency of that. And that's really down to knowing how you react around financial around the financial area. So let's have a look at this chart. I've chosen this one first because it's fairly easy to see what's happening here. We've had a nice downtrend. We are underneath the EMAs. I do use EMAs. I use the 8, the 21, the 50, and the 200. We've had what's called a dead cross just up here, just off screen, and so we're really anticipating and looking for more downward movement on this currency pair. This is the train that we're on at the moment, the euro pound, and our direction is downward. So we looked at our data at the beginning of the week, and the chart came out like this, and not a lot happening on Monday. This is a regular thing. Monday's often a quiet trading day. But what we do have, the only thing we do have, is that the euro is expected on this event on the Monday to go to a -3. It's also quite negative on the Tuesday as well, which is interesting. But later in the week, it gets very interesting, especially at this separation from zero, as we call it, with the Great British Pound. So on the Monday the 19th, and if I just run the line up here, this is the line here where Monday the 19th starts. We're just we're going sideways, consolidating really on a slightly upward trend, getting slightly higher lows here into the 50. We get these dojis on the Heikin-Ashi candlesticks, which are showing indecision, very obvious. I'd like it to be as simple as possible. I do honestly flick between Heikin-Ashi and normal candlesticks, just because normal candlesticks give you a bit more information, or different information, should I say. And so I'm looking for a short on this Monday on this. So and we get 40 pips there, which is absolutely fine. And then we get more indecision here as we're just coming up. But I would get out just at the bottom here on that one and just take those 40. Now on this on the Thursday, the Wednesday the 22nd, which is from this line here. We've come back, but now we're having a bit more potential to move to the upside. We've hit the 200, a little bit stronger resistance to that, and then again, I've got my currency sentiment focused, and I'm seeing this separation that may be happening on these events on the Great British Pound and the Euro through on Thursday. It's not looking too good. Where's the 21st? There we go. It carries on moving up. We get the indecision again, and then we start getting some negativity. Now we're getting no momentum here. The price, it's not really moving. Very small candlesticks. Just it's tried to get through a couple of times, and on the third one it does actually go, and that's later on in the day. So it's after these peaks. The peak on the pound is really the euro separation what actually got this going, perhaps that announcement, but the price was falling. The point is that we were looking for this downward move, and that's what we're looking for. If it did go against us and it started going long for whatever reason, then we wouldn't, our risk would be controlled, because we would just be down behind the 200 there. What I'd like to show you next, though, is a chart that you wouldn't actually take these trades, but I just sort of put this on anyway, just to show you how the relationship between the sentiment forecast and price. These are normal candlesticks, different indicators down here at the bottom. But we're just really looking at the price. The only one I would be interested in this fourth, I would perhaps look at that technically, because we're moving into the just above the EMAs, and we get the cross here. So I might be looking for this bounce off the 8, probably 21 actually. I've changed the colours on these EMAs. The yellow line is probably 21 on this. In fact, it is. So I might be looking for that bounce against that, because we've got this big move in the euro. The Japanese yen is showing some positivity there, but it's a good strong move from negative territory into positive territory on the sentiment forecast on those events. However, as you can see, we get this crossover where we get strength coming into the yen. Number one here, we get strength in the yen and weakness in the euro, and we get the euro Japanese yen pair just dropping a little bit. Then we get quite a big drop in the yen, so that lets the euro move upwards. I'm not saying it does. This is how it works in my head. You know, this is how I look at these charts. And then we get another crossover here, where we get more strength in the yen, so we get our drop, and then we're looking for the euro to increase, which it does on the Thursday. What was I going to say? The
Ken,
can't remember.
I'm here.
Yes.
We've just run over our time, unfortunately. Do you think we could
Have
wrap
we
it up?
not? Yes, we can, certainly. Sorry.
I'm sorry to I know you're in the middle of talking. It's hard to think of you, but
I am
if
in the
you
middle
could
of it.
just
Right.
wrap it up maybe in a couple of minutes, that would be great.
That's fine. I will do that, Simon, no problem. Now, we've got this separation. This is a new chart. Our trend this time is the pound yen, and we've got a separation from zero here. We've got the pound rising out of the volatility level and a little drop in the yen, and we get a nice rise here. We get the flatness over the squiggly part, but these two peaks in the pound I would notice on the currency sentiment forecast, and we get another crossover to the other direction, and on this you would be able to pick up this trade at this consolidation point here on the price. Andrew, it's quickly back to you then. Oh, can you pop him in?
Okay, yes, we can do that. Just
I'll move the slides. If you leave the screen on me, I'll move the slides in.
oh, sorry, no, we've gone back to Andrew.
That's fine.
Okay, so just wrapping up quickly, Andrew, if you can.
I don't know where he is. Am I still in?
You're still here. Yeah.
Oh, I'm still here, right. Okay, we'll just leave this both.
I think you've got me now.
Yeah.
Just very quickly to say, whether you choose to come to us and find out more, or whether you choose to use an economics calendar, knowing the data allows you to know the markets and lowers your risk parameters, and that's the most important thing. As you can see from this slide, there are 3 ways to do that, but overall, knowing the data lowers your risk, ups your profit, and can be done for just 15 minutes every morning, and will vastly increase the stability of your trading. And that's really it from us. So all I can say is thank you for listening, and I will hand back to you, Simon.
Thank you very much, guys. Dr. Andrew and Kenneth Stanion from the House of Trading. I'm sorry, it was a rushed presentation. I only gave you half an hour.
Yeah, well, we were called in at the last moment. So.
We were indeed, and I appreciate you coming in and doing that. I know you're coming down to speak at the live show as well, a week on Saturday, yes, which will be great. So I look forward to meeting you there, and hopefully we can have you on the webinar again with more notice. So I'll take the presenter. I'll put the website is in the chat box for anybody that's interested in finding out more about the House of Trading. Just go to their website, thehouseoftrading.com, and you can get all the information and get in touch there. So thank you very much, and without further ado, we are going to go straight across to our next speaker, who has been patiently waiting.
Our apologies for that.
The market sniper, and let's just go straight across now and bring Francis in to the event. We will invite him to share his screen, and the microphone should be coming off in a second or two. Great. Okay, we can see the contract futures chart. Francis, hello, it's Simon.
Yes, hi, good day, and welcome to the House of the Market Sniper. Yeah, thank you. Lovely to be back with Round the Clock Trader and having a catch up with you all. How are you doing, Simon?
Lovely to have you here, and my apologies for eating into the first 5 minutes of your presentation. We've squeezed an extra session in there, and it's been a busy day so far. We've had some technical problems earlier on in the day, which has sort of knocked us back slightly. So sorry to keep you waiting there. We're all fine. Getting excited about the live show in London in 10 days' time, and I know you're coming down for that as well, which is going to be great. So lots of people who can get to London for that on the 5th of November are making the trip, which is great. So we'll all be there in person. But for the moment, let's have a look at what's going on. And the Hunt volatility funnel working well?
It is indeed, yes, it is indeed, and it's put us into a few interesting situations which are very current and live at the moment, Simon. So welcome to all your attendees, and I certainly hope that they'll come and introduce themselves and just say hi and chat about the markets, regardless whether they whether they're interested in my particular approach or not. I'm just delighted to engage with traders. I enjoy serving traders. I am a trader myself. I trade for my own account. I'm more trader than marketeer thereof, but I enjoy the interaction and I enjoy the teaching and mentoring, which is why I'm also in that space. And of course, it's more predictable than trading outcomes, which are by definition pretty unpredictable. I believe we had our standard strapline of becoming the 9% versus the 91%. So I'm going to talk a little bit along those lines, while also at the same time keeping it current and running you through some very interesting events. But while doing that, I also just want to cap how this particular approach has and can put you into not only everyday short time frame and medium time frame opportunities, but can in fact put you into the primary themes that span multiple years. So just to recap, and I'm work on the basis there may be some people that have never come across me. In fact, there may be many people, most of you might not have. And so I will just mention that the Euro Swiss franc, both short calls in 2009 and for the floor to fail were made using HVF theory. The big theme that was July 2014 and ran for the better part of 2 years of oil being a big sell-off was another HVF theme. That was our structure. We recognized that this double top and pullback was the beginning of some serious resistance. We also knew from our super macro charting that we'd had only one other previous high, that was the 07s into the chronic subprime crash that saw probably the biggest and quickest and most abrupt bear market ever to take place in oil, when it fell from the better part of 130s, 140s all the way down to the mid-30s. Which was only to be superseded by this particular crash. For those that can't see from the PowerPoint slide, that is actually the 104 level where we were already scenario casting. That's not quite a forecast. We were saying this was one of the scenarios we believe would take place, and we were getting ready to take shorts on our 3 low. This little pattern is part thereof of the HVF theory and how it's drawn. And many of you will know that the rest of that was history in the making. As you can see, this triggered. It was a very consistent and very stable sell-off, and of what we describe as a fast-moving breakout. And the comfort in that is where your stops are tight. They weren't so tight here. They would have been on the other side of the red line if it shorted here. So there was still a reasonable distance away, but the comfortable aspect of our particular style of trading is that when you're accurate, the market moves strongly and consistently in your favor and away from the stops. So we get in on those key moments when you can justify tight stops. In other words, a volatility is pinching. Most people, stops are actually the enemy. Yes, you heard me say that. It sounds like a sacrilegious thing to say, stops are the enemy. Well, what tends to happen is your stops are too tight for the average range of the day. So you are then inverse scalping negative losses, or rather, let me say negative profits, in fact losses. And that is what many people are doing, because stop placement in of itself needs to be technically deduced, and it needs to require the market to come and run a key level of significance for you to be inaccurate. And that art of stop placement requires a certain setup, and we combine patterns. So here was a later continuation pattern. One of our big themes that we always say is you trade continuation. Things generally continue rather than reverse. This was oil again, a whole bunch later. The values here are in and around the 50s. We had a similar setup again. So within the macro cycle of being net short oil, you could have traded shorter time frame and gone in aggressively. By this time, you would have been very, very confident because you've been short from $104. And we'll have a pretty cozy P&L as a count of that particular trade. It had overperformance in it, and we do that for our first patterns. So that's a little bit of detail that you'd probably need to learn on a separate event to this. But here we go, trading it shorter on a shorter time frame. So that was a weekly chart. The bigger ones I'm showing you, this is a 4-hourly, and then we were getting in short again here and running it down as it made its progress to the downside targets again. So you can actually have multiple winners, and this is the value of doing your super macro analysis. So this was the whole move, top left all the way, and I'm afraid to say I've put a bottom tag every time the major commentators came out and said that's it for oil and from here we rally. And there was, every time there was this kind of price action, we had CNBC, we had Bloomberg, we had lots of people that should know better, Reuters, various analysts saying bottom, bottom, bottom. In other words, the sell-off was challenging people's belief systems. And instead of trading that which you see, people were being stumped by their belief systems. You think, damn, if it was 103, surely now it's a buy at 60. It can't go lower. Well, it actually traded 27, which is even lower than this point over here. So that little setup that we showed you here, comfortably made target, ran its first interim, little rally back to the funnel as it sometimes does, then a very consistent move all the way to target. This is spanning from July 14, this was occurring December 15, 18 months of trading, potential continuation on the oil market was a great game. Now, bringing it a little bit more current, a couple of things we did recently. Of course, the pound has been catching the headlines with many of you, so I'm jumping around. This particular strategy, totally market agnostic. In other words, it's effective. It is actually a strategy that is based on the volatility setups and pattern setups of a underlying market. So it can be applied to foreign exchange in the same way as it's applied to shares, equities, your futures and your commodities, which I'm sure I've covered every potential market in that category and probably a few overlaps. So there was our Brexit exit, which vote which came in here and smashed the pound. And then we had a little low at 128, a little rally up to 143. We were already scenario casting continuation coming for us in this because we were once again getting our DNA, our primary founding low, a rally to that extent for a high one, a higher low, yet a squeezing high, and this was, we're waiting for a third impulse for this to materialize to give us the view that we were ready for our next leg down. So this was a scenario cost. I'm using a draw tool that is part of the bundled items of goods that comes with my trading metamorphosis program, and it can be purchased separately. It runs on an MT4, that particular tool. So what happened, we're also going to have a look at the GBP JPY. Why are we doing that? Jumping around like that, because we're looking at the pound across other markets. So one of the other aspects of what I always suggest you learn and becoming that 9% is you need 360-degree visibility. People are too quick to take the trade. Trade isn't something you should be jumping into every morning because your computer's just booted up and this is what you're doing from home. It needs to be something that's far more research put in the beforehand, and then you lay out your plan in advance of the price action. If you choose to react, the lowest common denominator of that net response is the emotional responses, and they are usually incorrect. So you then become subject to fear and greed. If you submit to a process and you say, this is what we're doing regardless what the market throws at us, we will get that sized loss that is acceptable. It's 1-2% of our account equity, for example. Then you write the check for every trade in your mind, you place it on the spike, and in concept you're in and you stand too. And this was the GBP JPY just as an alternative, and we were showing you how it was breaking down as well. Oh, my apologies. It wasn't the GBP JPY. We're looking at the USD still. So I'm getting my labels incorrect. We do have a yen chart as well against the pound. Why did we do that? Because we wanted to ascertain that the DNA, this whole price pattern setup, is specific to the pound's weakness. So if it's doing a similar draw against the dollar as it was doing against the yen, therefore the DNA of the draw is the pound weakness. And of course, in both instances, there's this major move down, which was the referendum, and then the subsequent continuation pattern with the pinching highs and lows. And as I say, we look for the third. So this was part of the move. We had already broken, and we were already short in this market before what was alleged as a fat finger crash occurred. Remember, this occurred on the day of non-farm. Yes, it was nighttime, 11 o'clock, but it was morning in Japan, in the Asian session, so 2300 hours, Thursday evening here in the UK, morning session in the Japanese market, which is not going to be well defended on the pound. Very thin trade before one of the biggest data releases of the month. So that's a perfect time to ambush the pound, and ambush, I believe it was. It was not a fat finger in my view. So there you go, and that was on a shorter time frame exactly how it played out, and there's your huge tail spike with your target run. And you might have by being short have got positive slippage on that, depending on your broker and his liquidity. In other words, if it gapped really quickly, being one of the only buyers of pounds in an environment where the bid has disappeared, you often get an exceedingly good fill because everyone is stampeding to sell. And most of you, I certainly remember my first 10 years of experience was always moaning about my broker slipping me and being a victim. Broadly speaking, most of this is now done by a computer. Yes, there's HFT. Yes, there's people skimming a little bit here and there. But if you are being the 9%, you are the rare buyer in a market when everyone is the seller. And if you are being the 9%, you're the rare seller when everyone else is a buyer. And that usually means exceptionally good fills and liquidity, especially if your order is already predetermined and in the system and on the broker server. It didn't require you to be awake at 11 o'clock at night on a Thursday evening, just when there may have been a great Champions League football match or something else going on. So I'm also focused very much by the lifestyle training. I'm not interested in 14-hour days in front of 9 screens, 3x3, frying my eyeballs. It doesn't impress me as a lifestyle. I like to go away. I like to have holidays. I like to be free. I like to pursue kite surfing. I like to spend time talking to the clients. So I can, when I'm hunting for action, trade on the shorter time frames, but generally I'm on the 4-hour upwards daily and weekly and super macro trades. And when I'm really getting one right, I can then milk it and drop down and go deeper into the trades that are continuing really well, and then look for shorter time frame continuations. So let's talk about a little bit about the Euro USD. This was where we were highlighting that there was a pinch, and we pointed out that this was the lowest volatility and smallest range that we'd seen the Euro USD trade in for ages. I highlighted this on a YouTube clip at the time and said I suspect we're going to squeeze and we're going to fall to the downside, and I actually managed to capture the weekly chart as that happened. So for me, in terms of probability of view on the Euro USD, this entire period from 2015, which captures this Q1 low, the Q4 secondary low, and the highs in between, taking you into 16, is all one setup continuation pattern. So that means on balance of probabilities, I have a predisposed view until such time as a key level is run in the opposite direction that we are going to have a parity run. Yes, you're hearing it here. I'm telling you parity run on balance of probabilities. Do I know that for sure? Absolutely I don't. And if the price action changes to a certain degree, I will even be able to tell you at what level I invalidate that and say that is no longer the probability outcome. But for where we are and what we're expecting, this flat bottom little super squeeze here was the beginning of a downside move. We'd suggested, because this was very flat bottomed, we have a little bit of HVF in here as well on a shorter time frame. I'll drop down a time frame to show you. So we said at this point in juncture, this particular squeeze is probably going to break down, and it's going to represent a decent move which is likely to run the previous low. So we've had a lower high here, and we were expecting a lower low on this move. That would have to have come past this point, and I still think that there's scope for it, even though it's rallying a little bit now. It's sold quite a bit. You never go down in a perfectly straight line every time for further downside to occur after this little rally is occurring. So there's your squeeze. It's all about volatility. Let's have a look at that area again in a shorter time frame so that you can appreciate it. There you go. There's the flat bottom. There's the deeper squeeze across the tops. So it's already indicating to you which way it's going to roll. We were all over this and watching it, and there was the confirmatory break. So you can wait in confirmation. We said the 110 will be surrendered. It'll be another key level that'll have to be allowed to go as part of that, and then this level here for a new low. So we've now feigned through that level, and we'll go to the live markets now, because it's all great showing you things historically. The whole value of being a very good trader and going from being a very good trader to being an outstanding trader is to build the notion of being a price behavior futurist. What's going to happen next? At the moment, we haven't touched on that. So I'm just going to escape the PowerPoint and leave that for a bit. Let's go straight to the live markets and stick our neck out. So yeah, for those of you that was the oil we were starting on, but I'm actually going to go straight to, this is a little of a quicker platform to jump through the FX charts on, so I'll use this for now. There's that break, there's those cells. This is a pretty weak rally so far. This isn't a bad candle, but when you look at that, they were beaten back here. This is what we call a feign and break on a larger setup. So we have this as our low 3. So we could have just triggered a far larger setup, which would have a target of 98. That's it. There's your parity run right in there. We will chop and churn quite a bit then. That's why these are clustered quite close. The open areas is often where you make your best progress in between interims. If you want to know more about how do we get those interims, it's in the geometry of the pattern, but you'll learn more about that if you wanted to take it further. However, there we go. There's our little downside. There's our squeeze, and that's what's given already people a better part of 300 or 400 pips from being short from the 112 levels down to the sub 19 levels at one point. But that will pull back a little bit, and we're not concerned. So where would the stop be on this minor setup? It's your third high, which is somewhere over here. If I draw it with a free hand, I would even have to drop a time frame to get you the full perspective on that. And it'd be that. I think that little wick is slightly higher. That would be the stop on that. And the short was the takeout of that level over there on the short time frame setup. So this allows you to trade the same idea across multiple time frames. Why? Because the pattern repeats. The tightness of the volatility is the game. It is the clue. And on a super macro weekly level, going back to the weekly, you can see that we have a congestion and we're failing to make higher highs and we're failing to make lower lows, and we're trading deeper in a tighter range. So there is at a macro level a squeeze, and then you get a squeeze within a squeeze, as you just recently had to set up that down leg. Very powerful because the fast move. The amazing thing about volatility-based trading, there's a couple of very powerful points for it. It dissipates slowly, so you can observe it in its dissipating, and that the range is indeed tightening. But when it returns with a sudden and violent bang. That means if you are accurate and the market takes you in, because we talk about pending orders, waiting, at the key point, which would imply that the market is now in an expansionary state now, it's no longer tightening, that you get taken in and your stops and your targets get made instantly live after that pending event. So if you happen to be incorrect and it moves in the opposite direction and your trade is never triggered, there is no loss. So had this broken to the upside, your pending order to the downside would not have been triggered. So that also allows a great deal of forgiveness. If for those of you that trade options, of course, the expansion in the volatility, it makes the option more valuable, as well as the fact that you're moving into the money in terms of your strike price's relative position to where the market is. So you get a double whammy of bonus on that. But you don't need to be option traders to enjoy a fast moving breakout trade in your direction. So that's a little bit on the Euro USD. Another way, many of us battle to see downside setups, and it's hard to short. So the great thing about this is that the Danish kroner is very similar and very tightly correlated to the Euro USD, because it is very much like Switzerland, landlocked to the European zone. And this is literally the upside version of what you've just been looking at. The upside version of what you've just been looking at. That's right. So here you go, and that's what we would expect for the Danish kroner. Look at this nice impulsive break, a similar squeeze here. I've done a little bit of analysis on the shorter time frames. That's that mess in there, but you can see a proper breakout candle, strong belt hold day, one of the biggest candles that you've had for, and this is a weekly chart, in absolute weeks. The last time you had a chart, so a candle that big, was probably there, and it had a huge wick on it, which means it was beaten back. Probably the last properly big candle was that big sell-off there that engulfs it. So this is a significant candle, and it was followed through upon, and that high point of this expansive day is now run. So it's clear to us we're now expanding out of this. Look at that super tight range as an absolute gift that something was coming, and it allows you to get your stops real tight. In fact, if this is the big patterns stop loss, but you could in fact, with this price behavior, get tighter still within that. That just improves your risk reward. This draw tool is telling you that you've got a 2.3 risk reward. That's with your stop right down here at the red level and only getting long at the green level, holding till the purple level. Had you got the takeout over here with a stop down here, you've split your funnel into about a quarter, and you can multiply that by 4, which means you can also trade 4 times bigger for the same loss. So we talk about early and advanced. Being early is critical in the trading, and also advanced techniques that allow you to boost your risk to reward. So when you are right, you want to be damn right, or when you are accurate, a better choice of words, because right and wrong has a little bit too much ego attached to it. But when you're accurate, be really strongly accurate. We can see from this price behavior that there's been a bit of a flaw under here. Look at this price reaction, popping over it, coming back, sitting on it. This is a key level of significance. Trading through it, support, support, hammers, 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 bottom wicks, support. This is not going through that level. There is a level here, and we're taking our time, gathering our breath before going further up. It's amazing, this, because once you build the technical view with a fairly high probability, you can then retrospectively work backwards the opposite way that everybody else thinks, and that's what you need to do when you want to become the 9% of the 91%. What is the fundamental news going to be that's going to be driving this? Because believe you me, things are going to be going down for a move of this nature, and a parity run is politically, well, it's politically going to be exceedingly interesting. It's going to get all sorts of people talking about the euro, and I wonder what will drive it. So you can speculate at will, but the difference is you trade it now, you get the news article later. By the time it's in the newspaper, it's in the bag as far as the trade is concerned, and only the dumb money is arriving. Do not be the late arrival responding to the news flow out the mainstream financial media. That is too late, she cried. It's perfect for being scalped and being hammered. So that is the take. You need to be early. So just for fun, let's have a look at the Euro GBP, because this involves many of you. A lot of you are going to be UK based here. Many of you might have European homes, family members, etc., that have interests on the European side. Clearly, initially, all the damage was of not all, but most of the damage was of a GBP nature. This is very much in the structure of what I'd call a very steep rising wedge. I draw them with an access point like that splits them down the middle. It's kind of a unique way of doing it, and I believe there's a very good reason for that, but too much to get into over here. But you can see how this is formed, and often with rising wedges you get a melt up out the top before you go down. So there's a squeeze inherent in here as well. So there is a bit of a volatility squeeze, and then you get an exhaustive push up. I do not believe this spells particularly well for the euro either. So I think while the pound has had to wear a lot of the losses up front, I think there's going to be a turn, certainly a time and a turn for the euro where it will be doing far more wearing. Whether that's all about Brexit, or whether it'll be the Italian markets, debts, etc. We can speculate at lib on the story. Truth is, I will have no better idea than you, but I'll be as interested as you to find out when it all starts going down. That's the value of looking at the markets on both sides of the coin. There isn't a technical analysis versus fundamental analysis. There is one coin and there's two sides, and the both definitely move hand in hand together. The difference is I don't expect to be told anything before anybody else in the market, and I take any news as already baked into the market as a standard default position. And I advise most retail traders, unless you have father-in-law's Carney, to have a similar view. Treat everything else as a ramp and misinformation to misdirect you into a certain line of thinking. Sorry if that sounds cynical, but I prefer the charts and the footprints in the sand as to where people are going rather than the narratives. So that's the take. So a little bit of fun for you on the Euro GBP. What I'd like to talk to you about, though, a great opportunity as well, potentially. We did last year, was it last year? Was it 15, actually? I'm losing track of time. I think it was 15. We ran about October. Yes, in fact, it was the crash. It was the crash of 15, and it came early. It came in August. I don't know if you remember. We had a crash in 14 September. So let's pull up the indices instead of talking about crashes and showing everyone an FX chart. Let's look at the indices. This will jog ailing minds. So here we go. That was the August push down, and this, of course, was the January beginning the year sell-off, which we did predict in December, and we said it will be on China news as well, and that did transpire, and there was inverted HVF structure for it. In other words, the the footprints in the sand gave us that, nothing else. We do not have unique information on Chinese data relative to anybody else, and I actually doubt that many people do. So that's our take. Those were big moves. That was, let's just zoom in because we're losing a little bit of detail. So this particular sell-off, we got a 62.5 risk reward on the USD JPY. That's probably the biggest I've ever achieved. In fact, I know it is the biggest that's ever been achieved. Now, that can get you a bit of a quantum leap in your account. That is not what I'm trying to put forward to you as a daily occurrence or a regular occurrence. And in actual fact, overperformance can bring problems of its own. And one of the best things you can do is take a big chunk of any proceeds that come out that land in your trading account as a result of a massive overperformance like that, and place it in your savings and investments plan, which you should have. In other words, I've done a YouTube series. Go Google it if you like, or write it down on a pen and paper while you are here. DeMartini, the market sniper, and he has absolutely nothing to do with trading, but he has everything to do with values, and he says one thing really interesting. Any fluctuation in your wealth that is larger than 10% becomes emotional, and you will take outlying risks if you get a gift that is beyond that, and you will go into defensive, defeatist mentality if it's to the downside to you. People who are worth, say, $1 million can make £100,000 and not go absolutely dilly. They're not going to buy a liner and a brand new home, etc., if they hadn't already done that when they were worth £1 million. And if they drop to 900,000, they're not quite yet ready to hang themselves about it. Swings of larger than that, and it becomes emotional. So whenever you get an overperformance win, one of the best things you can do is to trim your account down, because otherwise you'll say, ha, I've got fat on this body now, I can afford to take outlandish risks. And instead of taking better risks, you just cut to the chase and you shortcut your usual processes, and you end up giving large parts of that money back. And if you oversize or get a bit giddy, you can actually do even more damage. So that is a mentality, a self-awareness, and an emotional management process, and my traders get that problem. I don't know if you get that problem. I would like to give you that problem, but I would also say it takes some managing too. I have a tweet that went out and a clip that said we were £165,000 profit made in 5 days, and was one of the worst things that happened to me. And you can watch that clip as to why I lost my head and the damage that did for me, and the approach and how I changed. But anyway, we're talking about indices, we're talking about crashes, and then we got a little bit sidetracked. So here we go. Big sell-off there, big sell-off there. For me, squeezing and wedging upwards. We also know we have the lovely news, and I only trade the charts, but you can't help but wondering. We've got an election on November the 8th, and hasn't that been an absolute puppet show for the peasants, with two stuffy candidates and a whole bunch of stuffy old narrative, and I told you, and she's this, and I'm that. Wow, I can't get over that story. I can't even take it seriously. Anyway, so what's the DNA that we're getting on the indices? So I'll come back to that NASDAQ. Here's the Dow. Here's the Dow. Sell-off here. By the way, little head and shoulders, first of all. We've drawn that there for you. Little head and shoulders. There's your neckline. You take the nearest round number. We don't do angle necklines. We'll teach you how to really use a head and shoulders correctly, not the traditional technical analysis way. Key levels of significance are horizontal lines. The round number is the key. Options and derivatives dictate this, and you should never bother with an angled line on a head and shoulders. But anyway, I'll get into that in far more detail and far more reasons than that which you just heard. But that's just a quick hit you up. And so that should have been your target, and that would have been nicely taken to the downside. Then a grinding, note the lows here, grinding up move, strong sell-off to the downside. In fact, I think I did an illustration of this on one of my webinars just the other night. So I still have the chart here. There you go. Head and shoulders. Note how hard you fall and in how short a time. Note how long it takes to grind and chop, how hard you fall in such a short time, grind and chop. What are we waiting for? More grind and chop, and then a third proper step down. Then we will have DNA structure like this. So those would be your highs. I do them in white. We're waiting a final third high. And these would be your exhaustive lows, which I'm going to do in red for you so that you know that these are that we are in fact bearish here, and that this could have been a trend-changing event sell-off, and that we're winding up. Now, why is this interesting? Because it doesn't seem like a huge move. Well, the first inverted, and we call this an inverted HVF. In other words, you've come out of a major impulsive sell-off, which is showing some degree of resistance at these levels, and you have not been able to regain and hold those levels. That is showing some degree of exhaustive aspects to this market. So here you have, let's just draw, and I'm just going to make a right scribble mess of this because I don't want to lose any of you. Here and here, and then you're going to get a high of some sort. It may already be in, and it could be that one, but let's say we go a little bit higher a little bit later, and then we will look for that third high. And we get overperformance. That's why I was mentioning the USD JPY and took you on that song and dance and cared to mention it all. It wasn't entirely, it wasn't boasting. It's just that it's relevant. It's this time of the year that the markets tend to get a bit creaky. In this case, don't forget, we've got a two-termer president coming to an end. Boy, does stuff only get cleaned out during the end of two terms. Go check your history on the back of this. This could be a unique moment. Note how we're the sniper. We want to be there when the key action is coming, when the pinch is coming, and when the big moments happen. So there's a lot that could be coming together for you and could open you up to potentially trading a very, very good trade. Now, if I just go super quick and show you how it panned out to the blog, last time we had this set of circumstances. We were the big crash here, and I think I came onto Simon's program around about this time, the anatomy of a crash, and this captures the catch-up of this. If you want to read these blogs, they're there for you, by the way, themarketsniper.com, go to the blog. Here we go. There's the DNA setup. That was the US market, major outperformance to the downside. This was the FTSE, by the way, similar DNA, already dribbling down, much like we are now out of a head and shoulders. Rally, second impulse, third very tight impulse, overperformance, and then we had the USD JPY. This was our setup here, and this is where we got that 62.5. I've done a whole medley of charts in here just for fun, but you can look at these individually far easier in the blog post. There it was, tightening. We sold there with between 8 and 10 pips, and we took over 600 on overperformance there. That was how that pattern looked after that spill. The fear was back in town. We closed on the overperformance bands, teach you how that works if you're interested in doing the education on that side. So there you go. Go have a look at that as a resource if you like. Go also to Demartini, the Market Sniper, for very interesting values alignment for wealth building. So coming back to those indices, on the US indices, I think it's interesting. Now, I will say this, it's a very dangerous thing to do because indices generally grind their way upwards most of the time, and most short callers who are effectively calling reversal on super macro trends, and generally we don't do that, and we tend to stay away from that. Nonetheless, when you do get that HVF DNA, and it could be a first in a new trend, you can go really, really far. And last time we capitulated, there was, so the reason I'm going on to the long term, that's not the best chart. So let's do it on the Saxo platform. I prefer it for the long term stuff. We will get you the S&P, and there it is. This is the S&P 500, and there you can see the draw. Now, if you go on to the really bigger time frames, when you get these right, they can pay and pay and pay. So these are the kind of moves you get. There were inverted HVFs in both of these. In other words, markets halving. 1500 to 750 in that case, 1500 to 750 in that case again. And overperformance bands that'll take you out pretty close to the lows without being the absolute low. So very, very powerful, very, very powerful. Could we be at a time where that is in play? Note also that this last rise up that we've had two collapses from, once and twice, has been at this level here, 21441. There's a lot of resistance. We've got above it, so let's just zoom in so that you can see that now. Show them what you want to show them, Francis. Don't hide. There you go. So you can see we've been resisted there, and we broke with impulsive, no follow through, and drifting. It could be a hanging man, could be a hammer, but unlikely to be a hammer like near a low. It's not in this situation. This has been clear-cut support. So what is happening? We're getting a squeeze here, boy, oh boy, it's going to be interesting. And you've got elections, as far as I'm concerned, only downside to come out of that. So who knows? But that's a little bit of a bearish view, I have to say. And we have seen a divergence out of the US markets to most of the others. Add to that, you've had dollar strength recently at some scale. So remind you on that. Here's the dollar versus the Chinese currency, and this will give you perspective on where the Chinese market is going, which then ties into the copper market, which we were a big bear on, which has a similar squeeze setup, and we're seeing the Chinese currency leaking value to the dollar quite steeply, and it's even hitting the news wires in a number of places. And then you see a HVF, inverted HVF setup on the copper market. What are they trying to do? I think China all is still not well, and they put the genie back in the bottle in the beginning of this year. So we're getting a final little rally here. So lots of trade ideas. You can see through HVF theory how they all tie into each other, how you develop a macro understanding of the global flow of money, the macro understanding of a global flow of money via charts. So you are reverse integrating, not what they say, but watching what they are doing. What their footprints in the sand, it's called God's handwriting on the wall. They can't hide the money flows that run through the market. Just so that if you're wondering, is such a bear euro, I wonder why he keeps going on about it. The euro is bearish across a number of currencies and in big time frame setups. So this is the Singapore dollar, which, as you'll understand, is quite unrelated specifically to the pound. So that is in a setup, and it's even, you know, against emerging market currencies like the rand, it's even in a setup. So I do believe that's going to be weak. Right, I wanted to leave a little bit of time for questions, and I wanted to leave an offer to you. So given that Simon has got the speakers back to back, and I know it was a push and a shove, I would rather have 5 extra minutes at the end than run 5 minutes into somebody else's speaking time. This is an option that is available for you if you're interested. Whoopsie, I didn't mean to go right back to the beginning of that. Silly boy. He should learn how to use PowerPoint one day, shouldn't I? It's been around and long enough, hasn't it? So I've got a trading day. I've got more than a trading day. I've got a trading program that is kicking off that'll take you to the end of the year. I'm doing a light version of my flagship product, the Trading Metamorphosis program. It's usually 6 months. It costs a better part of £5,500, but you guys are coming up to Christmas. You've got kids that need feeding. So in actual fact, there's a 1495, and run it right the way through till the end of the year, basically to 1st of January of the this year. So you can be part of that. You will get access to everything. So that'll include our base camp if you're interested, which I haven't shown you, but this is where we talk privately. Some of the charts are in here. We do our coaching in there. All trading days that we do, and there'll be at least 2. You'll get the draw tool bundled up in that, which is worth £497. And you will get Theory Weekend, which is everything I know and do with HVF theory, and then reinforced during your period in Basecamp, where you'll get our trading ideas and you'll be able to follow everything we do in regards to that. There are, in fact, 40 projects, so we do equities, we do commodities and everything in here, and it's a beautiful virtual private environment for us all to interact. We're all trying to do the same thing. Anyway, I don't want to be too heavy on the sell here. Questions from you guys, please send them through. If you want me to analyze various markets for you or give you a view, fire away. These are all the particulars of this. I will load this up on slideshare.net. Post this or pass it on to Simon should anyone wish to participate in that. The Theory Weekend is 19th and 20th November, and you would get on board immediately following payment. So you would begin to make use of the Traders Vault, where there is 35 hours of primer materials to get you up to shape. Who wants to know or has a favorite share that they would like me to analyze for them?
Thanks, Francis. Yeah, what is the link for the pages where you have about the value, the pack you were just talking about?
Yeah, I'll pop it up on slideshare.net, Simon. I'm probably going to have to do that just after the presentation. I spotted 1 or 2 dates I'd mistyped there, so I'm going to make a minor correction. So I'll pop the link in the chat to you post this event. If you can share it with the gentleman, and I'll also post it on slideshare.net and tweet it out. So at the Market Sniper is the Twitter profile, the Market Sniper, okay. And the YouTube channel for the other stuff.
Yeah, we'll email that link with the follow-up email that was sent to everybody.
Brilliant.
Okay, there's a few questions been coming in while you've been speaking. Jeff was at HBF theory, well, it's HV for Victor F theory, of course, the Hunt volatility funnel, which you've just been describing. And Wayne is commenting that you are bearish of US equities and indices. Is that a fair comment?
Yeah, it's to say that we're coming up. There's a scenario cast position where I see there is a higher risk of a major downside move. What can happen is exactly the opposite. So when we're inaccurate, we're 180 degrees inaccurate, there is a squeeze. Quite clearly there's a squeeze building. So if we just go back to the indices, I was going to show you a few shares that are setting up, but let's just show you those indices again. In fact, it's quicker again, as I say, on the MT4. Whenever you get a squeeze, you always get a very brisk move. A very brisk move. In terms of the structure of the squeeze that we're seeing here, on balance of probabilities, it's a downside one. So yes, in a simple answer, he is accurate, but that doesn't mean that if for some reason it couldn't squeeze up. But I would say that's the 30% scenario. The 10% does nothing, and the 60% is down. And the positive part about the down bit is because of where it's occurring, and there's not a big trend before it. It's the first major setup in a new trend, is that you get overperformance. So it's a bit of a unique. It's like a special case. It's like the A star. If you get it right, you get plenty of juice on it. So there's a bit. It sounds like I'm qualifying a bit, and I am. But yes, he's largely right. That there's an opportunity here for potential bearishness where it could be really worth your while.
Okay. Okay.
We've got a couple of equities that I'll show the guys that are setting up. If there's no further questions, I've got a few ideas that people can write. I know people like a couple of things to stalk. Unless you...
Okay. Well, we've just got a few questions here.
Let's go through.
Well, it's a request for looking at the Aussie dollar, US dollar, and then the Aussie dollar versus the Canadian dollar. And Ripple is saying, do you look at the yield curve to get a view for currency moves?
It's an interesting question on that. Let's go through the order that they came out. So let's start with the Aussie dollar if we can, and then we'll come back to yield curve. So it's interesting that the Aussie has come up as a question because in my view that there is a nasty little grind line under this. We've had grind lines before and they've continued to break in the direction downwards. Then we had quite a strong rally. It seems this level here for the Australian, and let's just put a number on it rather than saying this level, we're all the sevens, 778, 7780 is a strong selling point. Selling wicks here, we return moved, two shooting stars. So let's zoom in a bit so everyone can see. Two shooting stars, a third shooting star, a weak attempt again, shooting star. Coming back up, long wicks at the top here. We've had a spinning top, and now we're getting selling dojis. This for me points to a break. This is a very steep buy line. We call it a steep buy line. That shows that a lot of the buyers are knocking themselves out, coming up underneath the price action of this. So that can lead to exhaustion, and we expect a grind line to be broken. There's clearly quite a strong lid on this, and it's squeezed down marginally as well. So this is interesting in that he's stumbled on, maybe by intent, and well done to the questioner if he's watching this, but he has stumbled on something we see as a slightly untypical inverted HVF with potential for downside. So we're biasing to short here, and we could even take early entries on the takeout of the lows. You could use a tactical entry here if you wanted to reduce your risk and boost your reward. So the risk reward currently standing at about 3. You would look at a tactical entry on the takeout of the lows of the spinning tops. Sorry, it's sucked onto that line, so it's a bit annoying. It's trying to do my thinking for me. I just want a flat line, and I want it to be under that spinning top and those hammers. So once it's run the low there, that could be a nice trigger early, because you've got the grind line that will probably be breaking, and then you get your confirmation sell short of your third low on that. So there's a lot of confirmation that will happen here. So I'm a little bit bearish the Aussie. is the quick answer, and there is DNA structure. I think you also had Aussie CAD thrown your way.
That's right.
So let's take a flyby there. And the value of this, apart from just being bearish, is that you should at some point in that trade have a fast move away from stops. That is the value of trading with volatility on your side. In other words, it's more emotionally comfortable. So get a nice white background on that. Zoom it in. And what is the time frame that the questioner was interested in with regards to the Aussie CAD? Because broadly, if there's no time frame, we have to do a full macro top down. Those are your sort of, for this data pool, extreme highs and lows. So we tend to cuff and collar a trade and know whether we're near the extreme highs or lows. If he's looking at, say,
he's trading a 4-hourly chart.
4-hourly on that. So you had a bit of a flat bottom triangle, a descending triangle that actually popped out the top return move and then has come up. So if we drop down to, we'll go through the time frames right the way down to the 4-hourly. Just by the way, on that weekly, that's becoming a bit of a shooting star, and as you know, we're quite close to the end of the week. So it's not a charge in long on the bigger time frames, most certainly. So you start hardening these views up on the bigger time frames. As we go through the daily, there was a bit of a continuation pullback there that pushed a little bit higher. That's a bearish engulfing, which ties in with the shooting star just across on a different time frame. So you had a little bit of a falling wedge structure there that gave you the squeeze and gave you that little extra spurt up. It's a little bit of nothing for me. I would say it's been more the Canadians' way, but that's looking like it's exhausting and that you could ease in the downside. So I wouldn't be putting fresh longs at this place, and I would probably be backing off longs, although on the bigger time frames the longs have largely been the side to be on. So it's no clear trade for me, but expecting more pullbacks short and medium term, but on the bigger time frames the bias to long has been the right side to be on. So no action if you aren't yet already in this market. Possible profit taking if you were long. And then there was another question around the yields. If you can just rephrase it now, because it seems like a while ago.
Do you look at the yield curve to get a view for currency moves?
Yeah, so am I charting the yield curve and regularly looking at it? I look at the bond instruments, the government bond instruments, that's called gilts here in the UK, and the T-bills occasionally. I wouldn't say I'm exceedingly regular, but I certainly watch that. But I don't find necessarily that those are highly indicative. I agree with the idea of looking at 4 new markets to get a more 360-degree view. I find looking at other pairs or other half pairs. So if you're looking at the dollar for a strength case, looking at it across a multiple of other pairs, the pound, the euro, the JPY, I find that degree of intramarket analysis more useful than looking at the debt instruments and their respective yields. So no is probably the right answer, but the concept of looking for other guidance is a good one. So yes, also looking for other asset classes. For example, when copper was falling in a contained descent, we were of the view long before many others that the Chinese currency was actually going to have to start reversing its strength to the dollar and going up, because clearly there were signs of the building ending and the demand for one of the most important building materials ending. So that's a peculiar example of how what doesn't sound like a big market to you became an early indicator of potential weakness. And it was the same thing with copper falling with the Aussie, because what trickled through to affect the Chinese currency would affect the Australian. So for example, we had the Australian dollar versus the New Zealand dollar, which are both nothing to do now with any of the other majors. They won't carry any of the Brexit weakness or the dollar strength. And when you have that Aussie versus the New Zealand, you could see that the Aussie New Zealand had got to, and I'll just show this as an example because it's quite an interesting question that was asked. We were up top here, and we recognized that China tapped out as the grower of last resort. So from 08, 09, all the way along here, the Australian dollar was getting stronger, and we had an inverted setup here. And we were at near all-time extremes, as you can see, against the New Zealand dollar. And New Zealand's a pretty decently run country, you know, in terms of its debt management and everything. In fact, better than Australia in terms of the property bubble and all of those aspects. And that oil smashed down and that commodity smashed down, all tied in with the Australian dollar being sold down from one extreme to the other. Now count that in pips and you will appreciate that you could have traded it, if you're a currency trader, that exceedingly well, which is one of the reasons why people who say to me, I'm only a currency trader, don't show me any other chart. You're missing out on other information. If you're trying to look into the room, don't just peep through the keyhole. There's another window and there's another prism through which you can look through where you get information. You should take it. So from 1.3 to almost parity, 1.05, you could have caught, and it was very strongly, largely down, down, down. So there's an example of how a counterintuitive market gave you a great insight into a very thorough and brutal sell-off. Look at these candles, huge amount of pips. This is a monthly chart, massive amounts taken out all the way down. And I think that's our time. So for those of you, I'll pass the details on this over to you, Simon. I hope you've enjoyed it. Whatever that happened, I'm really looking forward to being at the show. I've enjoyed chatting with you today. Simon, thank you again for the opportunity, and look forward to presenting on the 7th, isn't it?
The 5th, actually.
5th.
It's Saturday, the 5th, and remember the 5th of November, because it's Round the Clock Trader live in London. So we've got Saturday the 5th. Yeah, we've got about 30 speakers, and you know, I'm delighted the support from the speakers and from delegates as well. Of course, we've got about 700 people who signed up, going to make the trip and come down, because there's so much going on throughout the day. We've got a program of events which is huge. Five theatres going on throughout the day, as well as some of the companies exhibiting. Folk like your friends, Peter at Pelican Exchange. I know you're a fan of the Pelican app. So the Peter and his brother will be there in the room, telling people about the app and things like that. So it's going to be a fantastic day.
Great venue as well. I'm really looking forward to it.
I'm glad you're coming as well. Francis Hunt, as always, a pleasure. Thank you very much for joining us. And I'll take the presenter role back from you now, and we're going to go on and speak to Ulrico Bracci from Yard Charts. So thanks, Francis. There we go. So if I go back to my screen, that gives us just about a minute until 3 o'clock comes up. So thank you for joining us, everybody. This is the Round the Clock Trader webinar. I know a lot of you might have just been joining us in the last hour. You've been listening to Francis Hunt from the Market Sniper, and we still have a fantastic selection of live webinars coming up today, starting with Zaheer Anwari at 3 p.m. I'm getting ahead of myself, and following Zaheer, we will have Ulrico Bracci at 4 p.m. From Yard Charts. So let's, without further ado, let's just go straight across to Zaheer now and bring him into the webinar. Let's see if he can hear me okay. Hi, Zaheer, I've taken the microphone off. Can you hear me okay?
Good afternoon, Simon.
Good afternoon. How are you?
Very good, thank you. Yourself?
Great, thank you. Yes, we've had a great day so far. Lots of some new speakers joining us, which is always good. Of course, delighted to have you joining us again. We met at Lisa's London Investor Show a couple of weeks ago, which was good.
Yes.
And you're a slightly longer term trend trader.
Correct. Yes.
I think it's a good message. We see the good news today, of course. Then the GDP figures come out better than expected.
Correct. Yes.
It's not all doom and gloom post Brexit. But does this make you think that really the economists trying to forecast these figures they seem to be getting a reputation for getting it wrong quite a lot? So
Yeah.
it'd be better just to be following the trend. I think that would be something that you would appeal to.
Yeah, I think the more you try and keep up to date with what's happening in the economy and in the news, and then try and relate that to what's happening in the markets, it tends to be quite a difficult way of trading. I know I found that quite difficult, particularly when I was working. So when I was in employment, keeping up to date with all the news and then trying to see what's happening minute to minute or hour to hour in the news alongside my job, it was just a very time-consuming, stressful approach to the market. So when I stepped back, started focusing on the bigger picture and really just ignoring the news, more having more of an approach that, well, we're outside the institutions, we're outside the hedge funds. They get the news well before us. So by the time we hear it, the private trader, it's already been factored into the market. So by having that approach and saying, well, let the market makers do what they need to do with the news. Once they've established a direction in the market, I'll then jump in. So it's a far simpler approach.
Well, Zaheer, let's go across to you now. We're just into this past the 3 o'clock. So share the screens as we do and ensure that everybody can hear and see. As I said, this morning was a little ropey. We had a few upsets. My PC crashed, which is probably the one that we don't want. But thankfully, everybody managed to log back in. And then we've had a few internet issues as we've gone, but it all seems to have settled down now.
Good.
I'm looking at your screen, the dynamictrader.com.
Great.
And I can hear. Can I ask everybody at home just to confirm that you're also hearing Zaheer as well as seeing his screen? Great, Lee, Dozie and Hamid, thanks very much. Okay, I think we're all systems go. So let's pass. I'll pass the floor to you, Zaheer, and again we'll take questions at the end.
Yes, brilliant.
Wonderful. Over to you.
Fantastic. All right. Hi, guys. Welcome to the webinar. First of all, huge thank you to Simon, as always, for having this amazing platform where I can share the knowledge that I've accumulated over the last 10 years and really try and get the message of trend trading out to you guys, which I'm assuming you're all private traders of sorts. So I hope that this message really relates to you. So just to give you a very brief background of myself, I started trading in 2007, and one of the main reasons I started trading was I was fed up of always having to compromise in any career choice that I had chosen. So I've got a degree in software engineering. I graduated from City University here in London, and I then worked for a year with Oracle. I'm sure some of you guys or all of you guys may be familiar with a company called Oracle Corporation. So I was working as an engineer for Oracle, and to be honest with you, it was not the best experience. Now, one thing that I've learned, and I hope you guys probably relate to this, is that when you're working in a 9-to-5 job, first of all, it doesn't end up being 9 to 5, it ends up being a lot longer, but you have to enjoy what you're doing, because that is pretty much the bulk of your week. If you don't enjoy what you're doing, you have to be strong enough to make decisions to walk away. So within the first year of me working for Oracle, I realized this is not for me. I had the potential of making good money, but I just didn't enjoy what I was doing. I then became a TEFL teacher. I think some of you guys are probably familiar with the word TEFL, teaching English as a foreign language. I then lived out in Asia for a couple of years, teaching English, which was lots of fun. Amazing place, lovely place to live and travel, but there's no money in teaching. So sacrificing money for enjoyment. I then came back to London and I became a photographer, because photography was always my passion. I ended up creating a collective. There was 3 of us, and we were doing amazing work. Barcelona Football Club were our clients, Vogue, Tatler, Audi, Coca-Cola. We did some amazing campaigns. Very, very good money, but the hours are horrendously long. Photography is not all fun and games. It's 15, 16 hours a day and sometimes 7 days a week. So when I cast my mind back, we're always sacrificing. If it's not your passion, it's your time. If it's not your time, it's your money. Something's always being sacrificed. So that is where I then looked to trading. I really wanted to start leveraging the money and the savings that I'd had in place, and I was very lucky to find my mentors very early on in my journey, because I know a lot of people go on to blow accounts and lose huge sums of money in the early stages. But I found my mentors very, very early on, and they were able to guide me onto the correct path. Now, one thing that they showed me was trend trading, and that really appealed to me because I was a photographer. I needed a style of trading that could be adapted around my photography. But most crucially, guys, and this is what's really important, without compromising on profit. A lot of people turn to day trading because of the appeal of quick riches. You're in and out of the markets and you're making money. And this is how Forex trading is really advertised, as a way of quick money. But A, I didn't have the time to do that. And B, I didn't have the inclination to be glued to my screen all day looking at charts. It didn't appeal to me. And that's why trend trading was really appealing, because it would adapt around what I was doing in minutes a day, but crucially through compounding. And this is something that a lot of people really don't appreciate because they don't experience it. The growth that one can achieve from compounding is far greater than the growth that you can achieve than being in and out of trades every day. Multiple trades. You'll have winning trades, you'll have losing trades. It doesn't really get anywhere. You've got to look at the people that have achieved success, i.e. Warren Buffett, George Soros, Jim Rogers. If you go back further, people like the Turtle Traders, Jesse Livermore. You look at these guys, they all embraced compound growth, and that's how they are able to, or they were able to, achieve such staggering amounts of money and wealth over the duration of their lifetime. Okay, and that's the message that I want to get across today, guys, is think long term. And the title of today's presentation is how to best improve your risk to reward. So what we want to do is keep our risk small, have our risk capped, our losses capped, but we want to have uncapped reward. Why do people blow accounts? Because it's the other way around. People have capped returns, but their risk is uncapped. Their losses are uncapped, and that's how you end up blowing accounts. So we want to reverse that psychology. Okay, so what do we want to go through today? So what are we covering? So these are the points that I'd like to cover today. How to manage a large watch list. Point number 1. Point number 2, how to use time frames to establish trends. Point number 3, how to use support and resistance. Number 4, how to use moving averages. Next point is how to build an edge in the markets. Now this is really important, guys, because if you can't define your edge, then you don't have one. An edge is an environment where you have entered into the market, where you have more chance of making money than losing money. You must have an edge because we're playing on probabilities. If you can't define your edge, you don't have one. And if you don't have an edge, you'll be eaten by someone who does. Okay, so we want to make sure that at any point in the market, you have a very clear edge. And if you don't have an edge, or if your edge hasn't presented itself, then the next point is how to apply patience in your trading, because patience is ultimately a crucial skill that one must learn to develop and understand if they are to see consistent growth. We are programmed to make money on a salary basis. And so when people come to trading, they bring that mentality to trading, whereas in trading, money is made in periods. You make money for several months and then you may not make money. In the periods where you're not making any money, you've got to be patient and allow for these opportunities to come to you. So these are the points that I want to cover today, how to build an edge and how to apply patience to allow that edge to appear. But the next point is how to look for breakouts for a trend continuation. So once you have the edge, you still need a good entry point. So we're going to focus on breakouts in this presentation. I know a lot of the times people focus on pullbacks, but pullbacks aren't the way forward, and I'll explain why as we go through the presentation. The best way forward is to wait for breakout. Next is how to apply risk to reward. So once we've got all of this, how can we apply risk to reward to our trading to make sure that we are taking the maximum profits out of the market? And this doesn't have to be greed, guys. A lot of the times I hear people saying, oh, I just want one-to-one reward, or I'm happy with £100 a week because I don't want to be greedy. The foreign exchange market has got $5 trillion in there, traded every day. You extract $1 million out of that market, you're not greedy. You've done something correct, okay? And that is through good risk management and understanding what you're doing. So get away from the idea that you're being greedy by holding onto positions and extracting as much as the market's wanting to give to you. And finally, we'll go through some of the trades that I'm currently in and looking at. Okay, so let's go to my software. So the software that I use is eSignal, okay? I would recommend you guys all look into eSignal. It's a very, very good software, and it's probably the best charting package in the industry. Now, I'm not affiliated to eSignal, guys, so I'm not selling this on behalf of them. I'm recommending eSignal because it is simply the best software in the business. Okay, so what we have here is my watch list. Now, the first point I want you to take on board here, guys, is that it's an extensive watch list. So I've got the Aussie dollar, US dollar at the top, and it goes all the way down to the South African rand, Japanese yen at the bottom. Okay, an extensive watch list is crucial. If you just focus on one instrument like the euro dollar or gold or something that you feel like you have some kind of attachment with, you're not going to be in the best position to take advantage of the best opportunities. Money moves from one currency to another currency, or from one group of currencies rather to another group of currencies. Money moves, and then it moves from one market to another market, which is why I don't trade just foreign exchange. I trade US stocks, I trade UK stocks, I trade commodities, because when the foreign exchange market is in consolidation, where has the money gone? And we'll go through some stocks that I'm in as well, so that you guys can see how the application of technical analysis and trading can be applied to the stock market and the commodities market. A chart is a chart. So you want to identify where the money is. Where is the liquidity? Where are the market makers? You want to identify where they are, and you want to then go to that market. Okay, so we're going to focus on foreign exchange in this presentation. Now, it's very easy to be able to manage a big portfolio because at any moment in time, a select group of currencies are in trend. You don't just have random currencies in trend. Select groups of currencies will be in trend. At the moment, as you guys are probably all very aware, the trends, and these are bearish trends, are on the pound currencies. So my focus as a trend trader is on the pound currencies. All other currencies are in consolidation or are not worth trading. And we're going to see why this is. So how do I identify where the money is? So let's move on to the next point. The next point is looking at the time frames. Top right, I have the monthly time frame. Bottom left, I have the weekly time frame. Bottom right, I have the daily time frame. So I have the monthly, the weekly, and the daily time frame. The monthly is where I look for support and resistance and overall market structure. And the weekly and the daily is where I look for trend direction. This is where I start looking for my bias. This is where I start looking for my edge. So I want the weekly and the daily to be moving in the same direction. So let's start with the monthly time frame. So I'm just going to open up the monthly time frame, and I'm going to bring up these pink lines. I'm just going to simplify them for now. Okay, so what do these pink lines represent? The pink lines represent the previous high, the previous low of the previous calendar year. So that's January to December 2015. This is the high and the low of the previous calendar year. So that is the highest point that price reached in 2015, and that is the lowest point that price reached in 2015. What we can see price is currently doing is trading inside this range. And any currency that is trading inside this range, I'm not interested in. This is where I stand aside. What I want is what I want to see is price trading outside of this range. So any currency that's trading above the high has a bullish bias, and I'm looking for long opportunities. Any currency that is trading below the low of last year has a bearish bias, and I'm looking for shorting opportunities. So this is now where I'm starting to develop my edge, guys. I know I'm going to be jumping around a bit between those topics, but you guys now should start creating bullet points. And this is my first bullet point where I'm looking to develop my edge. Where is current price action in relation to last year's levels, the high and the low? So if we have a look at the euro dollar, for example, we all know that the euro dollar is the most heavily traded currency. But what I would like to add to that is, if the euro dollar is the most heavily traded currency and most private traders fail, what does that tell you about always trading the euro dollar? Okay, there's obviously a better way forward than just constantly focusing on day trading and scalping the euro dollar. And if we go back to the logic which I've just described, we can see that price is very much in an area of consolidation, and it's inside the annual levels of last year. And so for that reason, I'm not interested. Okay, we've had a lot of weakness this month, and there's been a lot of noise in social media. Wow, the euro dollar is weakening. But it doesn't matter what the euro dollar is doing because it's within consolidation. And for as long as it remains inside this period of consolidation, you want to stand aside. Now, why is it in consolidation? Well, prior to that, we were in a one-year trend. This is where I extracted a lot of profit from the euro dollar. I extracted over 15,500 pips on this particular trend over a 9-month period. After every trend, the market consolidates. This is a natural feature to the market. So this is where the money was for in 2014, 2015. Since then, I've not traded this because the market's been in consolidation. So where is the money? Well, if we look at a currency like the pound, Japanese yen, a currency which I've been short on for a very long time, you can see that price is trading below the low of 2015. Price has a bearish bias. If we look at the euro pound, we can see that price is trading above the high of 2015, so price has a bullish bias. And this is where patience comes in, waiting for price to move out of these pink lines and then going in the direction that the market is dictating. When one currency is inside the pink lines, you can see that another currency is outside of the pink lines. So this is why actually, guys, it's very easy to manage a big watch list. We can do this together right now. If I start on the Aussie dollar, US dollar, you can see it's inside the pink lines. I'm not interested in trading this. Now, if the Aussie dollar, US dollar, which is the base currency of, if you like, which is the main currency of all the Aussie currencies, then you'll see that most Aussie currencies will be inside the pink lines. Aussie dollar, Canadian dollar, still inside the pink lines. Aussie dollar, Swiss franc, inside the pink lines. Aussie dollar, New Zealand dollar, inside the pink lines. Aussie dollar, Japanese yen is not inside the pink lines. It's below the pink lines. Why? Because all the yen currencies are trading below the pink lines. So here is the CAD Japanese yen, below the pink line. Swiss franc Japanese yen, below the pink line. So you can see that by using the annual levels, we can very easily know what is on the watch list and then what isn't on the watch list. All other currencies are not on my watch list apart from the pound currencies and some of the yen currencies, and for the reason I've just shown. Okay. Now, the next point I want to bring up is the major levels of support and resistance. So you can see now that I've got a tool that highlights major levels of support and resistance. Now, what is the logic behind these levels of support and resistance? Very simple. Is a high bar which has a minimum of 10 bars. I'm not going to draw them all on either side. Okay, so a minimum of 10 bars on either side. So if you've got a high bar with a minimum of 10 bars on either side, this will act as a level of resistance. And if you've got a low bar with a minimum of 10 bars on either side, then this will act as a level of support. So the software will automatically highlight levels of support and levels of resistance. Now, one thing to note, guys, is this. We as private traders are lucky in the sense that we do not have to follow government rules and regulations. We have a lawless environment ultimately where we are the creators of our own rules. But that is where a lot of private traders fall short because we are in a lawless environment and we don't have rules and regulations to follow. We are then left to be able to create our own rules. And first of all, most private traders are not very good at making their own rules. And secondly, they're not very good at following their own rules. And that's where private traders then end up with frustration, losses, stress, blown accounts. And I'm no different, guys. When I started trading in 2007, I was quite smart, and I think I'm quite unique in this approach in the sense that I'm actually a very, very, very lazy individual. I don't want to try and figure things out on my own. I don't have the mental patience, if you like, to try and figure out things on my own. I'm always looking for teachers. I'm always looking for people to show me and guide me. And if that means I have to pay them for their services, I have no problems. So when I started trading in 2007, I wanted rules that worked. I wanted strategies that worked because I didn't have the time to try and figure this all out. And that's where the knowledge that my mentors parted with me really resonated with me, because it just made sense. Okay, so what you guys need to do is start bringing rules to your trading. I've given you a rule, guys, right here, your support and resistance. Now this is on the monthly time frame. A lot of people ask me, can you do this on the weekly? Can you do this on the daily? It's on the monthly for a reason, and that's because it works on the monthly. If you take it down to a weekly and a daily and a 4 hour, 1 hour, it's not going to work as well because you've got a lot more noise, a lot more candlesticks. Support and resistance work best on the monthly charts because we get a very clear picture of where price is going, where it's reversing, looking at the past, what price structure is doing. Very powerful on the monthly time frame. You start going lower down, they don't act as well. Okay, so those are the levels of support and resistance. The pink lines represent the annual levels of 2015 with the previous calendar year. Once 2017 starts, the software will automatically change for the high and the low of 2016. Software does that all for me. Beyond these levels, I then look at round numbers. So if we look at this particular currency, which is the euro dollar, let me just change my color. Let's go for purple. We can see here that we have round numbers: 1, 0.9, 1.1, 1.2, 1.3. The distance between round numbers, guys, is 1,000 pips. And this is very, very useful when risk to reward comes in, because I don't, when we look at risk to reward, most private traders will have some kind of idea of what they want their risk to reward to be. 1 to 1, 1 to 2. Now, crucially, the mistake that people are making here is that your returns are capped. And we know there's an expression which is the trend is your friend until the bend at the end. So why would you want to cap your returns? Would you be happy with 1 to 2 if the market is giving you 1 to 10? So we want to keep our reward uncapped. We want to keep our risk capped, so we always lose small. We don't want to have downtimes of 10 or 20 or 30%. That doesn't exist. In my trading life, that doesn't exist. Yeah, I have losses, I have down periods, but they're small, 2, 3, 4%, not 10, 20, 30%. But my returns are far bigger. Far, far bigger than what I initially risk, and that is because I allow my winning trades to run and I compound. Sorry about my writing, guys, but I'm using a mouse. So what I'm looking for is round numbers. So once price breaks through this support level, I'm looking for price to move towards 1, then 0.9, then 0.8. Okay, these are levels. Now, let's look at the history of this particular chart, and you can see for yourself how significant round numbers are. If we look at this high point, 1.6 round number. If you look at these 2 points here, 1.5 round number. If you look at this point here, 1.4 round number. If you look at this whole support zone, 1.2 round number. If you look at where price is consolidating, 1.1 round number. Think of it this way. If you are jogging, very rarely would you jog and stop at 11.3 kilometers. Once you go beyond 11 kilometers and you're feeling good, you're going to target 12 kilometers. Then you're going to target 13, 14. As we're always, as human beings, psychologically, we're always looking for whole numbers. It's the same thing with price. Price has natural features to it, and it's always looking to move towards round numbers. Look at the lowest point on the chart, 0.8. round number. And we can look at multiple charts and they will all have the same feature, just a different way of representing round numbers. Now let's go to the pound dollar. The pound dollar, if we look at the monthly time frame, look at where it reversed to the downside. If we look to the right hand side, 1.7 round number. If you look at this floor here, 1.5 round number. If you look at this floor here, 1.4 round number. If you look at where price is right now, it's at 1.2, which is a round number. If you look at the news over the last few weeks and months or years, as price has been weakening, we always hear the same thing, which is that the pound is weakening. It's at 1.6 it's going to bounce and go back up. Yeah, well, it went to 1.5. We hear the same thing. Then what tends to happen is that at 1.5, there's a bit of a correction. So we then start seeing a lot of excitement in the use. The pound is rallying. Yeah, but the overall trend is bearish. There is some kind of correction. Look at where the correction came in. Look at where this failed. 1.6, round number. We then had a move to the downside, came to 1.4. Look at what happened at 1.4. A bit of a bounce towards 1.5. I move back down. Look at the move. Boom. Big move towards 1.3 and then 1.2. This is where the risk to reward comes in. Once you're in a trade, look at the round numbers, because that is where price is going to move towards. Now, the challenge with trading, and this is where a lot of traders go wrong, is accepting that the market doesn't move in a straight line. I've been short on the pound dollar since 1.4. And you can see now that we're at 1.2. So I've held positions for 2,000 pips. But if you look at what happened here, the market went into consolidation. So my short position, which was in profit, I just had to hold before the next round. Now, this is the thing. Look at where we are. Here, there's an area of consolidation. Why is there an area of consolidation? Look at the months, guys. July, August. June, July, August. Summer months. In summer, the markets go quiet. This is a natural feature because people are on holiday. That includes the market makers. Everyone's on holiday. Then in September, when the market makers are back, look at what we've had. We've had a round of trend. Now, the thing is, when the markets are in trend, we can't expect them to continuously shoot. Look at little periods where it goes into little sideways movement. This is nothing more than a breather. What I'm now looking for is the next breakout to the downside, which we're going to come to in a second. I hope you guys are absorbing what I'm saying here. You have to start embracing natural features to price. Round numbers. Price moving towards round numbers is a natural feature. Price not moving in a straight line is a natural feature. Price going quiet during some times in the year and then bang, breaking out into trend at some times of the year. These are natural features. You have to get away from thinking that it's a 9 to 5. It isn't. You won't make money every single day, and your results, guys, should tell you that. I'm assuming that everyone is on these webinars to look for a better way of trading, to understand how to trade, to improve your trading, to get better results. So you're watching these amazing webinars so that you get an idea of what you can do better. As a private trader, you should look to another private trader who's already learned how to trade. That's one thing that resonated with my mentor. My mentor is an engineer. He hasn't got a background in economics or worked for some hedge fund. He's an engineer that got trading working from him based on his mentoring. All the best traders, all the best successes throughout history, regardless of what industry you're in, always have mentors. The reason for having good mentoring is that you have feedback. If you don't have constructive criticism and constructive feedback on anything that you do, how are you going to improve? So I always take self-taught traders with a pinch of salt. Okay, because I don't believe that self-taught traders are necessarily had the feedback for them to then be as in a position to pass on that information. Okay, and this comes from experience. You don't have to agree with me, but after being in the industry for 10 years, this comes from experience. Okay, let's move on. Now, the next thing I want to talk about is moving averages, weekly and the daily. The way to look at this is that the weekly is little brother, the weekly chart is big brother and the daily is little brother. What I want is the weekly and the daily to be moving in the same direction. So I want little brother to be following big brother. How do we do this? The answer is to use the 200 simple moving average and the 50 simple moving average on the weekly and the 200 simple moving average and the 50 simple moving average on the daily. Okay, so we're now looking at moving averages. What I'm looking for is price to be below both moving averages in a bear trend on the weekly and the daily, or I want to see price trading above both moving averages in a bull trend. Okay, so we can see, looking at the euro pound, we're above the pink lines. So we have a bullish bias on the monthly chart. We're above the 200 moving average and the 50 moving average on the weekly, and we're above the 200 moving average and the 50 moving average on the daily. So we have alignment. So let me just clear this to the left-hand side. Let me just bring up a pen again. Okay, so what have we looked at? We've looked at the monthly chart. Sorry, this is going to be a little bit messy. Weekly chart, the reason is because I am using the mouse. I normally have a tablet that I write on, but I don't have it with me today. So the monthly chart is where we look at I'll just say the pink lines for now, which are those annual levels, the high and the low of the previous calendar year. We then look at major pivots. So the major pivots are the high bar or the low bar with 10 bars on either side, minimum of 10 bars on either side. And then we also look at round numbers. The distance between round numbers is 1,000 pips. Weekly, I'm looking at the 200 SMA and I'm looking at the 50 SMA. Daily, I'm looking at the 200 SMA. Sorry guys, bad writing, 50 SMA. Now this is what I literally want to do, guys. I want to be able to look at a chart and go tick, 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 tick. If I have all of these ticks, I take the trade. If one of these is missing, I don't take the trade. If you want to be aggressive and you have a good setup, then you can reduce your risk. My risk is never more than 2%. So if I reduce my risk, it would be 1% or 0.5%. But what I'm looking for is my criteria to be met. Guys, this is what I would say is an edge in the market. Okay? This is what, these aren't all my factors. There are other things that I look at, but this is ultimately the spine of what I look for when it comes to my analysis. This is the spine of my criteria. This is the spine of my edge. If I don't have this criteria met, I don't have an edge, I don't take the trade. Okay, I know this is being recorded, so if I'm moving a little bit too quickly, then you will have the recording made available to you. I know Simon's really quick with getting those recordings out. Okay, so now let's focus on the euro pound just because it is open. Okay, so we can see that the euro pound is bullish. Now, if you look at what's happening with the euro pound, we had this move to the upside and we've had a correction back down again. And if we look, we've got this level acting as resistance, which comes from this pivot here. Okay, there's an offset. So if you look to the left, that is the pivot that is coming from. Okay, and we can see that round number 0.9. This is acting as a level of resistance. Now, this is not an environment to be going short, and this is where a lot of people go wrong. When price gets to resistance, they want to go short. When price comes to support, they want to go long. The overall direction of the market is bullish, and that is the direction that you want to be going in. The trend is your friend until the bend at the end. Simon, is that you coming in?
It is, Zaheer. I think probably I'll just stop you for a second or two.
Sure.
A few questions coming. George has got a few questions here. And just before we get too far on, just going back a few minutes, he says, does this mean that there is only one profit-taking level during a year at round numbers?
Profit-taking levels, no, but the thing is, I don't take profit. I use trailing stop losses. But I can see, I get the idea of what George is talking about. What George is saying is that is there only a certain period in time where you close your positions and take profit? I'm assuming that's what George is saying. And the answer is you don't want to take profit until the market has exhausted giving you profit. And this is where people need to re-educate themselves, because ultimately when people come to trading, they focus on the money because they have an idea of what they want to do with that money. So they may have rent to pay, they may have food to pay, they may have bills to pay. And so what they want is a certain amount of money that can then pay for something that requires paying, and maybe they're not having to go to work. I'm not saying that this is necessarily George's, I think it was George, the gentleman, George's thought process, but this is part of the thought process. And I know that from conversations with traders who are not getting the results that they want because they've got an idea and they want to make that money. But for me, trading is not about making money, it's about making growth. Why would I want to settle on 1,000 pips when I could make 3, 4, 5, 6,000 pips through compounding and holding my positions? So you have to rethink your approach and your strategy to why you are trading. If you're looking for a certain amount of money, then this is not the way forward. But if you're looking for long-term compounded growth, which will ultimately allow you to walk away from the system, then this is for you. You've got to question what it is you want from trading.
Okay, what about the 2% rise that you mentioned? Does this 2% rise when you compound?
The 2% rise, you mean the 2% that I allocate? Is that
HB? Can you maybe expand? Okay, we'll come back to that.
Yes, please. Yes, please.
How have you done back testing with your strategy? How long did it take?
I've back tested, and when I started back testing in 2007, it doesn't take that long when you know what you're doing. So, but the other thing is, you know, when you look at all the best investors and traders, and you understand that trend trading is the way the best people have made money, you don't need to be spending hours back testing. There's the best way to make money is put it into action and make it work. And so if you have a strategy that's working for the person that's teaching you, then you've just got to put it into practice. So I don't necessarily believe that you have to be back testing for hours at a time. And there is software that can help you with the back testing, and within eSignal there is software that can speed up the process.
Okay. HB's come back to say he risks 2% of his capital on a trade. Does this rise when he compounds his positions, or is it a total of 2% with compounding?
Oh, okay, I see what you're saying. Yeah, I think I understand what you're saying. Whenever I compound, I eliminate my risk on previous positions. So if let's say for example the euro pound, I've got one position running on the euro pound. When I get an opportunity to compound, I eliminate the risk on my first position, so I'm only risking 2% a time on any one trend.
Okay.
Now that doesn't necessarily mean that I don't have a max risk exposure. I'm happy to risk 6, 8, 10% depending on my personal stomach, if you like, to what I'm happy to risk. But on any one particular trend, I will only be risking 2%. But I could have another 2% on the pound dollar, another 2% on the dollar yen, so that's 6% potentially.
Okay. Final question for the moment. How do you set your trailing stops? How many pips do you set it at?
Yeah, that's the magic answer. Trading stop losses require an understanding of what the unique instrument that you are trading, and ultimately it's a really good question because it's the stops that determine how much money you make. I can't personally share what my individual stop losses are, but I can give you an idea of how to look at stop losses. So let's take the euro dollar. The euro dollar has an ATR of around 90 pips. Let's say 90 pips. ATR, if you're unfamiliar, is average true range. The euro dollar has an average true range of 90 pips a day. Let's say on average it moves 90 pips a day. If you compare that to the pound Japanese yen, the pound Japanese yen has an average true range of around 220 pips a day. So if you're using a stop loss of 100 pips on the euro dollar, you possibly be fine. If you're using a stop loss of 100 pips on the pound Japanese yen, then you have a very good chance of being stopped out. So what I would say is look at the average true range of the currency or stock that you're looking at and use that to guide you in how you calculate your stop losses. Again, guys, this is my point. It's a good question. That's not what I wanted to figure out. I just wanted the answer, which is why I look for mentoring. You can, of course, figure it out, and that's where the ATR comes in.
Thank you very much, says Hamid.
You're welcome.
Just one final question, maybe, and then we can move on. So take this final question for the moment, and then we can do some more of the presentation. Gabriella is asking, when you talk about compounding, do you add further positions?
Yes, spot on.
To your original trade?
Mm-hmm. Yes.
Okay. Yeah,
good. It's a really good question, Gabriella, and great to. I'm assuming it's a lady, so great to see a woman on the presentation. Definitely should be more women involved in trading. And the answer is yes. So when I'm in a winning position, let's say, for example, Apple, if I have a trade running on Apple and that initial trade starts returning me a profit, so my initial 2% risk is now 4, 6, 8% in profit. So instead of me going and buying Twitter or Yahoo, I might as well just keep on buying more of Apple because it's a proven stock. Warren Buffett, he says only amateurs massively diversify their portfolio. All you need is 1 or 2 trending instruments and repeatedly compounding. That is how you achieve growth, not through euro dollar one day, dollar yen the next day, pound Aussie the next day. It's not how it's done.
Yeah, good advice. Good advice. Okay, Zaheer, let's carry on, and we'll address the other questions. We're just about 18 minutes away from the hour, so we've got a little bit more time to play with. Thank you.
Fantastic. Thank you. Okay. So, I've lost my train of thought. Where shall we pick things up from? Okay, so let's have a quick review of what we talked about. So if we look at the euro pound, we're above the pink lines on the monthly time frame. So we have a bullish bias. We're above the weekly 200 and the weekly 50. So we have a bullish bias on the weekly chart. We are above the daily 200 and we're above the daily 50. So we have a bullish bias. So we're bullish on the monthly, we're bullish on the weekly, we're bullish on the daily. Right, we have alignment. Now what we need to start thinking about is, where is current price action in relation to support and resistance? So this is the next point. Now that we've established an overall bullish bias, the questions that need to be asked are this. Where is price, I'm not going to write it all out, but where is price in relation to support and resistance? Where am I going to enter based on a breakout? And then crucially, what is my risk to reward likely to be based on round numbers? These are the 3 questions. And then, of course, what you need to understand is things like, what is your stop loss going to be? Where is your risk management? What is your risk management? How are you going to move your trailing stop losses? All of these things, guys, need to be thought out before you execute a trade. Why do so many people blow accounts? So many people blow accounts because all they focus on are entry points and the money. That's all people care about, is getting into the market and making money. And that is why people blow accounts, because you have no emphasis on capital protection. As a trader, as a full-time trader, my emphasis is always on my downside, because I don't know what the upside is going to be. I don't know how far the market is going to trend. Now, I do understand trends, and I do understand that patterns repeat, and I do understand round numbers, and I have the experience to understand that I don't need to be right to make money. If I'm wrong, I have my stop losses and I get out. All I care about is making consistent profit. And so once I'm in a winning trend, I repeatedly compound. You want to get away from wanting to be right, and you want to think in terms of making profit. You want to get away from winners and losers, and you want to think in terms of profit and loss. You want to think of it as a business, and the way to think of it as a business is to protect your downside, not think of the upside. Okay, you can have visions and goals, but to say that you want to make 100% in a certain period is pretty much impossible, because you don't know what the market is going to do. So you need to think of all of these things before you enter. So given that we have an overall bias, where is support and resistance? When am I going to enter based on a breakout? What is my potential risk to reward likely to be? And then once I'm looking to enter, where am I going to enter? How am I placing my initial stop loss? What is my risk going to be? And how am I going to trail? And also, how am I going to compound? These are all questions that need to be answered. Okay, so looking at the euro pound, if I was to go long on this, I would need to see the high. If you look at the daily chart, the breakout is when price breaks and closes above this level. This is what we would call a breakout, because this is the highest point of the trend. Now, unfortunately, we had that flash crash incident before NFP, and that's created this overextended wick rather. And so, you know, it's annoying and it's frustrating, but that's part and parcel of trading. Ideally, we would have liked this point here to be the highest point. It isn't, because a break and a close above here would have offered us an entry into the market. But luck has it that this is now the highest point of this trend. And so we now have to wait until we get a break and a close above this level of resistance. Guys, remember, break and close at the end of the day, not intraday. Just because on a 1 hour time frame it's closed above here doesn't mean that it's going to close above there at the end of the day. This is where patience comes in. This is where trading psychology comes in. Wait for the market to dictate a close and then place your entry and your stop loss. Once you're in the trade, where is price likely to move towards? Well, we've got the figure 1 up here. And if you look at where the market is, you've got 200, 400, 600. You've got 600 odd pips towards the figure 1. You do have this resistance level, which is in proximity. But let's just focus on the figure 1, the round number. You've got 600 pips. That is a pretty good risk to reward. So let's say if you are risking 200 pips based on the fact that the currency has an ATR of 100 pips and you want to have a 200 pip stop loss, you've got a potential of 3 to 1 return. Now, this is the important point, guys. You don't want to take your profit here. This is where you use your trailing stop loss, because if the market breaks through 1, then you've got 1.1. So that's another 1,000 pips. So you've then gone 1,600 pips. So your initial 200 pip is now targeting 1,600 pips. If it breaks 1.1 and goes towards 1.2, that's 2,600 pips. This is where the risk to reward comes in. And this is where the compounding comes in, because when you have multiple positions, a trend of around 2,000 pips or 3,000 pips can equate to 10 to 15,000 pips. I can tell you this from experience. So let's have a look at the pound dollar, which is the opposite way around. So the opposite way in terms of it being bearish. We are below all of these major levels. We can see current price action is below all of these major levels, which are all acting as resistance. We're below the pink lines, so we have a bearish bias. If I compress the chart, how far could this continue? Well, look at the 1985 low, which is at around the figure 1. So this could trend. This could, as a trend trader, I know I'm based in the UK and Simon's based in the UK and some of you guys are based in the UK, and the pound weakening is not great for us, but as a trend trader, this is what I want. I want the pound to weaken because it's in a bearish trend, and the more it weakens, the more profit I'm going to extract from the positions that I have in play. If I look at the weekly chart, below the weekly 200, below the weekly 50, so we have a bearish bias. Look at how it's acting as resistance. If you look at the daily chart, below the daily 200, below the 50, we have a bearish bias. Now the same thing as with the euro pound, we have a low right here. Once this low is cleared, we can then look for short positions. Now let's have a look. Let's cast our mind back to Tuesday. On Tuesday, the pound dollar fell 100 pips. You can see it fell 100 pips and then intraday reversed. This is a good example of where you don't want to get caught up in intraday movement. But if you look at the bigger picture, it's stuck in a range. So if you look before that, trend. Now it's in a consolidation. This is not the end of the trend. This is what price does naturally. What we now is weakness. A break and a close below this pivot support, and we will also clear 1.2 round number. If it clears 1.2 round number, then where will price go towards? We've got 1.1. And then if it clears 1.1, the figure 1. So potentially another 2,000 pips. I have, just so you guys are aware, I have 2 positions running on the pound Aussie dollar, 1 on the pound yen and 1 on the pound dollar, I believe. I believe I have 4 or 5 positions running. I can't remember exactly. 4 or 5 compound positions running. These have been running since around June, July times, and my current positions are now running at almost 6,000 pips. So I've got 5 trades and these positions are running at 6,000 pips. And this is not the end. I have my trailing stop losses in play, which are protecting my profit. But a break and a close below here, I'll add further positions and this will then accelerate the profit phase further. So this is where patience for the breakout comes in. And then once we get the breakout, we've got our risk to reward. So let's look at this. Monthly chart. Just grabbing a pen, guys, if you bear with me. Okay, so monthly chart, we're below the pink lines. Weekly chart, we're below both moving averages. Daily chart, we're below both moving averages. What are we waiting for? Well, we're waiting for a breakout. So we don't have the breakout, so we stand aside. Once we have the breakout, what is my risk to reward? Well, I have a very good risk to reward, because potentially if this clears 1.2, then this could go to 1.1, excuse me, 1.1, and then also potentially the figure 1. So I have the potential of another 2,000 pips that this could target. So if you're not in this trade, let's say if you have a risk of 200 pips with a 2% allocation, this could then move 2,000 pips, and it may do that over the next 4, 5, 6 months, or may even do that less. I mean, if you look at 1.3 towards 1.2, what we're looking at here, we're looking at, I don't know, 2 weeks or 3 weeks. So if it's covering round numbers at a rate of, let's say, 1 month, it's covering 1,000 pips every 1 month, then it could cover 2,000 pips over the next 2 months. So you do your maths of the potential risk to reward. And then if you understand how to compound and how to have well-placed stop losses to allow your positions to run, that is how you're going to achieve growth. Okay, I think that is everything. Now, the one before I forget, what I would like to do is just quickly show you a stock that I'm in, so that you guys can see how this can be applied across the board. I've been in Nvidia now since price broke above $40. So you can see that when price broke above the pink line, I waited until it cleared the highest point of 2007 and $40. And you can see now how this has been achieving me very good growth. Okay, if you look at the weekly, above the 50, above the 200, above the 50, above the 200 on the daily, look at how the 50 is being respected as a level of support. Okay, I've been in this since $40, guys, and this is now one of my best performing trades of this year. Another stock that I'm long on is Boohoo. I'm sure particularly the ladies out there, you will be familiar with a company called Boohoo. There is the stock of Boohoo. Same logic. Broke above the pink lines. When it broke above this high, this is when I started looking for long opportunities, and it's now at around 120. Weekly above the 50. There isn't a 200 because there isn't enough data. It's quite a new stock. But if you look at the daily chart, it's doing very, very well. Okay, so this is a stock that I'm currently long on and in good profit. So you can see how the application of technical analysis, a risk to reward, developing an edge, waiting for breakouts. If you're not in this, a break and a close above this will allow you an opportunity to enter and go long, and then use the round numbers 130, 140, 150 as your levels where you want to see price move towards. Okay, I think that's everything. Now, what I would like to direct you guys all to is this ebook. So the lady that wrote this ebook is Anne Chapman, and she is one of my mentors. She's the lady that taught me how to trade back in 2007, and this will cut through all the noise, all the clutter regarding technical analysis and trading. Okay, you can see it's a very extensive book. You've got the trading bias as the very first chapter. You can see it goes straight into the meat on the bones, all the way through to a trading plan at the end. This is a free ebook, guys, that we are sharing out with people who want to walk away from short-term trading and scalping and looking for a more empowering and a more consistent style of trading that can be adapted around work, that can be adapted around family, children, hobbies. Ultimately, you want to get away from working hard. We're tired of working hard. We've worked hard our whole adult life. There comes a point, particularly when you get into your 30s, where your emphasis changes, your priorities change from work and money to time and family and the things that are important. But to do that, to be able to focus on that, you're going to have to sacrifice on money, because to be able to have more time, you've got to sacrifice money. This is the strength of trend trading. You don't have to sacrifice anything, because once you're at a point where you can fund a lifestyle from trading, which may take a couple of years, You can walk away from the 9 to 5. You have your time and you have your money. Now, why do I say you have time? Just to give you an idea of my lifestyle as a trader, I spend about an hour at the weekend preparing for the week ahead. So I go to foreign exchange, stocks, commodities. It takes me about an hour. I have software scanners. I have tools that do a lot of the work for me. I then settle on the instruments that I want to be trading for the week ahead. Monday to Friday takes me no more than 10 to 20 minutes a day, meaning that it can be adapted around any job or any lifestyle that you have. Fast forward 2, 3, 4 years, when you've grown an account size large enough to fund a lifestyle, which is very, very possible with what compound growth can achieve, you can then walk away from the lifestyle, from the 9 to 5. Now, this is the most important thing, guys. You're still only going to be working an hour at the weekends, and you're still only going to be applying your trading 10 to 20 minutes a day, Monday to Friday. That doesn't change. You now have the rest of the day free to do whatever you want. And this is the power of trend trading. Give it a chance. Okay, so please contact me. The way to contact me for this ebook is through my email. I'm just going to put it in the chat box, zaheer@tdtpro.com. Simon can then copy that out. If you can put in the subject title, RTCT ebook, if you could put that in the subject title, then I know that you've come through this presentation, and I will then have the ebook over to you ASAP. If I don't have it over to you, then a member of my team will have that over to you. Okay. Regarding contacting me on social media, guys, if you want to take what you've seen today further and you want to get involved in some training, please check out the following website. Training on this course is 1 month of training. You get a breakout strategy, pullback strategies, community support, training in stocks, commodities, live webinars every week, stocks, commodities, currencies, live webinars every week. There's just a lot that goes into this. It's only £99 plus VAT for a month. If you're interested, please check out the website and get in touch. If you're on LinkedIn, guys, please follow me on LinkedIn, or please connect with me on LinkedIn. You can add me on Facebook. We have a Facebook page. Excuse me. There we go. If you search for facebook.com, the Dynamic Trader, we have a Facebook page as well. I'm also on Twitter. You can search for my name, Zaheer Anwari, on Twitter, and you can search for the Dynamic Trader on Twitter as well. But the main ways to contact me are LinkedIn, Facebook, please add me, and the email address which I've just given out, which is zaheer@tdtpro.com, and I will have this ebook over to you ASAP. Over to you, Simon.
Zaheer, thank you very much. Fantastic. And if you're not on social media, of course, it's a good old email address, and I'm sure if you wanted, I'll hand that over to you with Zaheer's permission, if you just contact me. So
Yes,
all sorts of ways to get in touch. Zaheer, thank you very much. That was a great, enlightening presentation. Not my words, that's the words of George.
Fantastic. Thank you, George.
Wow, says Julian. Great, brilliant talk, says Julian. Really fantastic, nice feedback there. I think you have opened their eyes to some and myself to just sort of a cooler approach to trading the markets. So thank you very much for that. And we're finished neatly on time, which is very good. So I will take the presenter role back for you. And so here, well, again, like most I've been speaking to today, we're going to look forward to seeing you in London at the live show. So
looking forward to it. Thank you for today, Simon. Appreciate it. Thank you for all you do.
Pleasure. Thanks again.
Take care. See you later. Bye-bye, everyone.
The link to the book, P. Wall, is in the chat box. So if you refer to your chat box, you should see a message from myself. With email address for Zaheer, which is zaheer@tdtpro.com. Just asking if you put RTCT ebook into the subject line, and that will be sent back to you. Okay, well, moving swiftly along. From a rather shaky start this morning, the technology is all working well. I'm delighted to say we've got a very great active crowd in the room at the moment, which is really good. Thank you for all your questions. It makes it so much more enjoyable for the speaker when they have that sort of engagement and they realise that there are people out there listening. The recordings will be available, George, just as soon as we can. Once we finish tonight, I will, as always, have a rather late night trying to process these recordings, and we'll get them to you as soon as possible. There is a facility now where you will have access to the whole event on the GoToWebinar system. So that will email out to you sort of automatically after 2 days. We'll hope to speed that up though and have them available at our own London School of Training website. So lots of things to go non-stop indeed in HB. So on with our next speaker. I'm very pleased to welcome our next speaker to the event. He's a man that I met just a couple of weeks ago for the first time, called Ulrico Bracci. And as I was wandering around the London Investor Show in London, coincidentally enough, came across the Yard Charts stand where Ulrico was demonstrating his software to me, and gave a very interesting presentation on his a rather simple approach to looking at different patterns forming in different markets around the world. So I asked Ulrico if he would come on to today's event, and I'm pleased to say that he accepted, and here he is. 4 p.m. It's how to recognize favorable risk-reward situations and opportunities. So this is the first time we've had Ulrico on the webinar, so I will just talk him through the screen sharing process. But first of all, let's see if we can hear him first. Ulrico, good afternoon. Are you there?
Yes, Simon. Good afternoon. How are you?
I'm fine, thank you. I can hear you, which is great. Nice to have you. Nice to have you join us. What we'll do is we will do what we call a screen share. So if your computer is ready with your presentation,
yes, it is.
We will now ask you to become the presenter. You should have a prompt asking you to accept the role of presenter.
Right. Yeah. Sure.
Fantastic. Okay. Now we're looking at we've got a reduced window browser with the Yard charts there. Oh, fantastic. Okay. Now we've got it. Now we've got it full size. We're looking. That's where we're starting. Okay. So I'll let you get started. I just introduced you. Yardcharts.com is the name of the program, and of course we met at the London Investor Show just a couple of weeks ago, and it's good to have you. So you've heard some of the other speakers. We've got a crowd who are relatively short-term trading focused in the room today. So I'll hand over to you and allow you to make probably a better introduction of the company than I can, and then we can take some questions a little bit later on as we go through.
Excellent, Simon. Thank you very much. I will we take a bit the philosophy of our previous speaker, Zaheer, in a sense that with my methods and this method I'm trying to bring out, I'm looking more at the medium term rather than at the short term as well. I also I'm totally subscribed even the view of Francis Hunt before from the House of Trading, that patterns do repeat all the time, and of course you want to be in before the news come out. You don't want to trade out of the news, or you'll be always behind the curve. So I'll start from here, and I'll start with the patterns that our software scans for. We are mainly focused on at the moment on stock markets, and what we are trying to achieve is to scan every stock on every market we look at, and to extrapolate those that on any given day has presents itself as a model pattern, and it's a process that takes many days, sometimes months, even year for a proper pattern breakout pattern to produce itself out. It's the value added of the system. The value added of this system is that what it proposes, it's relatively simple, but it takes a lot of time if you would do it manually to scan every stock every day in each stock exchange. Just to give you an idea, just on Nasdaq and on NYSE there are roughly 8,000 stocks. So how can you keep every day watching each 8,000 of them? That's where the software comes in. This software has been designed as out of experience, of my own experience, trading on short-term futures many years ago, and we tried to have a software that basically works as the human eye. The thing is that if you're trading a liquid market like bonds or DAX on a daily chart, you would have one of these patterns develop maybe once every year or every 2 years. If you go into the 2 minutes time frame, you might have one every couple of days. So these patterns are simple, but the thing is that you have to look for them. You have to search and search. So the computer, basically the software, does this work for you. So I'll go into detail into each one of them, starting with the bottom right triangle. I call it. It's a common triangle where we have I'll show it here, where we have a horizontal line from which the market has to be at the bottom to start with. So the computer does, the first job that it does is to starts to find a level, a peak level, from which maybe will develop a resistance, like a neckline, say, and this has to be at a relative bottom. That means it can be either in a bottom that is it's a bottom if you go 5 years back, or it can be a bottom that maybe it's within a bigger consolidation, right? So maybe the market has been coming off for 9 months, but this 9 months can be a consolidation relatively to the last 5 years. So we are here at this relative bottom, and this situation is it's favorable. Why is it favorable? Because as we see from here, once we have this horizontal line and the market bouncing off and coming down and establishing lows that are higher as we go along in time, once it breaks up, and it shouldn't go lower than the last low before the break. So we have this space from the line and to this last low before the breakout, that this can be used as a stop loss. I mean, this is the maximum risk. We should get out from here if the market, instead of going up, goes down, because we have to bear in mind that if we find a situation like this at the bottom, the market should turn and a new trend on the upside should develop. So what is this? What these risks represents should represent, if things work out, a little dollar amount compared to what will develop eventually. So this is a theory. Now I have some I'm going to just show a past example here, because this is quintessentially it looks like really the theory. This is a real bottom right triangle that happened on DuPont. It was in 2005, but we can see how it developed as a bottom right triangle. You see, we were at a relative bottom, and here we had the first bounce here depicted by the red line. Then we bounce off this horizontal line. We establish a second bounce with a lower low here. So this is the second bounce. And finally, we trail off again before establishing a higher low. And then finally, we break. We break from here. And that's where we should get in if we get the chance. And put a stop loss here. Now I will go. Through some real examples of some trades that I have done this year, and explaining each one of them, and then some that I couldn't catch because sometimes it's not very easy to catch these trades. So back in at the beginning of this year, there was a if anybody remembers, of course, there was a big bear market on oil and all oil-related stocks. So one day on January 28th, we get a bottom right triangle on Cimarex. At the time, it was looking like this. I'll just go into the detail, right? So we have here, we have the first bounce and the second bounce, and then the breakout. These bounces can be, must be a minimum of 2 and can be 3 or 2, right? So if I go back, you see, this is where it was given, the alarm was alerted, and so you can see that here we are at the relative bottom. And I remember that Cimarex was a company that I always wanted to buy because it's very well run. And I remember it was 2 years that I wanted to buy Cimarex. So finally, I get the chance here. And so we have this line passing at $85.91, and this low before the breakout is at $74.75. So we have quite a big risk to start with. So I decided that I didn't want to risk this. This was more than 10%. I said, okay, I should buy at the line here. We have at the line here, and we have a theoretical risk of $9. I decided to put a lower order, basically where we can see that between the spaces here, between these lines and the real bodies of the candles, there is some empty space. So I decided to let the market wait for the market to come to these levels, which is 80, 82, 81.5. But then looking at a stop loss, I said that I wouldn't. I thought I wouldn't like to risk more than $5. So what happened is that I put an order at 80, and basically I just go again into details. I got the fill at 80 on the 11th of February. But that was almost 2 weeks later. It was 10 trading days later. We got the fill here. So I put a stop at 74.75. It almost hit it here on the February 17th because it went down to 75.01. And in that instance, we bought more because it was not costing much more as a cost opportunity. We rounded out position, and well, it did not break it, and then look at this nice trend that developed later. It didn't take much. It was quite volatile, up and down on the first month, but then eventually it went up without never hitting a trailing stops we put, because every time it was making a new high, I raised the trailing stop to the to where the new high was made. You know, so here, for example, once we hit here, we put the trailing the trailing stop here, and we raise it, and then eventually when I put this as a trailing stop, and I got out here losing some of the trend, but it was still a great trade because we're up more than 50%. Then the same concept was applied to Taser. Taser was also at the relative bottom back on the 11th of February. I'll go into detail. This is the day alert of the alert. When the system alerts, that's how you see it. Yeah, this is on a closing basic on February 10th. So as you go in the morning before the market opens, this is what you see. Yeah, you see the chart up to here. This is the alert where the horizontal line stops. So here again, it was the entry was 80 at the line, $80 with sorry, at 1573, was at 1573, with a stop here on this low at 1472. It was a $1 risk. So next day the market opens quite lower. So I was able to buy lower at around 1520. Yeah, you see that the next day the market opens lower. Basically there was the stop loss was basically only 40 cents, and it developed in a really nice trend. You see it. Well, actually, I got out on the day because here it really shot up. It went up to 20. Out of a very nice report, quarterly report. So basically, coming back to risk reward, we're risking 40 cents, and all of a sudden we're making $5. So that's when we got out. We were basically, we were very satisfied with that. And then the stock went sideways, right? It went sideways, and then it gave another alert later on May 10th. Yeah.
Can I interrupt for a second?
Yes.
Is it possible to zoom in on the screen that we're looking at, because it looks quite small for us looking at it through the webinar? I don't mean that. Right. I mean the whole screen.
Right, the whole screen. Just a second. Let me see how I remember there was a system.
At the moment we've got a lot of space on the left and right hand side of the black window.
Right. Yeah, yeah, I'll try. I remember there was a system how to do this. Hang on.
Control plus is being suggested.
Control plus. This is a Mac. Sorry.
Oh, there.
It must be Command plus, maybe. Yeah. Excellent, Simon.
Okay. Thank you. Now, if you could scroll down a little bit. There we are. Oh, there we are. Now we can start to see a little clearer. Thank you, Hamid, for that.
Yeah.
Great. That just makes a little bit better for us to see.
So this was the second alert on May 10th. It was given basically a little bit lower from where we got out the first time on the day of the if you remember here on this day of the quarterly report. So I decided to jump back in and I ran it all the way to 25, and then I got out because there was another quality report, and I was really satisfied with this as well. And so this was Taser, and then there was another big, the same concept here with hang on, this is the second control plus. Okay, this is a stock of Buenaventura. Is one of actually is one of the biggest gold mines in the world. Is owned by Newmont Mining, and is a Peruvian company. It's quoted on the New York Stock Exchange. So this was the day of the alert here at 5:50 and 5:56. We stop down here on the low at 4.99. And this was a 50 cents stop to start with. At the time, I decided that I didn't want to risk so much as well. So basically, I waited. I put a 520 bid with a stop at 4.99, and I got the stop was the same. So I got filled on a few days later. Of course, if this had shot up like it did here in the first few days, I was ready to miss it. That's what happens. Sometimes they go straight up, but in this case, it didn't go. I had a good chance to buy a very good level, and this also you see was.
Sorry, can I interrupt?
20 basically. Sorry.
Sorry, I need to interrupt you again. I'm sorry. One or two people are saying that they cannot see anything. Now that's the third person that said they've tried switching the webinar on and off and come back in, and they can't see anything. It's not the case for me. I'm able to see the screen clearly, but is anybody else having a problem? Maybe sitting there not wanting to say anything. Well, there we are. Okay, so most people can see everything. Fine, great. Okay. Clive, I don't know what to suggest, and Sanj as well. I don't know what to suggest. That it's not coming through to you. My apologies. I'll have a think to see if I can think of anything to do, but everybody, the majority, seems to be fine, and at least can see the screen, even if it is a slightly small chart on the screen. Okay, we'll carry on. Ulrico, sorry to interrupt.
No problem. So here also we had basically a theoretical initial risk of 50 cents, but it was covered many times over, from 5 to 16, and so 10 times over, and I got out at around 10. Then I go quicker because I see time is passing, so I go. I put this. This also was a particularly favorable trade because here the stop loss to start with was very tight. I go into the detail. This is a biotech company, ex-biotech. There's a long consolidation. You see, the computer is looking for this for you. Is making these little allowances here. It's bouncing here more than the line, but it's closing below. Here it's trading here with the line. But this is what artificial intelligence is. The computer looks at the line, even though it starts from here. It tolerates this through some parameters as the eye of a human would, because it basically tolerates all these breakouts. Anyway, this is the data alert, how you see it. Took a month, so it was here on March 8th. The line passes at 8:36. The stop is at 7:31, and we put an order of remember this order was 781, but this, unfortunately, I was not able to buy it because it never hit my level. Yeah, that was a bit too stingy here. So this I just saw it going up, and that was the end of it.
Ulrico?
ACAT, yeah?
Sorry, could I interrupt again? We're getting a few questions. I think you might have lost a few people, excuse me, in terms of the presentation. And I know you're working in a second language. It's never easy. And I just wanted to, maybe I can ask a couple of questions to you directly, just to sort of set the scene and set the context for what it is that we're looking at. We're looking at a sort of program interface here, which is taking, is it live data first of all, or end of day, or what's
end of day? Right. It's end of day data. You see basically you'll be able to see the alerts after the close. Yeah, because anyway, for this pattern you need a closing basis to be confirmed, right?
Okay.
So it's end of day data.
So it's end of day data. So it's looking for it's not for intraday traders particularly, like you said at the start. It's more for the medium term investor trader. And the patterns that we saw quickly the different patterns before at the start, and you had a bottom right triangle. What signal is that particularly showing us? Is that showing us a buying signal or a selling signal?
Well, yeah, the bottom right triangle is well, I'll go back here. Bottom right triangle is something like this, right? So you have to get a bottom. Why do you have a triangle? Because it's a right triangle because you have a horizontal line here. And it's, as you can see here, it's associated to a triangle. It's a long side, a short side, a hypotenuse. Given from these rising lows, the low here, then it bounces up here, then it goes down, up, and these lows are rising. So we can associate this pattern to a triangle. When you go into real life, like here's the triangle in real life. It's this horizontal line, so it goes down from here to here, then it bounces, then it goes down again, higher low, it bounces, higher low here, this is the lowest within this bounce, and then finally the breakout. This is finally the breakout. And once you have the breakout, the market of this stock shouldn't take this stock below this line here, which is it's the lowest point on the last bounce before the break, right? Is that pretty clear?
Yeah, sure. So the system is actually looking for these patterns occurring on the chart. So when these patterns occur, is there any time frame? Because obviously you could find these patterns occurring on different time frames. What does it take to qualify?
Absolutely, they occur in all time frames. They occur in weekly, in daily, in hourly, in 10 minutes, in 2 minutes. They occur all the time. On stocks, we look at them on daily. Each one of these bars is a daily bar. So that project us in medium-term trades that usually last for 3 to 6 months, sometimes even a year. But if you get stopped out, it can take even only a couple of days. But you see here, for example, for this bottom right triangle to develop, it starts here on the red line. I'll go into zooming out. So it starts on the February 1st of 2016. It establishes the first bounce. It takes basically a month, and then almost another month to do a breakout. So this pattern takes almost a month and a half to develop after being spotted at the bottom of this trend. Here you have the market that comes from 40, it goes down to 20, 16, and here between 20 and 16, this bottom right triangle develops. And once it breaks here on this day, on March 22nd, this is where where the breakout is confirmed, and that's where the theory says you should go long on this breakout, but not risk if the market goes below here, this low here on that is on March 17th. So basically, I remember I put an order here to buy. I got filled, but then I had other positions, and I didn't want to take this, and that I regretted because it went up almost instantly next day. I'll show you another one, and then I'll finish with this pattern. Yes, we got this. This is a smaller company. It makes pawn loans. It's S Corp. This was the day of the alert. So again, I waited for next day, and on the following days I put an order here on the line that crosses at 308. The order was at 309 with a stop loss here at 275. So basically it was a 34 cents stop, and then it started to go up, really nicely. It went from $3, it went up to 10, and that only took 6 months. It never without too much volatility. Actually, volatility was on your only when it went up. Otherwise, on the downside, there was no volatility. So this is a pattern. It's called the bottom right triangle, and the computer goes every day to look for them. Then I would like to show the audience another pattern, which is what I call the bottom end sweep. This is similar to the other in a way. We have a triangle here as well, but it's inverted. The lows are getting lower every time. We are bouncing. Hang on, I'll put this bigger, otherwise nobody sees it. Okay. Here, the same thing. We are bouncing off this horizontal line with lower lows this time. Then the market breaks. We don't get into the market. We wait for the market to come back to this horizontal line, which is the day of entry. Right? So the system only calls the alert when all this pattern has been produced and it got back to the day of entry. Some examples, a trade we did was on Twitter. We went long on Twitter at the beginning of June because Twitter made this pattern. Twitter had already a lot of bad news in the market, so I mean it was down, but as you see, it was not going much anymore. It was spent. It spent 4 months trading. Well, it's volatile, but it really was not moving that much with all bad news it was getting. And then finally, we get in June a bottom end sweep. So this is the first bounce. Second bounce with a lower low, goes up here, and then here where the blue line ends is the day of the alert. So that's when we got alerted. Next day we couldn't get in because it was, as you see, it was higher. So we put an order. I put an order as this was a dangerous stock. I put it very close to the stop loss level, which was here was $14. And eventually got filled on June 10th. This almost got stopped out. We got in at 14.20 with a stop at 13.99, and almost got stopped out. But it didn't go to the low was 14 actually. So just for one pip. But then it started to go up very, very nicely. The rumors of takeover started to filter. And it was there were a lot of downgrades, bad news again. So it was a rough ride. You see, like this day here, from 18 it went down to 15. But no, it was sorry, it was not 15. It was 15.69. The trailing stop was at 15.40. So there again, we didn't get stopped. We stayed in the trend, and then eventually we got out here at 22.5. on that day when it was announced that bidders were retreating. So that was, you had to be there a lot because you had to get out at in the pre-market. But so we got out at 22. But it was a nice trade. It was kind of difficult, but we had another example of this is Netflix. This was just a few days ago. You see, it's the same pattern. Bounce here on the red line, then another bounce with a lower low, goes up, and then when it hits the blue line again, this is the day of the alert. That's how you would see it. The stop loss is here on this pattern. It's explained on the theoretical part. So basically, this is a stop, and then after a few days, we had some excellent quarterly reports. And another one I would like to show. This was done in this summer. This is a smaller stock. It's a semiconductor. But I went through the company also, and I liked basically what they're doing. And so this is the same thing here. It is at the bottom, first bounce, well, and then the next day it alerted because it went up and then down again. It touched this line. So we put an order here at we got in at 242. The stop loss was at 223. So it was a 20 cents stop loss. Stayed in, and then all of a sudden, when I was on holiday, this went. I saw it open 150% up. So at we sold it out at 570 here because it was just crazy. And then it went like this. It went trading water. So this is explained here on the website. Bottom and sweep. For the readers, they can go here and check this out. All right. Then I go to the next pattern. It's called bottom reversal. These bottom reversals are very rare. They happen. You don't have many, right? It's very difficult to happen, but here we go. Basically, we need also to be a downtrend like here. Then the market has to go in a trading range. It has to go in a trading range for quite a long time. Then it has to look like it's going to break down, a continuation, right, of the previous trend. But then all of a sudden here, it breaks below the higher band faster than it went down. So the computer calculates the velocity. Here there are 4 bars coming off. 1, 2, 3, 1, 2, 3, 4, 5 to establish the bottom, and then just with 2 bars, it breaks, it reverses. So here the theory goes is that you buy here on this line here, and this is the stop loss. It's the lower band of the trading range. If this is indeed a reversal, this is it's a small cost to pay in the sense that this is the only thing you risk, and this should go many times over. This was a trade was done. We had one. I enlarge this again. Hang on. Wait. This was the actual trade on TNET. There was also on Nasdaq. This was the day of the alert. You see, the computer found the range for you. You don't have to look for range with your eyes. The computer does that for you. And then you got alerted this day. This is the actual pattern. You see, so it takes 2 candles to establish, and 2 to break. It has to be. The reversal has to be at least the same. The same number of bars. Because if this had taken 3 bars to break, the computer, that means it's slower. The to come up is slower than to come down, so it wouldn't be good enough. And so here you have to buy at 13.5 on the sorry, let me check. Okay, 13.5 on the higher bands, with a stop loss here at 12.47, which is 1 point of risk. And this, so I decided to put half a point. So I put an order at 12.80, which was filled here, this day here. So basically a few days later, also a week later, 12.80, stop at 12.30 on this day, and this went up as well, very nicely. So and these are very rare. You have in the whole market, you might have 10 per month of these alerts on the whole market. And so we go basically the computer goes through the whole market, 3,500 stocks every day. So you make your calculation. Basically, in a month, it goes that is made up of 20 trading days. It goes through 60,000 stocks, and you get only 10 of these, you know, on average, right? So this is quite value added. When they work, they really work, and they work really well. Then I'll show you how many we found. Okay, then we have. Sorry.
I'm just. We have a question.
That are continuation patterns.
We have well,
yeah.
Can you hold on a second? A question from Paul is saying, is there a best time frame to employ these strategies?
No, these strategies you can employ on any time frame. On stocks, I think the best time frame is the daily chart, because stocks, as opposed to indexes like the DAX or the Bund or the like very liquid markets like the US dollar, the markets are not liquid enough on a 10-minute time frame, right? So I wouldn't risk that. It's better to go on a daily time frame, so you catch trades that last for 3 months. They're not too stressful. You know, as the previous speaker said, it only takes 20 minutes to go through Nasdaq and NICE. To me, you know, I search for stocks. It takes me only 20 minutes with the computer, and I place a trade. Of course, if I want to go on lower time frames, the system works as well. It would work as well. I mean, we don't have the data feed for lower time frames at the moment, but I mean, it's very easy to put the data feed. But it would work, say, on very liquid markets. I would say indexes and foreign exchange. And then you can go, yes, on 10 minutes, where you would catch trades that maybe they can last a day or two on the 10 minutes, so if you have a really good trend, or maybe they could last 3 hours if you go on a 2 minutes time frame. Okay, but as the system has at the moment on stocks, I wouldn't really. I tried once on the 60 minutes for just the S&P 500, sorry, for the Nasdaq 100, and I didn't like it. You know, you get too many trades, and then it's. I think it's too stressful. It's better to go on a medium-term outlook, and you can have very good returns. You know, when you're making 30%, 50%, 300%, and you don't have to stress out. What's the point on going on the you know, to stress out on I think on the 20. I mean, I've traded for 20 years, so I don't like to trade on smaller time frames anymore. But I respect everyone has got their time frames, so this system could work on any time frame. Now I go quickly through this other pattern that is the horizontal support. Horizontal support also very good risk reward. because here we are supposed to have a first the computer looks for an uptrend, so we must have a neat uptrend without retracements, without relatively speaking, right? We always have retracements, but as long as it is solid. Then market retraces a little bit. Then when it makes a new high, it triggers a support level here. You see where the lines change? So this is a support level. So the computer calls you as an alert when we get very close to this line, when we get within a distance of 5 or 10% from this high to this line here. And so we risk this. If the market goes lower, we get out. Otherwise, we enjoy the trend. I have a real example here. This was on United Continental. We had the support on this was June 27th. June 27th was the day of the alert. I came in on June 28th. I liked the company, so I saw this line. I say, okay, let's maximize. Let's see where this line comes from, because it was going really back quite a long time. You know, I couldn't see where it was coming from, so I just pressed max on the computer, and I see this was the support. It was coming from July of the previous year. So here you would have to buy at the alert was 38.80 with a stop loss level at 36.65. So we're talking about 2 points, right? So basically, I didn't trade that because I was waiting for a lower level, so I didn't get it. But anyway, then you see, it's still working. I mean, we're not sure if it will work. Before it's still up quite a bit, because from 38 we are at 58. So percentage-wise, it's a good trade, but still not out of the woods, this company, unless it breaks these levels up here. We did a trade, a nice trade on resistance, which is the opposite of supports. The pattern is this: it's horizontal resistance, the same concept. It's just reverse. We are coming off here from a downtrend. Goes up, triggers here. When we're up here, that's where you get alerted. So we had a nice one on Starbucks, right? Starbucks on June. No, this was April. Okay, at 61.30. This was the stop loss. Well, this I wanted to go short because it was just a 40 cents stop before it reached this red line. But the company had some bad news already in, even though the market was not paying attention. It had some bad social media feedback. People, because of a change of caps, I remember, people were reported with intoxications at some restaurants. And there were news on EFT that China customers were shifting to local competitors. Didn't like much the American. So there were the Chinese, which is the main market. So I decided to take a chance before the quarterly report. And then this is when we got rewarded. We stayed in this trade from here to here for 15 days. It never went above the stop loss. And then it went down nicely. So this was Starbucks resistance on Starbucks. I mean, time is running out, but we have the same thing. We have the trend reversal patterns from the top. So we have, for example, like a top reversal. Here we have a top and sweep, which is just a reverse of the bottom and sweep. So some examples. I got some examples here. Let's see. Yeah, here, this one. This is the Edwards Life Science. It was this was the day of the alert. You see, when it touches the I'll just go into detail. So the alert was on October 12th. when it touches the blue line, so we are talking about let me see the second. Okay, this I didn't trade that. I wish I'd traded, but the line was passing at 1862. Stop was at 121.73. So up here basically, because these stops are almost the same, even though this is slightly higher. So basically, well, this is working fantastically. We just collapsed. They had some bad news. So it never went up. The stop loss. This was for people that believed in this one. They'll be doing greatly at the moment. We only got. I don't have time to go through all of them through examples, but the patterns are all explained here, right, on this section, and basically the system works like this. Basically, you go in the morning before the market open. You choose your markets. You choose for the patterns you want to look for, say bottom right triangle, bottom reversal, and bottom end sweep for as the close of yesterday. You choose your day here. You see, you go like this. So I choose the market I want to search for, New York. I choose my patterns. So I just click in. I can look even more days, the past days. Well, I look here at the 27th. I do a search. No, I know 27 is today. Sorry, I have to go for as yesterday's close. So search. Well, this went too large now. Anyway, this is our these are the results. We had one bottom and sweep on the New York exchange. So out of 3 patterns, only one bottom and sweep out of 3,500 stocks. We had more on the Nasdaq stock exchange. So here I just go back, right? So basically, if I want to look for the top right triangles, I do the same. Let's see what yesterday there were many top right triangles. So I go like this. Well, yesterday was a bear day when you had more, and here is this is the first indicator, is the liquidity. Yeah, A plus is more liquid. Then as you go down, you have the less liquid stocks. Half tank here. So on the liquid, you have a full tank. It's just a icon kind of. So let's say Quest Diagnostics. This is Quest Diagnostics yesterday. So this is the freshest hour, closed like this. Well, it's a bit aggressive. It closed aggressively down. So maybe, well, you have to wait for sure for it to bounce, to come back to the, before you do a trade, to come back to the horizontal line from where it broke. So you see it's like this. So the system does an automatic search on all these patterns. One last thing I would like to mention is that here on the free section of your charts, you can check all our patterns given in the past, good and bad. There are all the patterns produced by the system in the last year and a half. So you just go for example, on the Nasdaq, you say I want to check, bottom right triangles from Nasdaq bottom right triangles. Hang on, I mean now it's not working. Why not? Sorry. Okay, bottom right triangle. It should come here. I think there's a problem now. Hang on. It's too many charts up. Okay, let's try again. Okay, yes. So you see here you can go on any day so on any day in the past, and for example, you go, say you want to see Nasdaq. or say Nasdaq, right? Whatever. Bottom right triangle on April 4th, for example. April 5th, it's the same thing. Okay, these are. This is you can see how it worked. For example, this one. Okay, this is how the alert worked on that day. It went straight up, and then eventually it didn't work. So you have all the examples of you can get a feeling of the system by looking for free at all alerts, past alerts. You will not get the last 15 trading days because this is what the service is about, is to get fresh alerts. The fresh alerts are here on the Yard Chart Plus, and you see these are the last 10 trading days, 15 calendar days, and this is what the system is about. But you can go for free here and look. Have a feeling. Look, for example, on how on a bull market how the bear alerts worked, right? That you want always to get see if the system is solid. Look during a bull period how the bear alerts worked, or vice versa. During a bear period, look how the bull alerts worked. If the system is working good or satisfactorily during this situation, it means that on average we are doing well. But the thing is to look at you can go at this for free. Basically, this is we have 8 markets to look at. Even though this is the markets I like most from Europe, because we have. You can have time to prepare before the market opens, just half an hour of work, and you can even, once you are here on the alert, you can go into the fundamentals through the link. You see?
Ulrico, we need to wrap up.
Just press here. Right, sorry. I'm finished.
We're just a couple of minutes away. I think that's we've certainly got a flavour for what the program is and how it works. Which is great. There's obviously a lot to it there. So thank you for coming on and showing us the different passes. Where do people go if they want to learn a bit more about the program? Is it yardcharts.com is the website? Yes.
Yes, yardcharts.com, and I would suggest people to look at the patterns to see what we are talking about. Just read more. On some we have a video as well, where people can look at the video and go into the theory. Here is with the examples, and then just play with the free sections. That's for free. Once we have registered, which is for free, people can play out with this. And then if people like, once they register, they also get a 10-day free trial on the Yard Chart Plus, where you can make a search on multiple markets. Multiple days, and so just play with it. You can play with it 10 days for free on the Yard Plus, and anytime you want on the free Yard Charts for the past alerts.
Fantastic. Well, Ulrico, we're just bang out of time now. So thanks very much indeed for joining us today. I'm going to take the presenter role back from you now because we have another speaker to move on to.
Okay, Simon, thanks very much for the opportunity, and thanks to everyone for listening, and hope to see you on the website.
Fantastic. We will do. We'll keep in touch. Thank you very much, Ulrico. Take care. Bye-bye.
Have a good afternoon. Thank you very much. Bye-bye.
Okay, so we find ourselves remarkably at 5 o'clock already, and I'm pleased to say that our next speaker, Pablo Ortiz, the FX Method, is in the room already. So just to welcome those of you that are joining us, I can see lots of new names still coming in. It's one of the nice things about the event is we have a morning crowd, an afternoon crowd, and an evening crowd, and we have our elite crowd who stay with us, who stay with me all day. So welcome to you all. This is Round the Clock Trader. My name is Simon Campbell, and I'm delighted to be hosting this monthly webinar event for traders. It will be recorded. It has been recorded, Doriel, and the the link will be emailed to you. Hopefully by tomorrow, if we can. We'll just it takes a little bit of time to process all these video recordings, as you can imagine. So you're a registered attendee, so you're on the list. You will be receiving an email from me with links to that recording. So let's go on to our next speaker, Pablo Ortiz. Pablo's spoken on this event several times over the past year, and is a specialist in algorithmic trading, the robo trading. I won't tell you too much about it. I'll leave that for him. He will do a better job than I can do. Just before we go to Pablo, just to give you a little heads up of the schedule remaining today. After Pablo's finishing, we have a new speaker, Ruben Miller from the Investing Academy, to speak at 6 o'clock. Andrew Keane on the hedge fund option orders at 7 p.m. And then finally, we're staying in the US for My Favorite Strategies by Jeffrey Gibby over at Metastock. So quite a few presentations still to come. Hope you can stay with us up until the evening. If you can't, of course, it is being recorded and you'll have access to that just as soon as we can. So, unmuting Pablo, we can say good afternoon. Pablo, are you there?
Good afternoon, Simon. Yes. Do you hear me properly?
Good afternoon to you. I can hear you very well, which is great. And once we go across to your screen, we'll ask everybody else if they can hear and see you as well. So thank you for waiting patiently there. We've had a great day today. It's been a little testing this morning with the internet, but everything's running very smoothly. So let's just get straight across to you now, and we'll do the screen share. And you're the only one that's talking today on this subject of algorithmic trading. So trading system families, as we're calling it now, of course.
Mm-hmm. That's awesome. It's great to be back here, Simon. It's a great event. I love your events. There's such a panoply of different speakers, so many subjects, and a good crowd. I see there's a lot of people today, so that's great.
Thank
awesome.
you. And a nice crowd and a lot of new faces as well. So this is good. We often sometimes we make the mistake, because of course this is our world, talking about trading and things, that sometimes we forget what it's like to be maybe a newer trader. So for those of you that are new to trading on this event, I'd be interested to just get any feedback from you on how approachable you're finding the seminars. Because a lot of you, I know that there's a lot of people here who are experienced, they're in the markets, and we've been there and done it, and so forth. But if you're someone that's just taking these first steps, please do just let me know how you find it, whether you're finding this variety of presentations useful, or just make sure, we want to make sure we pitch it appropriately to everybody. And so Pablo, I know that you have some fantastic presentation slides here as well. So the trading system families, looking forward to finding what this is. I'll hand over to you and allow you to get started.
Thanks very much, Simon. I'm going to try to keep it easy. It seems like a very easy topic, but it's not. And what we are going to talk basically is about different trading styles. And I call them trading system families because we like to divide them very clearly in families. And I'm going to compare them today. It's going to be kind of a fun session. And what we advise the people that they see other styles of trading, other ways of trading, and invite everybody to look into automated trading. It's not so difficult. It's not so impossible. You don't need to be an engineer. You don't need to be a mathematician. Well, I study mathematical physics, but it doesn't mean anything. I try to keep things simple, and I really invite you to do things differently. So to have a look in automated trading systems. Okay, I'm going to compare the different trading families. Like I compare it always the trader that it's like a hunter, right? And what is very funny is when you see traders that go to hunt elephants in Siberia, or they go to hunt bears in Africa. That's the parallelism I make, right? And it makes no sense whatsoever. So I'm going to compare this. I'm going to talk only about 4 trading families, just to mention. I'm going to be with Simon next weekend on the 5th of October in his venue at 4 p.m. and you are welcome to pass by. It's going to be a great venue. It's going to be a great gathering, and I'm going to develop these trading system families further. And you can meet me in person, which is the best way. I know some people are not from London, but I've had people coming from Belgium with the train over through the Calais tunnel, and you're really welcome to come over and we talk further about these topics. So we have the elephant, that's the trend systems. We have the beer, that's the breakout systems. We have the partridge, which is the counter trend systems. I'm not going to talk about this today. It's probably too difficult. The duck could be the range systems, and the rabbit are the scalping systems. Okay, so you need to have the right tools to hunt the proper animal, right? You need to be in the right place. You need to be in the right timing. Maybe it's not the right time for rabbits, right? Or not the right time for ducks, and that's very important for a trader, whether you're a manual trader or an automated trader. Okay. So this is the best example what traders do. They do it wrongly. They go hunting without any concrete idea. They just open the platform and they just start a trading day. They don't have any clear idea what they're going to hunt, right? Is it going to be a trend day? Is it going to be a breakout day? What are they looking for actually? Are they going to scalp? And that's one of the major problems when we encounter traders. That I'm not only talking about the trading plan. I'm talking really what concretely they're looking for, and that we call trading system families. Okay, so let's go one step. Well, that's what I said before, right? It makes no sense to look for elephants in Siberia, right, on the snow, okay, or look for the polar bears in Africa. You see the little bears here, right? It wouldn't make a sense, but people do that, right? They look for breakouts when there is no breakout moments, no volatility, and they're looking for trend systems or trading trends when the markets are totally flat. Like in 2012, we had a completely flat market in the forex markets. We have traded more forex, but not only, and people were looking for trend opportunities, which makes absolutely no sense. Okay, so this is actually what people do. Okay, they go hunting. Exactly like the doggy here on the GIF. I don't know if you can see that. And it makes absolutely no sense. Okay. So, first of all, we need to understand that there are 3 main market characteristics. There's 3 main ways. I don't care if you're trading futures. I don't care if you're trading stocks, forex, indices, whatever you're trading. There's only 3 ways that markets move. And many people don't even know this. And this is for me the basics. The basics of the basics. So we need to know what are these 3 main market characteristics and how frequently do they occur. And if you don't know that, you're completely lost in the forest trying to hunt whatever animal that moves. Okay, so we have, first of all, 70% of the time, I mean of the market time, we are in ranges. The market is moving beyond 2 prices. I'm going to make a picture. I'm going to draw a picture actually later, just to show you the differences. And this is the main market characteristic. The market is moving between 2 levels. I don't care if these levels are even, I mean like on the same level, or they are slightly tilted. It's still a range, okay? And I disagree fully when people say that the trend is your friend, because actually trends occur only 20% of the time. So if you catch them, good luck for you, but they don't happen so frequently, okay? And this is very important to know. Trends are only 20% of the market time. And the rest of the time, 10% of the time, the markets are breaking out. So I'm going to make a quick drawing. Sorry for the pain. It's not in English, the software, but you will understand actually what I'm saying better with a drawing, real quick drawing. And, well, that's, let's say, 2 predefined levels. And if the price is bouncing back and forth, I also call it the ping pong, right? And we have 2 predefined levels, and what we do usually here is we basically sell up here, and we basically buy down here. I wish it would be always so precise that it's bouncing precisely at the level. Majority of the times, it's not precisely bouncing. You see there's a gap here. It's not bouncing exactly on the level, but if we knew what the levels are, we would be trading ranges beautifully. And normally this trading style or trading family is being traded to the mean reversion, meaning we don't trade till the price goes fully down, but we go to the mean of the channel, right? It's also called channel trading, and people discuss whether this kind of channel is a trend, right? Because it's slightly tilted. I don't want to discuss whether 5 degrees is a trend or not, but basically that's a range trading style, and this is occurring 70% of the time, as we said. That's the main actually market characteristic, and many people don't know that, and they pretend to trade trends here while we don't have these big moves, right? The other market characteristic I don't need to define, I hope everybody here knows, is the trend. And trend is defined by major highs or whatever, the usual definition, and I don't need to give it, right? That we have higher highs or lower lows, right? That's a downtrend. And that's the definition of a trend, actually. What is very important in all these trading families is that we need to first recognize them. So if you want to recognize a trend, you have first to have at least 2 highs and 2 lows, or 2 highs and 1 low, and you can trade the trend on the breakout of this level or on the pullback on this level, right? But first of all, you have to have the initial movement for the trend to be a trend. Same thing happens on the range. You cannot tell it's a range unless it hits 2 times up here and 1 time below. And you can find this all very well described in the best book on technical analysis, which is John Murphy. You can buy it in Amazon. I would say that's the Bible of technical analysis, okay? So trend trading and range trading and breakout trading, especially these two, can only be defined after we have an initial movement and we are certain. So we are always late. We are always late in defining a range. We are always late in defining a trend. The last characteristic, which is completely different, is the breakout. And the breakout is the complete opposite of the range trading. You see it's bouncing back and forth on these levels, and at a certain point it really breaks out of this range, and this happens 10% of the times, right? So once you understand these 3 main characteristics, we'll have for sure, I'm sure Simon will make a break later for questions. You can ask them again if you have any doubts, or you can meet me next week and we can clarify exactly what these are. But I think this gives you a very pretty picture of what are the main 3 characteristics, the main 3 ways all markets move. I don't care which financial market. Okay, so based on this, we understand now that, for example, a reversal system is actually a trend system. Okay, it belongs to the trendy characteristic of the market, right? Or, for example, an Asian scalper is actually a range system. Why? Because we're basically scalping in the Asian session. We are selling on the upper part of the range, and we're buying on the lower part of the range. The only thing is we are going for 4 or 5 pips. And trading systems such as, for example, Fab Turbo, which is very famous, or Erroneous, or other scalpers, they're basically range systems. They are scalping on the range, okay? But still, they're scalpers, but they're range systems, okay? They belong to the range market characteristic. So you need to understand, first of all, which kind of animal, which breed of animal are we talking about? Are we talking about a big animal? Are we talking about a small animal? Okay, once we understand these 3 market characteristics, we can now further define every single family of trading styles. Okay, here we have the trend system, right? It's big, right? It doesn't move with speed, right? And you need to have patience. That's the trend system. Okay, so for me, these are the elephants. What are the characteristics, the main characteristics? There's so much more to this. I mean, in our advanced education, we really delve very deeply into trading system families. Okay, so the main characteristics are these 5. Okay, they have a long ratio. What does it mean? That they take profit, the target, what we're looking to earn is usually much higher, much bigger than the risk, than the stop loss, right? So we are usually looking at 2 to 1, 3 to 1, even sometimes 4 to 1. If we're earning 3, we expect to lose 1 only. That's very correct. That's one of the main characteristics of trend systems. And they're usually traded in stock markets. Okay, trend trading is the buy and hold we heard all the time. That's the way actually Warren Buffett and many other big hedge fund managers trade. And there's nothing wrong with it. But what we suggest is that we'll talk about this next Saturday, that you build a team and that you play and that you go hunting all 4 animals. You don't need to specialize just only in trend systems. You can trade all 4. You can be a good hunter for ducks. You can be looking for elephants. You can be looking for bears, and you can be looking for rabbits. And you can train yourself in all 4. Why not? And combine them. Actually, that makes you stronger. But the problem with trend systems, as we see here, is that many years, I would say it's lately, maybe with Brexit, we have again volatility. I'm talking about the forex market, right? But several years we had problems with flat markets. So they are not good to trade in flat markets. Trend systems are very easy to learn. Okay, it is the first thing you learn as a trader. They show you, okay, that's a lower, higher high. This is very easy to recognize. When you make automated trading systems, you can take 2 moving averages, or 3, or 4, or 5 moving averages to detect a trend. We have the Scott-Lowry trend system, which is a very simple trend system. You can look it up in Google. It's one of the easiest ones to learn. You can trade it on the DAX, for example, if you're in love with indices, and it's quite easy to learn. Okay, that's why the majority of traders start with trend systems. Okay, but you need to know that the entry is always delayed. Once you detect a trend, you're late. You cannot expect to forecast completely when a trend is going to start, because once a trend is started, by definition, you're late. Okay, because you already have the initial movement, and this is lost price. That's a lost impulse. You cannot catch anymore. Okay, so you need to know the entry is always delayed. Hence, the entry is not so important, because everybody will know, oh, it's uptrending. I mean, we can look at a chart. I have here MetaTrader opened, and everybody can say, well, it's very clearly a downtrend or an uptrend. We can do this later if we have time. Okay, but that's not so crucial. The crucial part in a trend system is the exit. It's very easy to enter into a trend. It's very difficult. It's really extremely difficult to decide when to exit a trade in a trend system. Why? Because we can always, the greed is there, the greed factor, and we say, okay, we already make 2 times our stop loss, but what if I stay in the trade? And this is one of the problems with trend trading. Okay. I also compare this to, I like to make the comparison with a soccer team, and we build in our education advanced soccer teams. We tell people you need to find your 11 players, and you need to have goalkeepers. Goalkeepers are the trend systems. Here we have Iker Casillas, one of my favorites. And the good thing about trend systems is they protect your account. Okay, if you're really like the goalkeeper, right? He's protecting you, and you need to have them. You cannot be a trader and not trade, in my view. Okay, this is all personal opinions, right? You need to have at least one trend system in your basket. Okay, so that's the main trading families when we're talking stocks, when we're talking indices. Okay, you need absolutely to trade it. Okay, a big trade will cover a lot of losses. Okay, that's good psychologically. Okay, and it's very easy to create the entry. The exit is extremely complicated, and it's similar or akin to when a goalkeeper shoots. He shoots very far away, but you never know where the ball is going to land, right? Same thing with trend systems. You know where it starts, you never know where it ends, and it stays very long in the air. And that's actually not so good. If the market is going to turn around and you are very long in the trade, like the ball is very long in the air, you have more risks. I'm not a big fan of very long buy and hold for this reason. Okay, so I'm going to draw now what the curve looks like, and my students detect it immediately. They know immediately, oh, that's a trend system. Why? Because they know how to read curves. So in a trend system, in the balanced curve, you will have a very big trade that goes up. You can earn 4 or 5 times the stop losses, and a consecutive streak of stop losses, like 4, 5, 6, 7 trades of stop losses, and then immediately another big trade, and you get something like steps. You see this? And that's the characteristic curve of a trend system. I really invite you to go to my FX book or any other place where you have statistics, and you will see that trend systems always move like big jump, lots of losses, big jump, and that's a trend system. You don't even need to read anything further about the report, how it's traded. You can detect them immediately just by the curve. So I invite you to do that. The holding times of the trades are very long. In the Forex market, we're talking beyond 60 pips. That's going to be around at least 15 hours in the market. We could discuss whether this is swing trading or position trading. Both are trend trading. Okay, the difference is basically that in swing trading, we're talking 40, 65 pips in the Forex market. And when we're talking position trading, we're probably talking weeks. And it's probably over 100 pips or so. But still, both are different subfamilies of trend systems. Okay, I hope this was clear enough. I'm very fast. I'm already in the middle of the lecture, and I still need to cover another 3 trading families. I'm going to be real fast now. Okay, the next trading family is the breakout. I compare it to the beer because it's when the beer gets aggressive, it's a lot of force involved in it. Like in the breakout, it can create big moves. And both animals are big, but the character is very different. Okay, so the breakout systems, they usually have a medium ratio to long ratio, meaning that the TP and the stop loss are normally similar. We go from a TP which is twice the stop loss to sometimes even half the stop loss. Okay, it can happen. And in my view, if it catches a very long trend after it breaks out, it's more of a trend system. And some people have problems classifying this. They say, well, that's a breakout. Yeah, it started as a breakout, but what I'm looking for is to catch a very long trend after a breakout. For example, after the Brexit, yes, you could have caught a very long downtrend on the pound, on the sterling pound. Okay, so it works very well on news, obviously, right? Because news start the highly volatile market. Okay, non-farm payroll, you name it, all kinds of news, openings of sessions, and they're very difficult to create, believe me. If you think as a manual trader, while you're going to catch a breakout, then it's akin to you just being in front of the screen and you decide, okay, I'm going to catch beers now, and tomorrow I'm going to catch rabbits, and that's not the way to trade. Okay, I insist again, you need to predefine the trading family before opening the screen, or open the screen and say, okay, today I'm going to look for breakouts. And if you have robots, it's even easier because they will decide when there is a breakout or not. Okay, in this trading family, the filter is a key part. Why? Because there's a lot of false breakouts. What is a false breakout? Basically, the price seemed to break out from the range. I'm going to show the former drawing I did. Okay, here you see it, right? It seemed to break out, but not. It went back to the range. And if it did go back to the range, it's called a false breakout, or FB, or FB or FBO, whatever term you use. Okay, so these are really causing you problems in this trading family, and you need to be very aware of that, and you need to be very good as an automated trader, at least, to create good filters for that. Okay, so breakout systems are comparable to the defender in a soccer team. I'm not favored for any team in the Premier League, okay, but they're the opposite of the range systems. They are traded the opposite, and we can see this clearly in the drawing I did before. Whilst in the breakout system, we are here trading basically a buy trade. Let me draw it real quick. Right, we would be expecting the price here on a buy trade. It could be a limit order or not. On the range system, we're expecting the price here on a sell order. So you can see very clearly they're exact opposites. So you need to trade always. You need to have always a defender and a midfielder together, because that makes you stronger. In other words, you need a breakout system with a range system. Okay, and we'll see later, you need a scalper with a trend system. That are the perfect matches in this team work, and we'll be talking about it next Saturday more in detail. So the problem with this is that we have a lot. Breakout is the most traded trading family when you trade futures, especially in automated trading systems. And we have a lot of streaks of bad breakouts or false breakouts, and that's the problem with breakout systems. And as I said, the filter is crucial. Okay. Let's go to the next one. And here we go. And the curve of a breakout system is basically very noisy. You can get a lot of good breakouts and suddenly a lot of false breakouts and good breakouts, false breakouts, and it would look very noisy. And you'll have streaks. You'll have like highly volatile markets which break out very well, and very flat markets which create a lot of false breakout in a row. That's how you detect these curves. Okay, they're very rough, they're very noisy. The holding times are medium. We are talking usually about 5 to 15 hours in the trade. Okay, and everything below 5 or below 3 hours, it's scalping. Okay. The breakout is very strongly used in the Forex market between sessions. Like we are waiting on the European session for the European opening to break out the Asian box, we call it, or we are waiting in the American session to break out the European range, or we're waiting in the Asian session to break out the American range, which happened before. More about it in next Saturday. Okay. The range systems, the duckies, okay? I hope you are not falling asleep like this duck is falling asleep here, okay? So they usually have a medium target ratio, okay? That means that the TP, the take profit, is similar to the stop loss. The ratios are only within this range. I mean, we're trading 2 to 1 to 1 to 2. I always put the stop losses on the right side. I divide by stop losses, so that's earnings. Okay, and here on the right side we're talking losses. Okay, the market is ranging 70% of the time. That's great. So the more range systems you have, you can build your team very strongly on the midfield. Okay, and because the range system you will see now is the midfielder in the soccer team, and they're very difficult to create. That's the only handicap, really. I wish I could tell you, oh, we can create very easily range trading systems, but that's a very difficult trading family to create. Okay, here what is important is the distance between the take profit and the stop loss, because this will make you either lose money long term or earn money long term. That's the most important thing you need to look at when you're creating range trading systems. Okay, I compare it to the midfielder, and these are again the opposite to the breakout trading systems. And as I said, difficult to detect. You need to wait a little bit to know for certain you are in a range, and they're very difficult to optimize in MetaTrader. They're not so easy to find the parameters for, and that's really one of the flaws of this trading family. So the ratio is very important. Keep this in mind, okay? When we are talking about range trading system, or somebody is explaining you a range trading style, you can call it trading styles or trading families. I prefer families because in every family there is the sub-families. Actually, counter trends can be part of range. We can trade in counter trend in range systems. So range systems have a lot of sub-families. So I prefer to call them trading system families than trading styles. Okay, style is a very vague word. It doesn't mean anything to me actually. Okay. So the curve is very varied. I cannot draw a curve for range trading systems. Sometimes it's more neat, sometimes it's not neat, but usually the lines that go up and down in the balanced curve are similar because we have a system which has similar take profits and stop losses. So this down point is similar to this up point. That's the only way I could detect them visually, but actually there is not one single curve for range trading systems. The holding time, we are usually talking about range systems from 20 to 40 pips, right? Something in between. Below 12 pips, we are talking scalping. Above 50, 60 pips, it would be swing trading or trend trading, actually. And so it's in the middle, okay? That's why it's a midfielder, okay? They're very extremely difficult to create. It takes a lot of time. You need to really be very good at the markets to master range trading. Scalpers. Here we have the funny rabbit. They are very fast, right? They can hide very fast, and if you don't shoot in time, you never catch them. I'm not a hunter, okay? It's just one example. I'm not so much into hunting, but I thought it's a very good way to depict what the trading system families are. And once you leave this lecture, I hope you remember the elephant, you remember the bear, you remember the ducky, and you remember the rabbit. And that will make things easier for you to remember that you need to define what animal you're looking for. You probably need a different shotgun, and you probably need a different time of the year, and you probably need a different area to hunt them, right? These are the three elements actually in trading. The right time and the right timing. These are different things actually, okay? So the right time could be taken to the right place, right? If you go to Africa for elephants, you're in the right place. And if you go for bears to Siberia, you're in the right place, not the other way around. Scalpers, okay. Scalpers have always a short ratio. I mean, don't let them lie to you. There's never a scalper that is, they take profit. Some people say, oh, I put the stop loss at 10 pips. I never saw a trading system that works just with 10 pips stop loss. It doesn't exist, not in automated trading. So I don't believe it exists in manual trading. But usually the take profit is much shorter. That's the meaning of the symbol here, than the stop loss. We're looking for at least 1 to 3 to 1 to 5. If you have, for example, a trading system that has the stop loss at 300 pips and you're going for 10 pips, that's a ratio of 1 to 30, don't trade it. Okay? There was a actually very famous trading bot. It was called Overdrive. It was trading on the cable, okay? The sterling pound against the US dollar, called the cable, and it was optimized on 10 pips against 300 pips. I mean, if you're trading a ratio of 1 to 30, which is crazy, of course it sold very well. It was right 95% of the times, but once it hit the stop loss, you lost the earnings of 30 trades, meaning you lost the earnings of 3 months, 6 months on your trading account. It's the same as having no stop loss, actually. So don't trade further or beyond 1 to 5 in scalping systems. Okay, you're lying to yourself. When you can scalp in all trading market characteristics. You can scalp in trends. You can have scalping trading style in breakout, or you can scalp in ranges. What is actually scalping? Everything which is below 10 or 12 pips, right? That's actually scalping. If you want to clarify where the term comes from, just go to Investopedia and it will explain you what is actually scalping. Okay, I'm not going to explain it now. So they're very easy to create. It's very easy, at least in Forex. Also in indices like the DAX, it's very easy to create a scalper. Okay, but it's very difficult to maintain. It's like a striker. Strikers you can find for your soccer team. They're expensive. Okay, but they're different to maintain. They're moody. They think like the superstars. They are the superstars, right? Same with scalpers. You can have an incredible streak. I don't know. There was discussions here about Ronaldo, right? Is he still as good as before? Should we pay this price for him or not? Right? Same with scalping. You know, you never know when they're finished as a trading system. You never know when they're broken. It's difficult to decide. You fall in love with them, and suddenly they don't work anymore. Okay. What's crucial actually in a scalper is the entry point. Okay, it's very similar to the striker. Why? Let me show you. Let me depict it here with a picture. I think it will be faster, and you will understand why the entry is so important. Let's imagine we have here the gate. Okay, as I said, I'm not a hunter, and I'm not that good in soccer either. So maybe you can correct me. But imagine Leo Messi is around here, and he can shoot, right? Somewhere there is Casillas or whomever. And what about he runs a few meters and he shoots from here? So do you think the entry is crucial? The entry is everything in scalping. The 3 meters make the difference, right? The closer we are to the gate, the better the entry, the higher the probability we have success. So we're talking in scalping at least 70% success ratio. Why? Because we have very good entries. So in scalping, every pip, every quarter of a pip is crucial. Okay? I hope you got that point, because it's a very important point. Okay, so scalping systems are comparable to the striker. Here we have Leo Messi. They are the total opposite of trend systems, and they combine perfectly with them, right? The minimum you should trade is a scalper and a trend system together. That's actually the offer we have with Atsi Trader if you open an account, but I'm not going to talk about it now, only at the very end, okay? Or next Saturday. So the problem with scalping is that you trade a lot, so that creates a sort of an addiction, okay? I tell you, I've been doing manual scalping full time as just for 1.5 years, and it's very addictive. They're very easy to optimize, the scalpers, and they break very easily. That's not that good, actually. And the entry is very crucial. How far are you from the gate, from the ideal, from the optimal point to shoot? That's the gate, okay? The certainty of success. The curve is very characteristic on a scalper. We actually have a lot of winning trades, more than 70% in a row. Winning trade, 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 stop loss. And the stop loss takes at least 3 or 4 or 5 winning trades. And again, we start a new streak. Winning trade, winning trade, winning trade, winning trade, stop loss. You can recognize very easily this curve is the total opposite to the trend system, which is 1 winning trade, stop loss, stop loss, stop loss, stop loss, 1 winning trade, stop loss, stop loss, stop loss, stop loss. And if you imagine visually and you combine both curves, now you will understand why you should always trade scalping and trade systems together, because you balance both curves out, the drawdowns, and you get the ideal trading combination the dream team, okay, which is a trend system or the trend system family together jointly with a scalping family. Okay, that's the reason. It's the same as having 1 goalkeeper and 1 striker. You can start playing football, right? Even if you play around the corner down in the park, but you need at least 1 goalkeeper and 1 striker to call it football, right? Or soccer. Okay, so they have very short holding times, usually below 10 to 12 pips, the target, okay? And there are on average 1 to 3 hours in the market, depending on the pair. Some pairs are faster. The pound against the yen is a very fast scalping pair. And the euro dollar is average. The cable is quite fast. Okay, if we're talking minutes, we are talking actually about low latency scalper. That's a subfamily. We also call those in our education ultra scalpers. These are scalpers that trade in the minute time frame. Okay, they're easy to find, they're easy to create, and they're very, very difficult to maintain. Okay, easy to find scalpers, difficult to maintain. So we have all 4 families. We covered all of them and managed in 39 minutes. I thought I was never going to manage. Okay, and we can leave the 5 minutes we have still for questions. I just want to show you the next slide. That's what many traders do. It's kind of a joke. Okay, I hope it makes you laugh. If you only trade trend systems and you trade a lot of them, or the same trend systems on a lot of pairs, or the same trend systems on a lot of stocks, or on indices, or whatever, what happens is this. You got a lot of elephants, and it may run well, right? I don't know if you appreciate the GIF, if it's moving on your screen or not, or it may run badly. We lost an elephant there. I don't know if you could see that. Okay, so don't trade only trend systems. That's my recommendations. Please understand there's more animals in the field to hunt, and don't specialize only in trend systems because it's easy, because it's the easy thing to do. You need to learn to trade more things if you want to become a pro trader, actually. Okay, so if Simon, if you want to ask some questions, or we have time for questions.
Yeah, we've got a little bit of time. Thank you, Pablo. That's great. I'm amazed that a Madrileno would use a Barcelona football player in his slides.
Yes, yes. Actually, I was I was starting to do that, but I thought
a cardinal sin. But
it's really a crime. I know that.
well, fantastic. It's a very interesting subject, Pablo, and I love the graphics that you do to bring it to life. With the animals, it's fantastic. We do have a few questions that have been sitting. So I thought we'll wait and we'll come back now to them. So Doriel, he's asking, is your trading robot, does it include all the patterns that you're talking about?
It includes only two. Well, the offer we have is if you open a live trading account with AxiTrader, you will get a trend system and a scalper together, but still you need to learn to optimize it for the different pairs. You'll get two patterns only, trend and scalping, for free, actually.
Okay, thank you. And does it work with MetaTrader?
It does. It does. Actually, I have here, I opened here AxiTrader's MetaTrader. I'm going to show you on the screen. I don't know if we see it in the full screen or not, or I need to just cut the video later probably. Let me just do it properly.
No, it's fine. We can do that. Yeah.
It's better if we have the right size, right? Just give me 1 sec, and I prepare that properly. Okay, here we go. Basically, what we train people, and I really strongly recommend you come next Saturday, because this was only an intro and it was only 45 minutes, and next Saturday we'll have another 45 minutes to develop this topic further. And I really consider this is one of the crucial topics in trading. I don't care if you trade stocks, indices, futures, forex, or whatever. You need to distinguish the trading families code. If I tell my students, if I wake you up or your wife wakes you up in the middle of the night and she asks you scalping, you need to say immediately entry. If she asks you trend systems, you just need to say immediately exit. If she asks you breakout, you need to say immediately filter. What's the crucial point on every trading family? Okay, and that's actually what we teach. And I'm going to show you the bot in action. It's just here, and it's a MetaTrader bot. And the only condition we put for this is you need to trade. You need to open a live account with a broker, and later on I can explain you what our education consists. And we have many people coming actually from London. I have pictures here. In just 1 minute, and that's what this was actually one of the last. This was one of the lectures that we did, and Simon collaborated with us in one marketplace in front of Bank of England, big crowd. We were the last year a lot of times in London, and always Simon was helping us with the promotion. And this was one of the English groups that came to Madrid. This is actually our terrace and our training lab, and we have all kinds of people, and there's professional traders like this gentleman here. He's managing funds in London, actually several million, and they came over just to get the full education with us, and it's a 5-day course. It's very intensive, and you get the whole thing. You get robots for all kind of patterns, also for other trading families, not only for scalping and trend systems. Okay, so this is a bit what we do actually. So more questions?
Yes. No. Stuart says, wouldn't combining breakout and trend systems enable you to get into a trend early? For example, a breakout occurs and this would be followed by a trend.
Yes, it's all a question of the exit, and basically what you are asking about, I forgot your name.
Stuart.
Stuart. What you're asking about is about the trailing stop. Basically, what you're asking about here is about position management. Is where do I exit? And the solution for that is a good trailing stop, and that's very difficult. In the free system we have a trailing stop that exits by volatility. It detects when the market is less volatile after a strong impulse, and then it moves the trailing. Basically, it has a very smart filter that decides, okay, now the market is more calm, but we had an impulse. It's the moment to move the trailing stop a little bit further. If you're not acquainted with trailing stops, I can make a small drawing, and I don't get the paint to come to the other screen. So maybe I'm going to draw it up here, even if it doesn't look so nice or so neat. But basically, the trailing stop is moving the stop loss in your favor. Let's say you would have here a buy trade, and this is the stop loss here. Obviously, it's below because you have a buy trade. And let's say imagine the price would go in your favor, and you start moving the stop loss. Usually, the manual traders do it below the next low, and they follow the trend. And moving the stop loss in this direction is called a trailing stop. Okay, but what I want you to understand, Stuart, is trend trading and breakout trading are different animals. Let's not mix them. Okay, we need to know beforehand, are we looking for a breakout or are we looking for a trend, independently on how far this breakout goes. Okay.
Okay. What languages, what code languages do you use for the robots? Asks Wang.
MQL4, that's the standard. It's very similar to C, and I would say MetaTrader is the office of automated trading. I mean, 90% of the automated traders in the world are using MetaTrader. So it's a decision like saying, well, I want to do a spreadsheet. Well, should I do it in Excel, which everybody's using, or should I do it in Lotus 1 to 3, which nobody's using? I mean, my answer is MetaTrader. I mean, you can get free manuals, or you can write us, and we can hand over a free manual on coding. But again, coding is not so relevant. You need to learn trading first. I mean, we don't teach coding in our courses. We teach trading system analysis. Mm-hmm. That's what I did now, actually. I just opened your mind, I hope, and told you, okay, there's 4 different animals. Watch out. So this is the first thing you need to learn. Coding can be done inexpensively in Eastern Europe. You can find coders in Russia, Romania, Bulgaria, Ukraine for very little money. You can code for £40 a trading system. Really, that's really inexpensive.
Mm-hmm. Walter is asking, what is your favorite trend following indicator? He uses the ADX.
ADX is not bad for the entry, actually, more than for the trend following. I would say that modified moving averages. I don't know if you know the super trend. Super trend is modified moving averages, which does very well. There is another one which is called DEMA. It's the double exponential moving average. This serves quite well for following trends. And we did several systems with super trend. And another very good indicator for trend systems is the CCI. I think CCI is much stronger than ADX, actually. I use ADX more in breakout systems. See? That's actually a very good question, because it's all about the topic I lectured today, right? And when we have the wrong shotgun, right? I'm not saying ADX is wrong for trend systems. No, by far not. But CCI is better. Okay. Why do I know that? Because we did over 400 trading systems and we studied over 1,000. I'm doing this for the last 9 years, right? So I've seen a lot of trading systems, and I've seen CCI to work better in trend systems.
What about the full optimization result graph for the 2 experts? Dorio's asking.
I recommend really very strongly. I'm going to put here our YouTube channel, because today's topic was not about optimization. I know you guys want to know everything in one lecture, but it cannot be covered. And I just give me 1 sec. I'm going to put here our YouTube channel. Actually, you can look for it, the FX method. You look for it in YouTube, and it will show up. But I'm going to put the link here. And there we have like 5 videos of 1 hour on optimization. I just strongly recommend. Several of them actually were lectures with Simon. He has also several videos of us in his channel, and I just strongly recommend that you watch those and get a better idea on optimization. You know, because it's a very, very, very complicated topic, actually. Here's the link of the YouTube channel. You can have a look at it, and you can subscribe, actually, and you'll get videos for free.
I'm just reposting that link, so we'll go to everybody. Yeah, there we are. So everybody has that link to the YouTube channel. Fantastic. Well, Pablo, maybe just one more question. What is the approximate numbers of line of code in each expert? and again, we're maybe getting a bit technical with some
I got the question, yeah. Regularly, if we look at a good trading system, I hope I can show you here Augmented Trader again one more time, not less than 500 lines. Probably you're a coder, and the person who asked, I'm curious, probably it's a coder asking programmer. Are you a programmer? Just by chance. So normally I would say beyond 500 lines. The super simple trading systems will not work very well. They will not make good money. And the hyper complex trading systems will not work either. So I would say something around 500 to 1,000 lines of code. That's usually what I've seen works best. But you can have surprises of less lines of code working well. But I would say on average we're talking 500 lines of code. I wanted to open a trading system actually and show you how many lines of code it has. It's kind of technical, but it's maybe one example. If you go here to the expert tab in MetaTrader, I don't know if you see it here, and we open it here with modify, we'll have immediately the code. If it's an open source code, but if you bought it, normally they don't give you the source code because they want to keep the property rights of the trading system. And you can check here how many lines of code. That has around 2,000 lines of code. That's a very long trading system, right?
Okay. Dario is a programmer. Yes, I am a programmer. Will the code be given? I suggest probably drop you an email.
No, the code not. I will give you the EX4. I will give you open. The trading system is tradable in all brokers. We don't lock it only for AxiTrader, but you need to open just send us an email and we'll clarify the offer. But you can trade it unlimited. I mean, we don't have a limited time. We don't force you to trade in a certain amount of lots. You can trade it freely. But we don't give you the idea behind it. If that's the question, it's our copyright. I'm sorry. I mean, if it's a free offer, I cannot give you even the whole source code. I hope you understand that.
So, Pablo, with these robots, how much attention should you need to pay as a trader? It can't be as simple as setting up and just letting it run on its own. How often should you be checking and revising and amending?
It's actually not. It needs a lot of attention, and to be honest, everything in life needs a lot of work. I mean, I know there is a lot out there, like there was 4-Hour Work Week by Tim Ferriss, and a lot of books in this direction, no? And everybody's thinking passive income, which is great. But let's be honest here. I mean, passive income takes a lot of work. I mean, we are 9 years developing, we are 9 years working out, and still we need to watch at the trading systems, and it takes work. I mean, that's the plain truth. The only benefit, well, I wouldn't say the only one, is the psychological one. I mean, we have a clear control of the results. We have a clear control of the risk levels, right? And that's very good. I mean, in the sense that we know what to expect. We don't have surprises like what's going to happen. I'm going to show you a real account of one of our students, actually. Audited real account. I normally don't do that, but I don't have a problem with that, actually. As you can see, it's a real account with an initial deposit of $5,000, and they made a 60% result in 10 months with a which is a 5% monthly. And they paid their full education with the trading, okay, and they made even up to 100%. And what I want to show you is that the risk level was extremely low. They were risking only 16 euros on $5,000. That means that's actually a 0.3% risk on the trading account. That's actually what we teach, and that's really amazing. I mean, risking a 0.3%. But I need to be honest, that's above 25 trading systems together. That's actually like a double team of soccer. That's like 22 players. You can see that here. They were trading all kinds of things. They were trading all kinds of pairs and indices together. And that's how they managed it. And you can check the account. It's open in MyFX Book. That's like a free auditor. MyFX Book is like the Facebook of Forex, right? Where people share their accounts. It's like social media. You can write people, you can contact people, you can check and everything's audited, right? So, but it takes a lot of work. I mean, it took them 1 full year of studying, of developing, and they were coders. I mean, but even people that don't code, they can get there. I mean, with our method, we teach them from A to C where to find the bots, how to make them if they want to make them, or how to find them. You don't need to code at all. You can find good bots and re-optimize them and just combine them. If you know that you need to have at least 1 elephant, 1 bear, right, 1 duck, and 1 rabbit, that's the minimum. So you have 4 players, and you combine your soccer team. And that's what we will be talking about next Saturday. How to make the dream team, actually. How to get this right combination of players. But it takes time. I don't believe in easy solutions or 5 minutes set and forget trading styles. I don't believe in that.
Fantastic. Well, Pablo, I think we're just about a few minutes away from the top of the hour. I will say thank you very much indeed for coming and joining us and telling us all about the expert algo trading robots. It is great, and I'm so delighted that you're able to come across a week on Saturday. I know it's a longer trip from you coming specifically, but make sure that please everybody come and attend Pablo's workshop, which will be at 4 p.m. on the afternoon at the Grand Connaught Rooms, just at Covent Garden there on Saturday the 5th of November. If you don't have your ticket yet, please go to roundtheclocktrader.live and use the code RTC001 to claim your free ticket, because you're a member of the gang now that you've been on the webinar. That's the code. Get your free ticket, and there is a wealth of information going on all throughout the day, including Pablo. We will be doing a 45 minutes to an hour seminar from 4 p.m. on the Saturday afternoon. So Pablo, thank you very much.
In person. Thanks very much, Simon, and meet everybody on next Saturday.
Wonderful. Okay, thank you, Pablo, says Doriel, and any other questions, we'll include Pablo's email address on the follow-up emails that we'll send out to you tomorrow. Okay, we'll take the presenter role back from you now, and we will swiftly move along to our 6 o'clock speaker, who is in the room already, which is great news. Ruben Miller from the Investing Academy. Ruben is a first-time speaker here on the Round the Clock Trader event, and also I'm pleased to say that Ruben will be joining us at our live event as well, a week on Saturday, that Pablo and I have just been discussing. So here is an opportunity to speak to Ruben, and if you like his style of investing might interest you, come on down to the Grand Connaught Rooms on the 5th of November, and you can meet him in person. So let's go across to Ruben. I think the microphone is off, and I can say good evening. Ruben, it's Simon Campbell here.
Can you hear me, guys?
I can hear you loud and clear, thank you.
Beautiful, beautiful.
Can everybody hear Ruben at home as well? You just use that little chat box to give us a yes. Fantastic. There we are. Yes. Yeah. Great. Everybody can hear loud and clear. We have welcome, Ruben, and everything seems to be running very well. But we did start off with a slightly unusually challenging webinar this morning. We had computers crashing and the internet was dropping out, so we had all the challenges. But since lunchtime, we've been running very smoothly, and everybody stayed with us, which is great. So a very engaged crowd. Looking forward to the presentations this evening. So we haven't actually met in person. I know we just got to know each other a couple of months ago, but I'm interested to see this is an investing school that you run.
Yes, exactly. Hello, everyone. My name is Ruben Miller, and I'm a market analyst, and I'm a teacher at Investing Academy International. I'm actually so glad to be here at Round the Clock Trader And I want to thank Simon for having me here. I take my position very, like my life mission. When when we founded Investing Academy, we've got a few top market analysts that has successful career as investors and doing very well, managing our portfolio and portfolio of our clients. And we've decided to fulfill our old dream, and is building a school that teach actually people from all around the world how to trade. Can you, by the way, see my screen?
Just if you have you should have a box asking you to confirm.
I did
There we are. Great.
Okay.
Now we can see. We're looking at the blue. We're looking at the Gold Investing Academy logo on the blue screen.
Exactly. I'll try to take it one step. Okay. So we've built it, Investing Academy, actually for people that want to keep their daily jobs and want to continue having their own daily jobs and life, and not to be addicted to trading. So probably this is talking to a specific crowd among you guys, and it was 3 years ago when we built it, and today I have to say we have hundreds of new investors and students, and we are very pleased and with our success, because I know that we are creating every day new people that have extra income in their lives, continue to be programmers and chefs and all kind of jobs, daily jobs, and still having the trades working for them. Now, today I'm going to talk about the best time to invest as I believe which is the report season. I hope you all get pens and papers, and we'll begin. The earning report dates, first of all, the earning report season is probably some of you know, every traded company has to release their quarterly report earning. In general, each earning season begins 1 or 2 weeks after the last month of each quarter. For example, December, March, June, and September. In other words, the companies need to release their earning in early to mid-January, April, July, and October. Here, these are when the report season begin. Now, one of the systems that we recommend on starting to trade a successful trade with the earning reports is not waiting for the date of the report, but actually start trading on that share, on the specific share or stock 2 weeks before. Why? Because usually you can catch the rally up with that specific stock that you're looking for, and to enjoy that rally up. Of course, we are talking on a buy position mainly right now. Maybe Saturday I'll talk about sell. I'm looking right now only on the green side of the of trading. Now, this is the information that can give you a little bit when to go in. Quarter name, the first quarter, the quarter months are January, February, March. The in point usually 2 weeks before the end of March. That's a good time to start trading. Okay, same to second quarter, 2 weeks before the end of June. Before the end of the quarter is a good time to open the position. The beauty of the trading season, the the earnings season is that it's very active time in the market. Okay, all the participants, analysts, traders, and investors review the earning reports, which may affect their trades and on those different companies and affect your trades as well. You can often see a lot of movements on the shares price. Companies release their reports, and markets react to the new data immediately. For example, here's an old time at the Amazon report. You can see that this is actually the day of the report. There was a pullback because there was a whisper. A whisper is a rumor around traders that there's a chance that the report won't be that good. But eventually the report were great, and you can see a beautiful rally started exactly 2.5 weeks before, which means that you can actually take a trade before and enjoy this rally up to here, when you can see this what you call an evening star, this candle. You probably know this name, which is a shift in the trend. I will show you exactly how to spot that, but you can see that we can have more than 20% of trading of profits around this specific trade. It is also highly active time for financial news media such as CNBC, the Wall Street Journal. There's an extensive media coverage of major earning releases before the and you can actually start tracking those shares and try to see which share do you prefer on trading. Many clients of mine always ask me, you know, wait a second, I want to show you, there's another slide, sorry. I want to show you another slide of Apple. You can see here, this is again an earning report. You can see below on the chart, it says the exact date of the report, and you can see that the report is moving very strongly later on. This phenomenon happens because actually at that specific time, many believed again that like Amazon, that Apple won't do that good on their earning, but eventually they did pretty good, and that was this the results. So many students of mine ask me, how do you know if this share will go skyrocket or fall? And this is exactly what I want to teach you today. Yes, getting trading skills is very much achievable, I think, if you analyze charts and revenue for the last decade, as I had the chance. You will get those skills by yourself, but I'm here to show you a few guiding steps of which, if you follow, you will get the same results as well. The first step will be finding the right shares and checking their analyst consensus recommendation. Today, as you see, I'm focusing mainly on shares from American stocks, because I want to have the same, you know, fields and area. But so I'll take a little bit look at the Nasdaq. From the high tech, we can look at Apple. First of all, I want to talk about something very important. Usually I recommend using a smart, diversified portfolio. To use a diversified portfolio is using at least one stock of every sector. Many people, traders and students that came to me and started trading for the last half a year, for example, usually when they see a very good chance on a specific trade, on a specific stock, they tend to put most of their money on that specific share. okay, or on 2 shares. And if you get the chance to read about the modern portfolio theory, you can check it out in Google, which was developed by the American economist Harry Markovich. But it mainly said, by the way, this method was a Nobel Prize winning method, but what it mainly says that you need to diversify your portfolio. You never put all your eggs in one basket. And I want to show you how, by having a diversified portfolio, for example, let's say we've got £5,000 portfolio, and we want to see how we invest our money according to the earning report season. So, for example, we can take the high tech, we can take Apple. On the e-commerce sector, we can take Alibaba, which the report is on the 2nd of November. The report wasn't announced yet. By the way, we are currently at the peak of the earning report of this period of the year, of the 3rd report. On the banking sector, we can take Bank of America, which is doing pretty good on its report. On the pharmaceutical sector, we can take Pfizer. And on the web TV sector, we can take Netflix, which you probably heard, because Netflix had a tremendous, that's the queen of this Q3, because it jumped in $20 earning per share the day of the report, because the report, the revenue was really tremendous, and it beat any consensus recommendation. But before we continue, we need few terms. This is our portfolio. If we take, by the way, the £5,000, every share, every stock, I recommend to put 1,000 on every of these shares, or any of these shares. 1,000 Netflix, Pfizer, Bank of America, and you, of course, you won't invest more than 20% on each stock, which means Apple, you put in £200, same Alibaba, Bank of America, Pfizer, and Netflix. The rest you leave for margin. Now, when you use 200 or 250, maybe 300, the rest is very crucial in order to maintain risk-reward management of your portfolio, in order to stay in the trade, because the earning report is a very volatile time, and volatile means profits and also means risk. Now let's examine a few of the terms that I bet most of you know, but is crucial for this time of year. The first term I want to talk about is beta. The beta is a measure of volatility of each share or company compared to the market as an whole. Okay? For example, the beta of Apple is 1.33. That means that it is more volatile in 33% more than the market. This is pretty volatile. It's not extremely, but that means that, for example, if the market moved 100% that day, Apple will move in a 30% more than the market. Okay, that means more risk, but usually risk also means profit. Alibaba is even more volatile. It is 1.58. On our portfolio, you can see that we have Bank of America which is moving less than the market itself. And when you're maintaining a diversified portfolio, it's very important to have low risk as well. Bank of America is not the highest risk, but is not, you know, is a medium risk share. It moving very confident with but very slow according to the market, slower than the market, of course. Pfizer has a zero beta. Zero beta usually means that it goes exactly according to the market. And Netflix has 1.72. This is actually why Netflix can jump in $20 per share, earning per share in one day. Okay, that means very, very big volatility. Now, another term that I think that we need to examine is, of course, the price-earning ratio. Now, the price-earning ratio is something is a term that shows you the ratio of valuing the company that it measured. It occurred to the share price relative to the earning price of the previous year. What does it mean? It actually means the multiple of every dollar. How much every dollar can profit of the market. For example, suppose that the company is currently trading at $43 a share, and its earning of the last 12 months were $0.95 per share. So the price per earning ratio for this stock could be calculated as 43 divided by 1.95, and the result is 22.05. This actually means that this specific, every dollar that the investor is investing on that is it's expecting to see a pretty nice result on this specific share. And the most important term that we need to see is, of course, the consensus recommendation. What do market analysts think according to the revenues? What do they expect this specific share to do? Now, why is it so important? Because according to the consensus recommendation, that is the result of the bidding of the consensus will be, which means, for example, if a share price or a revenue was the consensus recommendation was 1.95, but eventually it was 9.97, that means that the share will be very volatile up, and it will beat the consensus and make very nice profits according to that bidding of this consensus, and we'll deal with this in a few minutes. I want to talk about what happened in the last, in this previous year, in 2015 and 2016 shares, in order to have a case study to the future of few shares. For example, Amazon. Amazon is one of the most profitable shares in the American market, although it's very, very expensive and volatile. In NASDAQ, you can check in the website. I will show you later on all the URLs that you need in order to find the consensus about any specific share. But in NASDAQ in September 2015, you can see that the earning per share, the consensus was minus 0.01. Eventually, the earning per share was 0.17, and the surprise percentage was 270% surprise. That's amazing. Okay, and you can see the results on this chart. Now, if you really want to know the tactic, how to make profits out of this specific earning report season, here's one of the tactics that we teach in Investing Academy, and it's pretty easy to understand. And we are trying to build a system that you don't have to be addicted to the screen. You don't have to be all the time when you're at work or having some time, quality time with your family. You don't need to be addicted to the screen and check your trades every minute, and to open a trade that is more of a long-term trades. Now, the tactic is like this. We follow, of course, the trend. We take the pullback. We wait for a pullback on the price. We are 2 weeks before the earning report announcement on Amazon. This is Amazon. This chart is, of course, a daily chart. This is around 2 weeks. We are looking at the lowest price of that specific share 2 weeks before. We are waiting for that the rally to start again, waiting for a pullback, and then we are looking for a confirmation candle that the rally is really continuing, the uptrend is really continuing, and this is the confirmation candle. And this is the entry point, the in point. And we can see that on the date of the report, there was a very strong skyrocket on movement on that specific share. And this trade made on one lot a profit of 11,500 euros, and I will talk about it later. Now, a lot of people that come to my school and to our school, and we have branches all over Europe, in Amsterdam, for example, don't know how to calculate leverage. Okay, I know that for the professional traders of you probably say, what? Yes, but there are a lot of them that actually don't know. So I'm going to have a few minutes talking about leverage, because when you're trading CFDs, contract for difference, online, you need to really master this specific theory of leverage in order to understand your risk. Let's say that you're trading in a platform that gives you a share leverage of 1 to 20, and the share price is right now 120 euros. One lot, according to that platform, is 100 units. So the share price is 120, multiply the way to calculate the leverage, multiplied by 100 units of a lot, and divided by 20 of the leverage, which gets us to take the share price and multiply it by 5. In order to buy this specific share, a lot, 100 units of this specific share, we need to have 600 euros. Remember, every dollar that the share is going into our direction, whether if it's a buy or if it's a sell, we are profiting 100 euros. Okay, this example is on euros. Of course, it depends on your specific account. what's the calculation? Maybe your account is in pounds. I'm located right now in Amsterdam, so I'm more used to euros. Now, every dollar that goes into your direction of trade, that means 100 euros. And why is that? Because you've bought a lot of 100 units. Okay? Let's have a look on those shares that did some nice movements this year. We will start on Chevron. Now, why am I taking this specific case studies? I want to show you how, by tracking something like 10, something like 15 shares, 15 companies, and knowing how to locate their specific news, and coming familiar with those companies, knowing who is the CEO, what's their next product in their drawer, what happened according to this last quarter. This will get you to understand and to know those shares very good, and to start to have a very good forecast on that specific shares that you are tracking. And it's very important to plan that a little time before every earning report season starts, because when you do that, you will see that you actually know to predict what, for example, let's say you're talking about Tesla, which earning reports did very well. For me, somebody who likes Elon Musk, the CEO of Tesla, and I really love his way of thinking, which making electric cars and thinking about how to reduce the use of oil in this world. It's no surprise that Tesla is doing so great, because this guy has a vision. He knows exactly what he's doing. He's working according to a plan. For me, that was no surprise that Tesla had a very earning report announcement yesterday. So what I recommend that every one of you will track his own favorite companies and go according to and follow those companies according to a favorite product that they have. For example, your favorite car, or your favorite supermarket, even Walmart or something. So I want to show you a few of those shares that we in Invested Academy have tracked for the past year. Chevron is a US-based oil and gas company. This is Chevron in 2015. You can see it's a daily chart. You can see when it gives its dividend. Now, according to the consensus, the forecast was 0.79. You can see that eventually the earning report was much better than the consensus, and the surprise was 37.97%. So how can I plan my strategy according to this? I know that we spoke about starting to trade on this specific share give or take 2 weeks before. So I know that I'm 2 weeks before the end of this quarter. I'm waiting for the right time to go in. I see here that I've got this sideways movement. You can see that this is a very strong resistance and very strong support. And I know that the report date is around the 5th of November. Now I'm waiting for this morning star to really show me that this is the time that the rally will start. And after the confirmation candle that we saw in a previous here, you can see it here. This is a confirmation candle. Actually, this is more of a confirmation candle. This is called an ochre, a green ochre, because it in the Japanese candlesticks, you can see that it's what we call a swallowed the previous red candle. So this is more of a confirmation candle. But once you see that the resistance was broken, we can take this trade. And this is the report date. You can see that after the report date, it gained beautiful $6 earning per share. And I usually recommend that to a few days after the earning report to close the trade. Why exactly? Because usually a lot of 30% of the investors want to see their profits few days after the earning report is released, and you will see that there's a little pullback starts, and it's a shame, you know, to have this a little loss in your profit. This went by 20 points. 20 points in one lot is $2,000. Again, let's see how simple it is. The share price was 76 actually dollars. We multiplied by 5 in order to buy one contract, 100 units, which is 380. We have one lot, and the share went up by 20 points, and that's the $2,000 profit. Remember that, of course, we can have 10 lots and make it 20,000, but this leads me to the talking about margin. Margin is one of the most important terms I believe beginner traders should understand, because margin, to know how to manage your margin right, is the basics of risk reward managing. Let's talk about Goldman Sachs. Here's Goldman Sachs also in 2015. And I want to again repeat on how do I manage and plan my trade. I see that the quarter ends here. I'm waiting for the pullback before the quarter ends. Why is there always a pullback? Many investors has different theories about that. That's actually some little fear of traders, of investors that think that maybe the share didn't do that good, and they pull and sell few of their shares on that specific trade. But that's actually our chance to get on this trade, and this is exactly what I'm trying to show you. So I'm waiting for that pullback, looking for this opportunity to check if this rally begins. After this beautiful confirmation candle, I'm taking an in point. That's the report state. You can see a beautiful climax. And if I'm risking and waiting exactly, of course you can check this. I'm not dealing today, this is more a fundamental webinar, I have to say. I'm not dealing how to check it with the RSI or Bollinger Band or whatever favorite indicator that you have. But of course, I have to say that if you are trading according to our theory and our beliefs in Investing Academy, you need to have one fundamental information and at least the three indicators saying the same thing. For example, Alibaba 2 weeks ago had a bullish, bearish diversion. Alibaba was going up very strongly, but the RSI was showing a different picture. And once you have it, and you see that the RSI is giving you a bearish diversion, it's showing you that no, this, what you see is not really what's going on and the beliefs of the investors. We recommend to check all those indicators that you used to, at least 3 indicators. And if, for example, the RSI is showing you different picture, don't take the trade or don't stay on the trade. Take your position out. This is 20 points up. Let's talk about Johnson & Johnson. Again, about our diversified portfolio, you can see that I'm choosing very different companies, the most successful ones, but different sectors of shares. Why? Again, because I want to put my money in different fields, in order for, if one of them is losing, the other one will protect my portfolio. I don't know how many of you were already trading in 2008, but I remember 2008 very good, and I remember that one of the most amazed shares of that time, there were 2 shares that rose and skyrocketed when all the shares were crashing. All the other shares in the market were crashing, and that was Walmart and McDonald's. And think if at that time, when really a lot of banks and firms went almost bankrupt and even went bankrupt, at that same portfolio, you had 30% or 20% shares of Walmart and McDonald's. How you could save yourself with having those percentage and preventing a bigger loss, because you had shares that are not in the risky field of high tech and banking shares that went crashing. So we see a fundamental highlight in the CNBC. It doesn't matter for right now what it means, but we know that there's going to be a growth in Johnson & Johnson. I want to talk about, again, the margin. I look for that slide, and here it goes. I believe that a successful margin is a successful trade is usually means a good margin, trading with margin. And this is a simple, really beginner's way of me teaching how to use margin. When you have a share price that costs you $1,000, usually have margin of multiplied by 3 of the amount. Okay? For example, if you invest 1,000, you decided to invest 1,000 on that specific share, whatever share it is, you need to have an extra 3,000 in your account that you don't touch. That's the margin. That's protecting you. That's preventing your loss. Again, that's different with from Forex and currency way of thinking, because I'm not talking right now about stop loss. I'm talking about leaving the trade open so you can have enough margin to protect you below. So how we can use margin with Johnson & Johnson? Again, the fundamental information. We can see the date. We can see that you are here for this example. This is when the quarter ends. Again, we've waited for this specific pullback. That's the Q report. Now, if Johnson & Johnson is $93, in order to have one lot, we need to have $465. I apologize for the euros, but let's say it's dollars. And we can see that the RSI is showing us the same picture. There's a beautiful uptrend in the RSI, although the share price is actually going sideways. And here it's breaking the 50 line. We have the confirmation candle, and we took the in point. Now, we said that we need to multiply it by 3 in our account extra to have enough margin. That means that in order for me to start this trade, I need to have 1,395. Why? And now I explain exactly why do I need that. Let's say that I took this trade and it begins in $93 per share. The price is $93. And I'm protected actually till the $80 per share. That means that the trade, that the share can actually go down and up and down and up and down and up till the 80 line. I'm very, very much protected. Okay, this could be a pullback, and this could be I don't know, you know, maybe the Nasdaq will go down a little bit, but still I'm in the trade. Now, this, of course, is after you checked how volatile, what is the beta of that specific share. You need to see that this share could never crash in 10 points in one day. And this is when you continue trading till the announcement of the Q report. And you can see that this beautiful trade have made us $1,000 for every lot that we have. Let's look at Alibaba. By the way, Alibaba is one of the shares, the stocks that didn't have earning report announcement yet. Their earning report announcement is scheduled to the 2nd of November. On a Saturday, I'll probably talk about Alibaba because it will be post that specific announcement. Again, this is 2015. We can see Alibaba surprise was 18.75%. Again, let's plan the trade. We are here, and the Q report is over here. Now, we are waiting for our pullback. We see this morning star, sign kind of a morning star. This is considered to be our confirmation candle, although this is more the confirmation candle, of course. We take this in point and we take all the rally up, ignoring this pullback. You see this pullback? We ignore this pullback. Why are we ignoring this pullback? Because according to our system, if we plan our trade right and we are on $60 over here, our margin would protect us at least till 45 below. So whatever happens, it won't reach that price. And if we have this, if we took this trade from here till up over here, the margin is growing and growing, and we are more protected, and we can take our profit and open another trade on another share. Now here I want to show you an out point. Of course, this is what you call the evening star. Right afterward, there's a confirmation of a trend change. 23 points. Let's check LinkedIn, ticker symbol LNKD. But first, I want to show you where you get the report information. If you go to nasdaq.com/earnings/report and then you write the ticker symbol, you will get all the information you need according to that specific share. Okay, for example, if you want Facebook, this is the URL. You write nasdaq.com earning report and then FB, which is Facebook's ticker symbol. If you want Alibaba, Alibaba symbol is BABA. By the way, there's another Alibaba in India, so check that you're not mistaken, but this Alibaba. Apple is AAPL. Again, BABA for some reason. And here's LinkedIn. You can see this is a screenshot of Nasdaq. You can see, by the way, this is, you need to look at that because this is February. This is previous quarter report. Okay, this is not the one. The consensus right now in LinkedIn is different. It's not strong buy. But here you can see that the consensus recommendation is a very strong buy on that period of time. It's over. Don't make that mistake. Check it before you decide to trade LinkedIn. Again, waiting for the right moment. Waiting for the confirmation. And taking this trade. Now, of course, the who view that is more safe and secure than trying to protect themselves, this could be more of a confirmation area than this, because here that you can see the Bollinger Band is showing us sideways. So it was smarter to start here and not over there. Actually, that would be the end of this webinar. If you want to join us for a lesson, we have a special offer with Investing Academy. We have a nice, first of all, I would love everybody to come on Saturday, November the 5th, and meet me in person. And if you don't have that chance, you can register to our Skype lesson. We have a private Skype lessons that you can register. We have a special offer. It's pretty easy to register. It's 3 steps that you go in, fill your details, choose your wishful trading topic, and schedule your specific time. It costs only $10 for two lessons. This is how our web page. And this is my private email. You can write to me any questions regarding this webinar or Saturday's seminar. I hope if there are any questions, I'm free to answer.
Okay, thank you, Ruben. I'll put that link in the chat box, so Investing Academy /Skype-steps, so people can go to the website. So thank you for the presentation. I mean, clearly it's a investment approach
Exactly.
that you prescribe. It's looking at the lessons of portfolio management, diversification, and just being aware that how that sort of balanced portfolio can help you out when the market goes down in one sector.
Exactly. I have to say that we are right now in the middle of a very, very unique earning report season, because few of the companies that actually announced a very good report crashed, or the rally didn't start at that day. And we'll talk about it Saturday and explain why exactly that happens, because this usually happens when the share price already reached its highest peak, and you can be aware of that, and you can be aware that, for example, Apple reached $118, and once the announcement of the report, which was pretty okay, not maybe the best, it went up down to 115 and even lower. And this usually happens when the share is around its highest peak, and you can see that before you start the trade, and you can be protected, and when you invest your trade according to your plan, as I showed.
Okay, fantastic, Ruben. I'll take it back now. Thank you very much for the presentation, and we will look forward to seeing you on the 5th.
Okay, great. I will look forward to. Thank you.
We will do. Thank you very much indeed. Okay, thank you, Ruben Miller there from the Investment Academy. And just while we're on the topic of the live show, we've got a few minutes before our next speaker, Andrew Keane, will be joining us. If I could just drag this window across here, I believe you should be able to see the website of the event that we've been discussing. And if you've not already been to pick up your ticket, if you're in the UK or can get to London on the 5th of November, this is the event. So just to show you, this will be what you find when you go to roundtheclocktrader.live. Registration there, enter promotional code. This is where you will enter the RTC001 code, and that removes the standard charge for the entry, and that gives you access to this amazing day that we've organized. 5 rooms, the FTSE Theatre, with people like Dr. Andrew Lumsden-Groom that we heard from today at lunchtime, Nicole Elliott from the Society of Technical Analysts, Rishi Patel from Master of the Markets, Charlie Burton from Easy Trader, David Jones, the ex-chief market strategist at IG, Paul Wallace from FX Trader Paul, Adam Harris from Trade with Precision, Alex Spiraglu, who's spoken many times before, Malte Kov from the Leadership Council of Traders. Again, just so many speakers. Steve Ruffley that we heard from, Alejandro Zambrano, Corvin Cardula, David Paul, Stephen Goldstein. Really, they're all here. Francis Hunt, who we've been heard of today, the Lazy Trader, Rob Colville, Himal Pandya from the Alpha Trading Floor, Ruben Miller, who we've just heard from now, Zaheer, who's talked today, Mike Hamilton, and really Alex Ong, Traders Corner, Steve Ward, of course, for the people interested in the psychology of trading. Steve's one of the biggest names in that field. George Hallmey from Click Events that spoke earlier today, and of course Pablo, who we heard for just a couple of hours ago, Pablo Ortiz from the FX Method. So really, it's quite a fantastic day, something for everybody, and there will be a little exhibition hall as well where you can go and mingle and chat with the speakers in between. Nearest train station, Wayne, will be, well, the two tubes, either you can get off at Holborn or Covent Garden. We're very central, and the venue is called the Grand Connaught Rooms, which, as the name suggests, are quite grand. Marble staircases and black and white floors and ornate ceilings, all part of the experience at the event. So yes, so Saturday the 5th of November, I hope you can all join us there. Currently it looks as if there's going to be 700 or 800 of us all getting together for the day there, which should be fantastic. So looking forward to that. Oh, back to the webinar tonight, and we still have two speakers left to make their presentations on the live event today. This is Round the Clock Trader. If you've just been joining us over the last hour, we've been listening to Ruben Miller from the Investing Academy. My name is Simon Campbell. I'm the host for this Round the Clock Trader event, and it's good to have you joining us. As an attendee, you'll automatically get a copy of the recordings of the whole day, just as soon as we can put it all together. So aiming for tomorrow afternoon or tomorrow evening at the latest for that. So we look forward to welcoming still two more speakers to take us up to our 12 or indeed 13 speakers it will have been today. We had an extra presentation at lunchtime. And I can see that Andrew Keane is already here in the room. He's already checked in. So we'll go across and see if we can talk to him now and take the microphone off, and then we can share screens for starting in just a few minutes' time. Hello, Andrew. It's Simon here. Can you hear me okay?
Yeah, can you hear me?
Oh, I can. Fantastic. How are you?
Good. How are you?
We're very well. We're very well. We had our technical problems earlier on this morning when we started this event. We did have a crashed computer, which was mine, which was never very helpful when it comes to live webinars. But we recovered and had a great day. We've had all sorts of trading, algorithmic traders, forex traders, and even looking at some more conservative investment strategies. Now you are an options trader. Is that the best? This is your favorite asset that you trade?
Yeah, I trade mostly equity options. I do trade a little bit of future and forex, but I've realized in my 14 years of trading, my most profitable is trading equity options, and that's what I've written my books on, and was on the trading floor in Chicago for 10 years trading equity options.
Now you'll know, because I know that you've spoken once before, I think, but it was quite a long time ago, and I think you mentioned at that point that you actually studied in the UK. So you'll be aware that we have spread betting here in the UK, and we use that in the same way that options are traded heavily in the US. Will some of the strategies apply to both options trading to spread bettors as well?
All my trading is basically it's equity based, so it could work in any stocks. I heard the presenter just talk about BABA and Apple, so you can trade it. You can trade stock the same way that I take my signals trading options.
Fantastic. Well, Andrew, let's go over do the screen share. I know you've done webinars before, so this will be nothing strange to you to accept to share your screen. Fantastic.
Do you want to make me the presenter so I can see questions, or no? If not, it's not a big deal.
Yeah, I can do that. You can do that right now. Make you the organizer. So you should be able to pop out the question box.
Okay, I'm good now.
Is that good? So everybody that you can type in, whereas I normally moderate the questions, you can get straight to Andrew with these questions now. So that's just on 7 o'clock our time. I don't know what time it is for you, Andrew. You're 2 o'clock in the afternoon, or are you which side of America?
So what?
Okay, great. Well, then I'll hand over to you, Andrew Keane. Trade with the biggest hedge funds in the world. Thank you for joining us, and over to you.
Hey, what's going on? How's everybody doing today? I'm going to start the presentation here. I'm going to show you basically how to trade with the biggest hedge funds in the world. I'll be presenting today, Andrew Keen. I presented a long time ago. As Simon says, I did study in England. I studied at Nottingham University for about 6 months, international business. I've been trading full-time for 14 years now, and I'll keep going back. So I trade on a Thinkorswim, and I trade equity options, and we'll talk about it later, how you guys can get access to all my trades. We send all of my trades via text and email, and we do send them internationally. We just got an email provider, text provider internationally, so you can join as an international trader. And you'll see this, my P&L kind of fluctuate throughout the day. This is my P&L today, $6,500 of profit. I probably only have about $20,000 of risk. And then you can see I moved to Texas about in March, and I'm up $171,000. So I've been trading really, really well. I'm trading this way. It's unusual option activity. It is, how the biggest hedge fund managers in the world. And it's actually a little bit weird for me to do a presentation during the day, but I think that is pretty cool because I'll be trading throughout this presentation. If there's a signal I like, I'll show you guys why I'm putting on a trade. If there's not a signal, there might not be a signal. Most of the action happens at the beginning of the day, which is 8:30 a.m. to 10 a.m. and then that is why I take that session. So, how to trade with the biggest hedge fund managers in the world. If you guys have any questions throughout the presentation, please feel free to ask questions. Knowledge is power is knowledge. I multitask while I multitask, so I'm very easy to ask questions throughout the presentation. You guys don't have to wait to the end on me because I've done about 500 webinars in the last couple of years, so I'm very familiar with the rigor or more. So a little risk disclaimer, I have to put this in every single webinar. Day trading, short-term trading, and options trading and futures tradings are extremely risky. They are generally not appropriate for someone with little to no capital, little to no risk. Never execute a trade unless you're willing and prepared to lose your entire investment. All trading operations involve serious risk. No trades are recommendations or advice. I am not a registered investment advisor. I cannot give recommendations or advice. What I can do is offer my opinion, which is very, very valuable. So I can offer my opinion on any stock, and if we have some time at the end, we'll look at some charts. Nicole Elliott was on this webinar, which is one of the 3 authors that has written a book on the Ichimoku Cloud. I highly suggest getting your hands on that as one of the best books I've ever read for technical analysis. So all trades are educational purposes only. Contact your broker, registered investment advisor for execution, margin, and other capital requirements. Everybody watching today's presentation adheres to all risk disclaimers on www.optionhacker.com and www.alphashark.com. That is the fun. Thankfully got it out of the way. Now let's get into it. So this is me at 20, this was 2000, so this was May of 2000, so this was me at 19 years old. Broke college student. I went to University of Illinois, Champaign-Urbana. Like I said, I studied at Nottingham for a semester, 6 months actually, and I never knew what I wanted to do with my life. And my father, who I respect a lot, I used to say to him, I'm like, what should I do? I'm like, interviews to be financial advisor, financial analyst, investment banking, and I just had no idea what I wanted to do with my life. And he told me, he's like, Andrew, I think you should trade. And I'm like, you want me to trade? I see those guys, because I'm from Chicago, I see those guys in Chicago, and they're nuts. They're literally insane. They're waving their hands, or yelling, they're screaming. Dad, they're always drunk. Like, I don't want to be like that. And he's like, I think you'd really enjoy it because every single day is different. So what happened was when I graduated, my parents cut me off, and I had to make it for myself. So I took the 5:40 a.m. train every day. I went through a clerk-to-trade program. I was taught by the best traders there were on the world. Okay, the guys that I had the ability to study and be around were unbelievable. Okay, they were amazing on just trading. Okay, and like I said, I trade equity option based, but you can use any of the signals that I send throughout the course of the day for stock as well. But I predominantly trade equity options. So I take the 5:40 train in, I get in at 6:30, I would go through the confirmations for the trader, make sure there's no out trades, they call them, and then I would clerk for 9 months. I was making $2,000 US, I don't know what the equivalent is here, and then I got the ability to trade. Okay, they backed me with $100,000, and through my course of my trading career, I've made millions trading, and you know, it's so funny that, you know, there's been a lot of people like starting to get in trouble like about saying how much they make and how much they don't make, and you know, everything I do is real time and live. So I will show you. I have losing days, I have winning days. These are my statements straight from Goldman Sachs, and I can show you them really quick. And these were from my best years ever, obviously. So here we see this is 2008. So a couple of things that are important. This is trade confirmations from Goldman Sachs. They were my clearing firm, which is important. Okay. Then you can see the date. This is 2008. And then you can see my P&L for the year. I was on an 80-20 split, so I was entitled to 80% of all that money, minus my expenses. And if you guys can't see that, that is $3.4 million that I made in 2008. And then the thing that's important as well, you can see my name on the account. So this is 2008. I just showed you my account from Thinkorswim. I'll be showing that probably a lot through the presentation. I happen to be having a very profitable day today, which is it's good to always have a webinar on days that I'm profitable. Same thing here. This is Goldman Sachs, last day of the year, 2007. Here's my name, and this is $1.5 million. I made 80% of that, like I said, and then minus commissions and minus like seat leases and stuff like that. So I've seen what it's taken to make money. I've also seen what it takes to lose money. I'm actually going to go take some CERN calls right now. So CERN, I just saw a signal, so I'm going to go in and buy some of these. Jan, I'm going to buy, wait, we'll try to pay 110 here. I will pay 115, I don't get them. So I got filled at 110. So I just saw a signal going across the tape, and this is what I'm going to teach you throughout the presentation today. An institutional buyer, okay, of the CERN January 72.5 calls, and they paid 115 for these. So we see here, this is what I watched throughout the course of the day. CERN January 62.5, an institution came in and they bought 5,000 of these for $1.15. So when I see this signal, I decided to get in. So what did I do? I came into my account and then I bought 30 of them for $1.10. 30 times $1.10 times 100 is about $3,000 of risk. So then I will send that trade out, and now you can see their 115 bid. Okay, their 115 bid for over 700. I'm gonna have a profit target at 120. Just like that, guys, right in front of you guys. I just made I'm at $225. So I'm gonna have targets here at 130, 120, 130, 140. So I'm gonna put all my profit targets out. So you can see my P&L, guys, and this is a real dollar account. This isn't fictitious money. As you can see here, I'm up $225 just within seconds here. And then I'll send this trade out, and if you happen to be a member of the trade alerts, you'll get this trade. And I can show you exactly what it looks like. Small accounts, entry to open, so just give me a second here. $62.5 calls. Okay, so that is an example of a trade that I'm going to teach you today. Why I took that trade, because a hedge fund came in here and bought 5,000 calls. 5,000 calls times $1.15 is about a $600,000 bet. So this is something you guys can keep an eye on for the next couple of days and see how the stock reacts. Okay, I took a long signal. You could buy the stock there with a stop loss. Let's look at the chart here and see how the chart looks. So CERN, January 57.5. Stock is really weak. I don't think they're shorting stock against it. I think someone thinks the stock's going to pop for earnings. Okay, so I am in this trade here in CERN. So let's get rid of my thing and let's go back to the presentation. So I studied finance at the University of Illinois Champaign-Urbana, and then I was the market maker on the trading floor in Chicago. I started in the General Electric pit. I went General Electric, and then I went to Philip Morris, and then I went to Apple. Okay, I was an Apple pit trader for a very long time, and that is, you know, where I made a lot of my money trading Apple. So now we just saw Exxon puts being bought. If this was earlier in the day, I would have taken a trade here in Exxon. Some institution came in, bought about $100,000 worth of Exxon, XOM, weekly 87.5 puts for 88 cents. Like I said, I would probably get in those, but there's not that much time left in the day. So I'm going to teach you guys how you can use the biggest trades from the biggest hedge funds in the world in your trading plan and to your advantage to potentially make the kind of money. And I'll give you guys an opportunity to get into our trade alerts as well. Okay. So I was a market maker. Here's a picture with me with Mr. Mark Cuban. We have a lot of things in common. He went to Indiana University. I went to University of Illinois Champaign-Urbana, and he reads about 3 hours a day. I try to read for about an hour a day. So we both read a lot. We both went to Big Ten schools, and I remember when his company was IPOing that he came in here and did a big options trade in the pit. So now I live in Austin, Texas. I'm really all over the place. You know, one of my passions in life is traveling. So I travel everywhere. Just this year, I've been to Guatemala. I've been to Argentina. I've been to Belize. I'm going to go to Colombia. I was just in New Orleans. I was in Philly. I'm going to Atlanta. So I do travel a lot, and that's one of the best things about trading is the opportunity and the ability to trade anywhere in the world. If I have a computer, I could be anywhere in the world trading. Okay, and that's one of the great things about trading is that you can trade from anywhere in the world. So a little journey of me at 21. I was a broke college student, which is always fun. Learned how to trade at 24. Made my first million at 25. At 26, I blew up my trading account. I lost $493,000 in a company named AMAG, which is AMAG, which obviously wasn't really what I wanted to do, but it was a good learning lesson at least. So I lost a lot of money in AMAG. I left. I went to Thailand for, I would say I went to Thailand for, I think I went for about 6 weeks. I taught English in a Buddhist monastery. That's where I learned about the Ichimoku cloud, and that's when I started getting into technical analysis. When I was on the trading floor, like my weakest point was technical analysis. You know, I know how to trade volatility. I know supply-demand curves, but I was really, really weak at basically technical analysis. So that's the thing that I wanted to improve on most was technical analysis, and then I improved on that. I combined that with unusual option activity, and it's been pretty good and pretty profitable for me. So I am a full-time trader, and I trade, you know, throughout the day. Usually every morning, you know, I might go to the gym, but throughout the course of the day. So there's a problem in trading, guys, as you guys mostly know. Most traders lose money. Okay, 90% of all traders lose money. And you say to yourself, why is that? How can that be possible? If someone's long and someone's short, how can 90% of the traders lose money? Well, you lose money for a lot of different reasons. One of the reasons you lose money is because you're not on the side of the trend. And this is why I started trading Ichimoku Kinkan Hoi, because trend is your friend. So that's why I started trading the Ichimoku Cloud. And when I watch and I trade unusual option activity, like the thing is, trading is really, really hard, guys. Okay, you have to be very gifted to be a really good trader. 90% of all people that trade lose money, and that's actually a fact. Okay, you know, ways you can start making money. You know, stocks is very, very hard to trade. Futures are extremely hard to trade. Forex is really, really hard to trade. You know, I will come and I will trade, but I like to trade equity options. As you can see, my P&L. And I'll show this throughout the whole presentation. It does fluctuate throughout the day, but I always put my money where my mouth is. Okay, I always say when you go to a presentation and you see someone speaking, because I have I've done about 500 webinars in the last 4 years, and I've also taught about 50,000 students to trade. If I was in your guys' shoes, you know, the questions I personally would ask, and you should probably write these down, is number one, do you trade real money? And most likely everybody's going to say, of course I trade real money. Like, this is usually what you should ask someone presenting. Number two, okay, how often do you trade? And it's someone who ever says, you know, the only good time to trade is in the morning, or the best times are Mondays or Tuesdays, that's not necessarily true. Okay, most action is in the morning, but there's no best time to trade. Mondays, Tuesdays, you know, there could be a really good signal right now. Like I said, guys, I just showed you CERN. I'm up $225 right here. If I wasn't at my computer right now, I wouldn't have made that $225, right? So, you know, the opening bell gives you the most action, which is when the U.S. stock market opens, but there's no really quote-unquote best time to trade. Number three, which is always the most important thing, can you show me that you actually make money, okay? What do you guys rather want to learn from someone who has made money trading before, and I am down this year. I'll admit it. This is my losing year for me trading. I started my account over basically in March when I moved to Texas, and that's my P&L before commissions since March, but I'm still down in the year. But I've dug that out of that hole, and I've done pretty well since then. So can I see something? Show me something besides an Excel spreadsheet that shows you made money. Like I just showed you my confirmations from Goldman Sachs. Okay, an Excel spreadsheet really isn't that great. So the three things you should always ask anybody speaking is, do you trade real money? How often do you trade? And can I actually see something that shows that you're actually profitable? Like, why would you want to learn from someone who hasn't made money ever trading? Okay, everything's all easy in hindsight. I mean, I could bring up a chart of anything up here, and I could say, well, obviously Apple didn't go higher because there was resistance there. Like, charts are easy in hindsight, right? I could bring up Apple here, and I could say, oh, yeah, well, Apple had difficulty getting through the 118 level, so that's why it sold off on earnings. I could sit here in hindsight and just make up anything, right? You could say, oh, look at there's like a quadruple top up here at that 118 level, and that's why the stock sold off. Or you could sit here and say, oh, look at this, a double bottom here with a bullish engulfing candle. These were buys, these were buys. I mean, in hindsight, everything is easy, right? But this is why I do it, and I send all my alerts out in real time. So most institutions do make money, okay? Institutions are the ones controlling the order flow. I was actually reading a book, and it said about 80% of all the basic price action is controlled by institutional order flow. And the way that I look at stuff is everything is a supply-demand curve. Okay, supply-demand curve between buyers and sellers. Just think about it this way. Okay, let's say you have a condo you own in London that you think is worth 50,000 pounds. So you put it on the market and you say, hey, I want to get 50,000 pounds for this condo. And then someone comes in, they give you a 450 bid, someone gives you a 450, 60 bid, but no one gives you a $500,000 bid. Well, is your condo actually worth 500,000 pounds? The answer is obviously no. Okay, it's worth what someone's willing to pay for it. It's probably worth 460. On the reverse way, if you have a condo up for 500,000 pounds and someone comes in and they're like, hey, I'll give you 500. Someone goes, I'll give you 520. Someone goes, I'll give you 550. Someone goes, I'll give you 600. Well, that same condo is now worth 600,000. So anything in this world, guys, is just a supply-demand curve. More buyers come into the market, price goes higher. More aggressive sellers come in the market, price goes lower. Throughout the course of the day, this is all I'm trying to do. I'm just trying to find supply-demand curves. Okay, where are buyers and where are sellers? And that's my goal as a trader. So the biggest hedge fund managers in the world, we have three pictures here. We have Carl Icahn, David Einhorn, and Bill Ackman. Big traders. I don't know for a fact. I'm watching institutional order flow of their trades, but I just assume a lot of it is because a lot of institutions do trade options. Okay, Carl Icahn, even though these are the best hedge fund managers and they consistently make money over time, they do have losing trades. Carl Icahn was in Cheniere at like $70, and he thought it was going higher, liquefied natural gas. David Einhorn, he was in Micron for a long time at $35. These are now both in half. And then you see Bill Ackman, which is the big one. If you ever think you have a bad day, just think of Bill Ackman. He lost $1 billion in a day. Okay, he's still a profitable hedge fund manager, but imagine losing $1 billion. It's about 40% of his net worth. So these are the best and biggest hedge funds in the world. So what I do, guys, is you can see here, this is a scanner. Okay, and it's actually really weird for me to do this presentation live because a lot of times I do it after the market closes. So I just watch institutional order flow in the option market. Okay, institutional order flow in the market. So I'm watching a minimum of 1,000 lot of. See, now this just hit the tape. The CERN trade, 6,200 CERN calls traded. I got into that position. So throughout the course of the day, this will spit out 8 to 1,200 trades throughout the course of the day, and then I go in and I trade, maybe about 6 entries and about 10 exits throughout the course of the day. So I'm watching institutional order flow, which is a lot of hedge funds. Okay, who uses options? Okay, options are used by hedge funds, mutual funds, pension funds, and sovereign wealth funds. Okay, they all use options because options give a better ROI, return on investment. Okay, so if I knew a stock, hypothetically speaking, was going to go from 10 to 20, would I rather buy the stock, which is going to give me 100% gain, or would I rather buy an option? Okay, I would rather buy an option because the option is going to give me a better return on investment. Okay, it's going to give me a better return on investment. So a lot of the hedge fund managers or pension funds, sovereign wealth funds, big traders, okay, will trade options because it gives me a better ROI, return on investment. And that's why I'm watching it, okay? So after the course of the day, you'll see this trade just come across. And my 14 years of trading as a full-time trader, I have an idea or sense, okay, off of which trades that I want to take. So let's describe what unusual option activity is. Unusual option activity is option flow by institutions. How much money you need to be able to start? It's a question for your broker. I think I always say you can start it in a simulated account. Any product you try to trade in the beginning, you should trade in a simulated account. Then if you make money in the simulated account, then you can move up to a real dollar account, okay? And, I think you can open an option account with a couple $1,000s. You'd have to call your broker on that, but you don't have to, okay? I started because a lot of people are like, AK, and I call me AK, they're like, I can't trade with you. I can't trade like you. So I said, you know what I'm going to do? I'm going to prove to you guys that I can make money on a small dollar account, okay? So what I did is I opened an account, and I put $10,000 cash in this account, okay? On 7 weeks of trading, so this was a small account, okay? So this is a small account. I put in $10,000 cash. I put in $10,000 cash. My handwriting is terrible. Right now, this is my P&L in 7 weeks, before commissions. So in 7 weeks, I'm averaging about $1,000 a week. So I'm up $7,400 before commissions on a $10,000 cash account, and these are my current positions. Okay? So it is easy. It's not easy to make it, but this is to prove, and we had over 100 people sign up for this, and then you get all these trades in real time. I only have 2 positions on right now. They're actually both shorts. Okay? So I started with a $10,000 account. I'm up $7,400 in 7 weeks. The challenge closes next week. I was trying to double my trading account in 8 weeks. So unusual option activity is average daily volume of a given stock. So every stock has average daily volume, okay? If it trades X over average daily volume, is known as unusual option activity. So if a stock trades, let's say, 5,000 options a day, how do you learn to trade options? Can you use a U.S. broker to trade options? I'm pretty sure you can trade interactive brokers, Thinkorswim. Thinkorswim and interactive brokers, most likely you can trade both of those. And you can use these, to trade stock as well. These are just signals I send out. So Thinkorswim or interactive brokers. So if a stock trades 5,000 options in a day, and then today it trades 10,000 options, that is going to be known as unusual option activity. Okay, X times usual volume. Something's not usual, then it's unusual. Okay, so unusual option activity. These orders give us insight to what the institutional order flow is doing. I compare like trading options to playing poker. Okay, if I played the computer and chess every single day for the rest of my life, I would never win. And that's like trading futures and Forex, unfortunately. Okay, trading and playing the computer and chess, you're never going to win because there's always one right move. The computers know that there's algorithmic trading that always knows the right move to make, which is really why it's hard to trade. Okay, but in the option market, there's a bluffing mechanism involved. An institution could be buying calls against a short stock position. They could be buying puts against a short stock position, a long stock position. They could be selling puts to establish a long stock position or against short stock. So you never know if it's a speculation or a hedge. All these option trades, I have no idea what the institution has on. I'm going to teach you guys my secret sauce, which is my trading plan that can show you how to potentially realize, what they have on or not. And I'm going to teach you something in a little while. So let's see where the traders are putting in the smart money. So like I said, guys, there's no dark pools in the option market. You know, you trade stocks, there's dark pools. If you guys want a really good book to read, you can read Michael Lewis's Flash Boys, and that's talking about dark pools, okay? There is no dark pools in the option market. And the reason there's no dark pools is because the exchanges are fighting really, really hard against it. A couple years ago, Andrew Sorkin from CNBC talked about how 25% of all mergers and acquisitions we saw unusual option activity. Okay, and this is why I continue to trade that I continue to trade. Okay, you see, this is a big trade here. We just saw a big buyer of FEYE calls. So keep an eye on this one, guys. So this is a signal here. Big institution bought some FEYE Nova 11.5 calls. We saw some calls actually being bought yesterday as well. So an institution coming in here, someone saying, hey, I think FEYE can go higher. They bought 4,277 FEYE Nova 11.5 calls for $1.13. If this was earlier in the day, I would have taken these for a day trade only. We're going to teach you guys when to take a day trade versus take a swing trade. November is only a day trade, so I would look to take those as a day trade only. I wouldn't look to take those as a swing trade. But you know, that was about a $500,000 bet, right there, $500,000 bet. So there's no dark pool in the option markets. Okay, so you say to yourself, why do we care about unusual option activity? Institutions have more edge than you do. There are reasons that they do. Number one, they have better information. Okay. Number two, the technology they have is better. Number three, manpower. And number four, capital. Okay. So this is why I am just trying to piggyback off the biggest trades. Okay. I'm not trying to take a trade unless the institution's doing it. I'm not sitting here coming up with random trades based on what I think the chart looks like. Okay. I'm watching institutional order flow in the option market, and I'm looking at what the biggest traders in the world are doing. And I'm just trying to mimic their positions. Okay. So manpower and capital. Next slide. So why is unusual option activity the best way to track trades? Okay. Think about the order process. There are no dark pools in the order process. Okay? There's no dark pools in the order process. The institution will come up with a trade based on their research, information, and analysis. They then call their broker and say, hey, I want to put this trade on. Then they shop the trade to Goldman, Citadel, Merrill, Morgan. And then they put on the trade. And then it gets declared. And everybody will see the trade. Okay? So every single trade in the option market I will see throughout the course of the day. It is very, very important to realize that. There's dark pools in stock. You won't see all the stock trading. You're trading in futures. They're hedging futures against so many different positions. So then they will execute the trade. The trade will be executed for the SEC and the OCC. Okay? Once it is executed, then it will be sent out as a trade, and then I can act on that trade. Okay, we just saw Akamai puts being bought. D70 puts in Akamai. So we've actually seen a lot of activity today. So what does unusual option activity look like? This is a trade I'm going to show you today, and we sent a signal out in this trade. If you put this trade on, I'll show you my profitability right here. I made $1,800 on this trade. Okay, so you can see here I saw institutional order flow in the option market, and a trader bought about 7,000 of the TJT target weekly 68 puts for 35 cents. And you say to yourself, why did they buy them? I don't care why they bought them. Okay, maybe they think there's another credit card fraud. But as you can see here, which is most importantly, guys, I have no position on right now, and I locked in $1,778 here in less than 5 minutes. And I'll show you the trade that I got. So this is what unusual option activity looks like. And I'm not showing you stuff from last year or 2 years ago. I'm showing you a trade that actually happened today. We actually changed all our slides today so we could give you something that was really good. So we see here just a breakdown of the trade. Bear day trade. Trader bought 1,227. TJT, which is known as target, 1028, 68 puts for 35 cents. Ended up being about 7,000 a trade. Shows you where the stock was trading. So if you know a little bit about options, you can be like, hey, stock's trading 68.14. I could just short the stock because buying puts is a bearish trade. And you can see here, I went in, and these are all real fills in real time. So I go to target. And I came in here and I was like, this looks like a good trade. I've made money before in target. So two things that are important. The timestamp, okay, from the broker. I ended up buying 200 of these for half at 34, half at 36. So I bought some at 34 and then I bought them at 36. Okay? And you see the timestamp at 9:54:21. So at 9:54 this trade hit, and I said to myself, hey, this looks like a good trade. I'm going to take it. So I bought 200 of the target puts for 35 cents on average, sold them at 40, 40, 44, 48, and then I sold the balance out at 43. So I bought 200, I sold 200, and look at how quickly it happened, guys. This was less than 5 minutes. Okay, there's nowhere else in the world you can make $1,800 legally. You can make $1,800 in 5 minutes. Less than 5 minutes, I made $1,800. And we can go back here and you can look at my profitability, and I'm out of the trade. Okay, so I'm going to teach you guys why some trades are better day trades and some trades are better swing trades. Let me go into Target here, and they just bought Akamai puts and the stock just sold off too. So we see here in Target, and actually the puts right now are 37 cents. And you see my position here on the bottom. Let me bring it up a little bit. Okay, $1,778 profit. $1,778 profit. Just like that. Boom. Okay. So a great, great trade. And this is one that hit today. So as we see here, if we looked at the chart of the 5-minute bar, and I like to use Ichimoku Cloud, 49% gains. Okay. These traded as high as 52. Hypothetically speaking, if you bought a 10 lot for 34 cents and sold it at 52, that'd be $180 profit. Okay. If you guys can make $500 a day trading, it's about $126,000. If you make $250 a day, it's about $60,000. Okay. So I'm not sitting here trying to swing for the fences, hoping these puts go to $4. Okay. Buy and hold is dead. Trading is where it's at. So we see the puts were bought right here, and the stock was trading 68.14. What happened? Coincidentally or not? Do you think that the hedge fund didn't know the stock was going to sell off? Of course they knew the stock was going to sell off. Shockingly, right? So the stock sold off, I cashed in, I locked in my profits, and the trade is over. So you say to yourself, how can I use this? Okay, AK, this looks great, but how can I help me? Okay, how does this trading style help me? Well, it's a fact, guys. So there's certain trades that are better day trades and certain trades that are better swing trades. So I go in here and I look at stuff and I call it the 4-week rule. Okay, and this is just Caterpillar per se. You can see my profitability. Caterpillar, $2,500 today. Not a bad day. Okay, so we see here, I call it the 4-week rule. Anything less than 4 weeks to go to expiration. Okay, so less than 4 weeks, I day trade only, guys. Time premium is too high and premium kills. So less than 4 weeks, I day trade. Greater than 4 weeks, I swing trade. Okay, so a swing trade can last 3 days to 3 months. Okay, so this is how I look at everything. Okay, everything's established differently. Less than 4 weeks to go to expiration is a day trade. Greater than 4 weeks to go is a swing trade. So if I looked at expiration, we have expiration here. 1, 2, 3, 4. So Nova 18 is my marker. Okay, Nova 18 and sooner, these will all be day trades. Okay, afterwards, those will be swing trades. Okay, Nova 25th expiration on will be known as swing trades. And the reason why is the gamma is really, really high in the front month. So gamma is highest in the front month, so it's going to give me the best risk and the best reward. Okay, so we go back here, and we can just go. I always like going back to my P&L just to see how it's doing. $6,446 today. This is how much cash I have available here. So I used to trade on a really big account. and I don't trade on that big of an account. You know, I used to have like 300,000 in there, and everybody would say, "Hey, I can't trade like you. Like I can't. I don't have that much money." So I've actually moved it to a smaller account. So now my P&L just went down $60. So now 23.28, and this is all real time and live real money. Okay. So there are some trades that set up better day trades versus some that are set up better swing trades. Okay. This is an example of PMCS. I sent this an alert out. This was back in January. A institutional buyer of 14,726 PMCS January 7 calls were bought for 85 cents. Okay. Breakdown. 14,726 PMCS January 7 calls were bought for 85 cents. This was a $1.2 million bet in PMCS. So somebody said to themselves, okay, I want to get into PMCS. I think something maybe going to happen in there. What can I do? Okay. Well, it's better, as I said, to take options instead of stock. Okay, you're going to get a better ROI if you take options in stock. So let's kind of see, where the stock goes for the day. Okay, what happens to the stock? Wow, just like this, the stock went up, and maybe they didn't know when it was going to be, but stock catapulted. Their calls were bought right here. Within 3 trading days, the stock went up 30%. Okay, so if I was long stock, I would have got 30% gains. Okay, that's pretty good, right? However, if I bought the call options, which we sent the signal out, the calls went from $1.85 to $3.30. So hypothetically speaking, if you bought 20 of these, $5,000 profit on a $1,700 risk. Okay, and this is why I trade options. And this is why I trade unusual option activity. Okay, this one trade could have netted you $4,900 profit on $1,700. This is an example of one of the alerts I sent out to my subscribers. As I saw this, it looked like a good trade. Oh, guess what? It ended up being a great trade. So you say to yourself, why take these trades? Okay. The hedge funds and big traders are smarter than us. They have access to information and technology that we do not have. Trade with the pros. Imagine knowing Carl Icahn or David Einhorn's positions before they are disclosed. You know, if Carl Icahn called me up, which I do not know him, if he called me up and said, hey, AK, I think the stock's going to go lower. I'm going to buy a bunch of puts in it. Do you want a little bit of the action? Like Carl Icahn, of course I want some of the action, right? Or imagine him like, hey, the stock's going to get bought out. Do you want to buy some calls with me? Of course I would say yes. So in theory, guys, I'm just piggybacking off institutional order flow. I'm literally piggybacking off what I think are the best trades out there. Simple and easy. It's not that crazy of a concept. I'm just trying to piggyback of what I think the best trades are. And like I said, guys, I watch a scanner. I'm watching it right now for institutional order flow. Okay. So if there's a good trade, I put it on. Like I just showed you that one in CERN that I put on in front of you. CERN is a swing trade. You know, why is CERN a swing trade? Because it's more than 4 weeks out. So just remember, guys, less than 4 weeks out, day trade. More than 4 weeks out, swing trade. And the best thing about this, guys, all trades are public information. Okay? All trades are public information. So you say to yourself, this looks great, sounds great. AK, how do I take advantage of this? Okay? There's actually a couple free websites if you want to learn more about it. Unfortunately, all these these are all delayed here. So let me go into this. Option Monster is one of them. So Option Monster is, I'll sign up right now for free, huh? I'll find out more. So Option Monster is one of the sites where you can get all these for free. The problem with this is these are delayed about half an hour. If you don't mind them being delayed half an hour, that's fine. But a lot of times prices move, and the profits that could have been made before are not made anymore. Okay. So this is one of them, Option Monster, and the other one is theoptionsinsider.com. Okay, so you can get here a lot of the trades on unusual option activity. Unfortunately, as I said, they are delayed. Okay, they are delayed. So that's one of the problems, they're delayed. But you can get those for free. So you need to have a trading plan in place. Okay, and I'm going to teach you my secret sauce. I'm going to teach you guys my trading plan. It's called the Oak Rivet Trading Plan. So I need to have a plan in place. So I know, okay, calls are bought for one of two reasons. Speculation to the upside or a hedge against a short stock position. Puts are bought for one of two reasons. Speculation to the downside or a hedge against a long stock position. I need to know if a trade is speculation or a hedge. How do I know that? I go through what is called the Oak Rivet Trading Plan. Oak Rivet Trading Plan. So I need to make sure profitability is on my side. So we have developed a plan for you guys. A trading plan so you can know if it's speculation or a hedge. As I said, guys, this is known as the Oak Rivet Trading Plan. So this is my secret sauce. Every single trade that goes across the tape, I go through the simple trading plan. If I was you guys, which I'm not, I would probably take a picture of this or maybe write it down. And the first thing I look at is the option volume. So volume, I want to be greater than open interest. I want a opening position. I don't care if something is a closed position. So option volume versus open interest is number one. Okay. Number two. Okay. Number two, the chart. If it's a bullish looking chart, I want only to be buying calls. I use Ichimoku Kinkin Hoi. Okay. So I don't want to be buying puts under the cloud. I don't want to be buying, puts above the cloud, and I don't want to be buying calls under the cloud. So I got to make sure the theory of my long calls lines up with the chart. You know, and this actually hurt me, and I lost a lot of money in Abercrombie and Fitch. Okay, I don't make money on every trade, but Abercrombie and Fitch, we saw huge institutional buyers of no 20 calls, and I should have known better. Okay, Abercrombie hit a new 52-week low today. Trader bought the no 20 calls probably right around here, but I guess it was probably against a short stock position, and I lost a lot of money in it. Okay, so there's no longs under the cloud. There's no shorts above the cloud. Just remember that, guys. Okay, so you can use whatever technical analysis that you want. Then I have R&R. Some people like rest and relaxation. I really don't like rest and relaxation. I like a risk versus reward setup. How much I'm willing to risk on this trade versus how much I want to make on this trade. B, break even. And then we have TNT, time and target. Okay, time and target. So here's an example of target. Let's go through the trade. Trader bought 1,227. Target 68 puts, and actually you can see target. I just had it up a second ago. How it just continues to move lower here, and now these puts are back to 52 cents. So these have gone from 34 to 52, and we see 8,000. So the first thing I look at is volume. Volume is 8,000. Open interest is 800. So the first thing I always look at is volume greater than open interest. I want volume to be greater than open interest. So if volume is greater than open interest, I can look at the next step. If volume is not greater than open interest, then I will not take a trade. So I want volume to be greater than open interest. Then I look at the chart. Like I said, guys, you can use anything for technical analysis that you want. I use the Ichimoku Cloud, otherwise known as the Ichimoku Kinkin Hoi. Okay, so I use the Ichimoku Cloud. You guys can use whatever you want. So I want only longs above the cloud, only shorts under the cloud, and nothing in the cloud. Okay. Like I said, guys, if you have any questions, please let me know. Okay. So this is Ichimoku Kinkin Hoi for my technical analysis portion of the day. Okay. Next slide. So we see here in target, and what's really important here when I'm trading, okay? So this is kind of cool. If I'm day trading, two rules for day trading. And then if I'm swing trading, okay, so day trading, I want less than 4 weeks to go of expiration. Also, I want to use the 5-minute bar, okay? So if I'm day trading, it doesn't matter what the weekly chart, daily chart looks like. If I'm swing trading, I want to look at the daily chart, not the 5-minute chart, and greater than go 4 weeks ago. Okay, so this is something to keep in mind here, guys. So when I'm day trading, I don't care about a daily chart. So I'm not looking at the daily chart. I'm looking at the 5-minute chart. When I'm swing trading, I only care about the daily chart. I don't care about the 5-minute bar. So then I look at R&R, okay? We always talk about, you know, if I'm a beginner trader, having a 30% stop loss. So if I buy an option for $1, having a stop loss at 70 cents. Then if I'm an intermediate trader, having a 50% stop loss. So if I buy an option for $1, having a stop at 50 cents. And then personally, I don't use any stop losses because I consider myself an expert trader or a full-time trader. But you guys can kind of do whatever you want, okay? Just figure out what kind of stop loss. Because, you know, they always say never get married to a trade, right? You know, no matter what a trade is, not every single trade is going to be a winner, okay? There's going to be a lot of trades that are probably going to be losers, unfortunately, okay? I don't care at the end of the day what percentage of my trades are winners. All I care about is if I'm making money in the long run. You know, I said this. I was in a presentation. I do a lot of public speaking. I'll actually be speaking in Vegas in 2 weeks. Hey, that's my dog. And they go, you know, some old guy in the back of the room goes, hey, excuse me, Andrew, what percentage of your trades are winners? I said, it doesn't matter, sir. He goes, what do you mean it doesn't matter? I said, think about it this way. If I have 5 trades on, first 4 trades, I lose $500. So technically I'm down $2,000. Then the 5th trade, I make $3,000. My P&L is profitable. So I'm net up $1,000. But only 20% of my trades are winners. So you got to stop looking at what percentage of the trades are winners. All you got to do is look at your bottom line, okay? At the end of the day, am I making more money than not? I will be honest. Trading is not for everybody, okay? If you want to learn how to become a better trader, learn from traders that trade for a living, okay? Look for traders that are professional traders that have been doing it for a long time, that are actually showing you stuff right now, okay? Not in hindsight. You're like, oh, I could have got it in this trade. Look where it went, okay? My certain position now back to break even, okay? So learn from people that actually do it, that show you, you know, hey, I'm up money. Hey, I'm down money. I do a lot of videos of me losing money, okay? To just show you guys, I'm not going to make money every single day. Anybody that says they make money every day, it's like impossible. I set up to all the emails of everybody, and people that are like, I made 80 straight winning trades. I'm like, you're crazy, okay? Why don't you start a hedge fund, okay? Because trading is difficult and challenging, okay? But over time, just like playing poker, you know, everybody, just like playing poker, the best poker players usually end up with all the money. Time to target, I call this TNT. Just remember the rules of day trading versus swing trading. Okay, I want to day trade less than 4 weeks and use the 5-minute bar. If I'm swing trading, I want to trade more than 4 weeks and I want to use a daily chart. Simple and easy. Okay, so what we have to offer you guys today, which is really, really cool. I just want to change a couple of things in this real quick. Get rid of that. Get rid of that. James spelled unusual option activity wrong. I'm just trying to put this in better order. Let's make it a little bigger here. Okay, so what are we offering you guys today? This is a one-time offer, okay? Whoa, let's go to the last slide. Okay. And I'm a huge, huge Cubs fan. So you guys can sign up on alphashark.com/go Cubs. Okay. What you will get for $99. Okay. So if you sign up, we have limited amounts of spots. I do not know if we're going to sell out of this. We might sell out of this. You get this is a one-time offer, you guys. You get our unusual option activity course. Okay. So what you guys watched is a presentation today. This is kind of like to teach you guys unusual option activity and how you can trade it. Okay, we have a course that we are going to give you today with 1 month of all my trades via text and email, and we do take international subscribers now. So you guys get our 8-hour workshop on trading and usual option activity, SMX text, alerts, and emails of all my entries and exits, updates of my portfolio that I update about 4 times a day. You get access to hundreds of hours of recorded videos, webinars, and other education material. And then you get a trade of the day video that we send out at the end of the day. You guys can sign up at alphashark.com/Cubs. Hypothetically speaking, of course, if you took every single signal that I sent out today, as my P&L is going higher now, okay? If you took every signal I sent out today, you potentially made over $6,600 of profit. And I only have about $25,000 of risk. So, you know, trading is different than investing. Long-term investing, obviously, you're not going to move 25% in a day. However, in this, I am up 25% of my book on my risk today. So, and then it just went up again. Okay. So what you guys get, this is a one-time offer. Make sure you guys take advantage of the promotion. It's $99. It's alphashark.com/go Cubs. And I see people piling in to buy it. I see Steve is in. I see Daniel is in. I see Jeremy is in. I see Jeff is in. I see David is in. I see Ashley is in. Okay. So you get our 8-hour workshop on trading unusual option activity. Then you get SMS text and email alerts of all my entries and exits. Plus you get updates of all my open positions. Plus hundreds of hours. Usually we just sell the trading unusual option activity course for $99 at most webinars. But then people started asking, they're like, well, the course is great, but how do I get your trades? So we've combined this into one, guys. This is a $999 value we're going to offer you guys today for only $99. You'll get the trades via text. I think we do it through WhatsApp for internationals, plus the course. And I'm leaving it open for questions here. I will never cut my time off. I'm going to use all hour. So if you guys have any questions about charts, we can go through some charts here. If you have any questions about the unusual option activity workshop, fire any charts you want, stocks, futures, Forex. I know Google has earnings after the bell. I know Amazon has earnings after the bell. So if you have any questions about any charts, just fire away. Someone asked, so Google has earnings today after the bell. I'm actually going to look to get short Google. I think I made a short-term top here. So we're just going to go through a couple of the big name ones. So Google, 838. Gold futures, we can look at that one. So I think Google might have put a double top in here. I'm going to look to get short Google. I think it tests back down to 790, and I'll do that in the option market. And then we have GC. So GC has it on the daily is up $5 today. I think it's a short on the rally. So if I was looking to short GC, I'd wait for a bear bar. So a bear bar yesterday on the daily. Could have shorted yesterday. Stop would be above 1303. Consolidating here, getting a little bit of buy-in pressure. Short-term bottom might be in here. I'd rather be short than long gold futures, and I would probably look to get short them around here on this 1270 level with a stop above 1303. Why not trade unusual option activity in futures and Forex? Because there's not. There's not unusual option activity in futures and Forex. Unusual option activity only works for equity options. Okay. Look at my P&L. This is Thinkorswim. I trade through. I trade through Thinkorswim. I got a short hog today. I'm long a bunch of puts in HOG. HOG, I'm up $2,000 today too. Have a nice day. So like I said, guys, if hypothetically speaking, you took every single trade that I sent out and the same quantity, $6,700 profit. You can see I have a lot of cash on the sidelines. I don't always have all my book allocated towards that. Okay, so GC, I know Amazon has earnings after the bell. I'm going to get short Amazon and I'm getting short Google. I'm going to short both of them. I'm going to buy put butterflies. So let me look at Amazon. Amazon, I'm going to go to, so the 820, so they're implying a $50 move here in Amazon. So in Amazon, I'm going to go to Amazon here, and I'm going to look at the 800, 770, 740 put fly. $30 put flag I can get in for $6.60. Let me try to tweak it down a little bit. Let me try the 780, 760, 740. $20 put flag I can get in here at $2.65. So I'm going to buy that one. And then let me go to Google. And earnings are really rough, but I do trade earnings. Google straddles around $40. So I want to do the 795, 775, 755. All right, guys, so let me just talk about the offer one more time, and then we're going to pass you guys out. And I think there's one more speaker after us. So this is a one-time offer. A lot of people are taking advantage of it right now. What we're going to get, and we usually just offer the course, but we're offering the course and the alerts today. You get unusual option activity course. It's an 8-hour workshop. We have that on our website just for $4.99 just for itself. Plus, we're going to throw in a month of text alerts and emails of all my entries and exits. So if I put on a trade, you will get that trade within, we send it out within 60 seconds of the trade being executed. You'll get updates of all my open positions. You get hundreds of hours of recorded videos, webinars, and other education material. Plus, you get a trade of the day video. Make sure you guys sign up. I can see my email box going up. My dog's excited. alphashark.com/go Cubs. If anybody has any questions, we have about a couple minutes left. If not, we're going to call it a day. Any questions, guys? If not, everybody have a great day. Listen to the rest of the speakers. Remember the 3 questions always asked. Do you trade real money? How often do you trade? And can I actually see something that's not an Excel spreadsheet of you making money? Thanks, guys. Make sure you sign up and take advantage of this great offer. We only have a couple spots left. alphashark.com/go Cubs.
Okay, thank you very much. Andrew Keane from alphashark.com. Thank you very much. I'll take the presenter role back from you now. Okay, so there we are. Andrew Keane, trading in Chicago. And that takes us almost up to 8 o'clock, where we're just about to welcome our next and final speaker of the day, Jeffrey Gibby. In case you're looking for me, I'm here. Fantastic, Jeffrey. Thank you very much indeed. I will make you, I'll bring your microphone off first of all, and we'll go across to speak to Jeffrey. Another first for Round the Clock Trader. Jeffrey Gibby from Metastock. Our final speaker of today.
Hello.
Oh, good afternoon, good evening if you're for everybody here, but good afternoon to you, Jeffrey. How are you?
Good. It's about 1 in the afternoon here.
Oh, well, we are just about at the end of what's been a fantastic day. We're a bit challenging. The first few hours we seem to have lots of problems with the internet, and I've been told now that there have been 1 or 2 problems going around the internet today, so it's not just us that's been affected.
Should we blame Russia?
I think, I wouldn't want to say, I couldn't possibly comment, but it seems to be happening on a more than regular basis now. So it is the #1 tool that everybody relies upon. But welcome to the event, Jeffrey. We spoke just shortly after our event last month, and of course, Metastock is a program for trading and analyzing the stock markets, but I'm ashamed to say that we've never had you on to tell us about it.
It's okay. It's always a first.
This is the first. So we're looking forward. We're looking forward to this. So you've obviously my favorite strategies. I know from looking at your website that you're you're doing a huge tour of the US with all the live seminars. And this is the busy time of year, so it's good of you to fit us in. Shall we go across and share screens?
Yeah, I'm ready. And you should see a nice, I think this is a very pretty screen. It should be all gold if it's showing the right screen.
It's a paper ticker.
Yeah.
I've just finished reading all about the. I did read it a few years ago, but I read it again. A slightly different version. It was an update of the book all about the turtle traders, of course, that came out of Chicago. Richard Dennis's experiment from the early 80s.
Yeah,
And,
yeah.
and he grew up reading the ticker in the 1970s. So I'm full of all that old-fashioned trading, when traders were real traders. But it's amazing how all these strategies still remain true.
I spent a few minutes on CBOE this year doing a talk, and it's just amazing how it almost looks like it should be a museum. The only pit that had really any activity was the S&P activity. And then the rest of it kind of looks like a little bit of a ghost town. So, yeah, it's crazy how things have evolved.
Well, we shut down. We had what was called the Life Exchange, the London International Financial Futures Exchange, was the last pit trading exchange here in the UK. I think there is still the Metals Exchange, but certainly for the Life one in Canning Street in London, the Canning Street was the big one. And it was just amazing to see with the people, the traders that had their hair sprayed different colours and everything just to make them remembered when they were doing a trade, because it was all about the visual, and sort of translating that now into these online forums has been one of the challenges that traders have had to overcome. But we do with the internet. There's all these trading rooms and things like that can help. So let's go across and start to learn about Metastock.
Okay. Do you want me to talk a little bit about who I am? I'm going to. I'll just go ahead and get started. How about that?
I think you should definitely do that. Okay. Jeffrey Gibby from Metastock. I'll hand the floor over. The floor is yours.
All right. Thanks. Okay. Let me just talk a little bit about who I am then. My name's Jeff Gibby, if you haven't figured that out yet, and I've worked for Metastock for the better part. Well, it'll be 20 years in March, to be very specific about it. It's been a really good place to work. It's a great company. We develop really awesome software here, and I started in inside sales, and now kind of moved up a little bit during the few years, but I'm in charge of all of our international partnerships, dealerships, that kind of stuff. So it's been a lot of fun. It's been a lot of growth opportunities for me. I've been able to work with people that are really good traders in the market and teach people how to trade. And I also end up doing a lot of webinars as a result of that. So that's kind of my background. I just got back from London in May. Generally, I kind of hit London about once a year. I should probably hit it a little bit more often, but it's hard for me to get away from my kids and my family for an extended period of time to kind of make it over there. So anyway, that's enough about me. The bottom line is I just really enjoy what we do here. I do have to read this legal disclaimer. So today's demonstration is designed to instruct you on using Metastock and the company's software plugins. It's not a recommendation to buy or sell, but rather guidelines to interpreting and using specific indicators and features within the software. The information, software, and techniques presented today should only be used by investors who are aware of the risk inherent in trading, and Metastock shall have no liability for any investments decisions based on the use of the software, any trading strategies, or any information provided in connection with the company. So there you go with that. That kind of gets that out of the way. Today, I just want to talk a little bit about kind of what Metastock is. It is a product that's actually has a lot of popularity. We were looking at some demographics earlier this year, and in the UK is where we actually get about half of our search engine traffic, excluding the U.S. So outside of the U.S., Metastock.com, the UK is actually the most popular country for Metastock. So I'd like to thank you for that. And when I started, it was, like I said, about 20 years ago. We were owned by Reuters. About 2 or 3 years ago, we decided Reuters has a huge focus on that institutional market. I'm sure a lot of you are familiar with Thomson Reuters. It's a huge company. It's a 19-some billion a year company. And their focus is always on that hedge fund, that the institutional traders, and a lot of their technology is kind of geared toward that. We've always, in Salt Lake City, Utah, we've always kind of catered to that individual trader, and so we wanted to be able to kind of focus more on kind of our core technologies, which is Metastock, and we've kind of felt that it would be better if we just actually bought the company back from Reuters a few years ago. So we did that back in, I think, 2012. We bought ourselves back from Reuters. No, 2013. And it's been a great kind of transition, because what we were able to do is, Reuters has obviously like a huge amount of data markets. They cover a ridiculous amount of instruments, whether it's issues that are from London Stock Exchange to Forex instruments to US instruments to just anything that you could imagine. So we were able to keep all of the really good data. We have a really good relationship with Reuters, but we've kind of been able to become a very small and focused company as well, and it's been good. Our relationship with Thomson Reuters is better than it's ever been, and we really appreciate that. Another thing, and we're not really going to cover this too much because I'm more of a technician at heart, but if you're interested in news, fundamental information, and market demographic, the software that we have that powers our real-time software, we call it Metastock Zenith, actually is a white label product of Icon. And we sell it for a fraction of what they charge, but it's the same type of news and the institutional traders actually get. But we're not going to talk too much about that. What I want to talk to you a little bit about today is some of the 3 of my favorite things that are built into Metastock that you can use it right out of the box. One of the things, we win a lot of rewards, like earlier this year, just actually I think it was about a month ago, we got an award called the UK Forex Award for the best provider of technical analysis software. So we're pretty proud of that. But one of the things I'm really proud of is actually our software has been rated #1 in its price category every single year since like 1992. 1993, somewhere in there. So for just a huge amount of time, it's been just rated #1. And it's a very, very cool toolbox. It does a lot of things. Today, what I'm going to talk about is I'm going to talk about 3 of the methods, if you would, that are built into Metastock. I'm going to start with RMO. It's a method that I started trading with and still use to this day. I'm going to show you kind of some of the support and resistance tools that are in Metastock, and I'm going to close with the LCI method. But the point is, it's a product that we've been developing for 20-something years now. And there's a lot of things I could show you. I've gone in and actually one time I flew down to Saudi Arabia and I trained people for 2 weeks on how to use the software and all of the different parts of it, and we were able to get through it all. But there's a lot of stuff I'm not going to show you. With Metastock, it is a really cool toolbox. Helps you scan through your securities to find stocks that have met your criteria. We'll show you that a little bit. It allows you to backtest trading ideas to see what's working right now and what stocks it's working with. There's a patent pending forecaster model that uses some incredible technical analysis. And then there's a really cool expert advisor that I'm going to show you too that kind of helps you learn about the markets and technical analysis techniques and stuff like that. My main goal today is actually to get you interested in enough in Metastock so that you'll take a free trial of it. So I'm setting the bar really, really low. But I want to show you things that are also going to be very, very useful for you. The whole reason for this slide, and the reason I put this slide up here, is I want you to understand that we're going to kind of get very, very myopic. We're going to really focus on some very, very specific things that you can use in your trading right away during your trial as you're learning about some of these other things to help you make more money. So, in any case, the first thing I want to talk about is RMO. And RMO is a great model. I've taught so many lessons on Rahul Mohinder oscillator. RMO stands for Rahul Mohinder oscillator. I'll tell you a little bit about who he is. Rahul is one of our best dealers in the world. He is such a consistent dealer for us. And when I say dealer, I mean a reseller. He runs a trading company in India, and he has 3 offices in India, and he trains people how to trade. And that's what he does for a living. And he's been doing it for, I think, as long as I've been with the company, and well before that. He's also a panelist on CNBC and CNN India. And what happened was, like a few years ago, Rahul was in our office, and we asked him to show us one of the methods that he used and one of the things that he was teaching his customers. And what happened is we decided we really liked it. We decided it was a method that was really, really cool. And we actually purchased it from him. It's been included with Metastock ever since Metastock 10, and obviously I kind of have a lot of good feelings about it because, yeah, it's one of the systems that has been tried and true. I've been using it for, gosh, I don't even know how many years now, but it's one of those things that I can kind of go in. And one of the reasons I like to show it to people is it's very easy. I want you to get involved in Metastock. There's a reason it's been rated so well for so many years. So it's easy, but it's also 100% objective. So we're going to look at some LSE stocks. They're just some things that I actually kind of just did a little scan for today to kind of get an idea of something that would work. We'll actually look at some stocks on the London Stock Exchange, but you can use these on whatever you want, whether it's here in London or whether it's an offshore stock here in the U.S., whether it's Forex. It works on a lot of different instruments. It also employed solid money management. And I actually had Simon talked a little bit about the turtle traders and kind of how successful they were with what they were doing. But one of the things that they did instill in a lot of their traders was discipline and sticking to the rules of their trading plan and having stop losses in place all the time and knowing exactly what their rules were. And I think stop losses and having those in place are very, very important. So we'll talk a lot about that. Anyway, let's talk a little bit about what this is. In a nutshell, this is a trend-following strategy, and I'm sure you've heard like the old adage, "The trend is your friend," or "Befriend the trend," or "A rising tide lifts all boats," or whatever you might want to say from that. But it looks at the trend in 3 different ways. It looks at it from a short-term and a long-term and a mid-term type of a perspective, and it's just designed to trade in conjunction with the trend. Okay, so that's what it is. That's what it's going to do, and it's very, very simple. There's 3 steps basically, and the first step is going to be to identify the primary, the prevailing trend. So obviously, if you want to trade with the trend, if it's going to be your friend, you want to be able to identify in a very specific way what that trend is going to be. So let's go ahead and go into Metastock. I'm just going to kind of swap into it right here. We'll go ahead and make it full screen, and there's a couple of charts. This came off on some scans that we were running today. I think I wanted to start with Anglo-American. Okay, and we'll show you it on Anglo-American and HSBC. I was looking for some things that had some liquidity to them, some things that looked like they were good. I have to be honest, I've never really looked at a lot of LSE stocks, so I just kind of picked these out of kind of the list of ones that were in the major index that I was looking at the time, which I think was the ES 100. Okay, so let's get back to kind of the task at hand, and that's kind of identifying the trend. So what we want to do first off with the Rahul Mohinder oscillator is to identify the primary trend. Rahul calls it the primary trend. You could also call it the long-term trend, but we want to be able to trade in conjunction with kind of the direction everybody else is trading in. So we need to be able to identify that. And the way that Rahul does that is he makes use of what he calls this Rahul Mohinder oscillator at the very top. Okay, I'm going to make it full screen. I'm going to zoom out just a little bit because it's been in a very bullish state for a while, and I just want to be able to show you that it's down below 0 at one point. Okay, and the way you read this right now is actually pretty simple. Rahul is very specific when he teaches this method that size and shape don't matter. The way we read it is it's either going to be below zero, as it was here towards kind of the first of the year, or above zero, as it has been since February 17th. So since February 17th, we're going to say this was above zero pretty much this whole year on a daily basis. And that means that in the long-term trend, we're bullish. Okay. So, and how does that mean for us in terms of our trading? As long as we're above zero, it's pretty simple. If it's above zero, what we're going to do is we're going to say that we're bullish. Okay. Equals bullish. Okay, and if we're bullish and we want to trade with the trend, basically it means we can't take short positions, and that's all. It does mean we're allowed to go long. Okay. If we're down below zero, it's pretty easy. It's very straightforward. Everybody can agree right now. We're not looking at what the earnings are on this particular Anglo-American stock. We're not trying to guess what the news releases are going to do with this particular stock. We're just looking at kind of the trend and making an assessment. Okay, this is long term. This looks like it's going up. Okay. If we're down below zero, what we're going to say is it's bearish, which means we just reverse this. We don't take long positions, and we're allowed to go short. And I try to be very careful with this because just because it goes from down below zero to up above zero doesn't mean that that's a trade that you're ready to take. It just means that you're now allowed, your perspective of the stock has changed, or the future, or the forex, or whatever you're looking at has changed, and you're only going to take long positions on it right now. Okay, makes sense for everybody? I actually don't have. Do I have access to the questions over here? Let me see. No, I don't. Okay. Okay.
Jesse, let me give you access. Since we're the last speaker, there's no harm. We've traditionally. I have been moderating the questions because the multi-speaker event.
You don't want somebody to shut down the whole room.
It's happened once or twice.
It's happened for me in the events that we do. I totally get it.
To my great surprise, but here we. I know you're a professional and you're also the last speaker of the day. So there you are. So that will allow you to see directly to the questions panel. You should be able to pop that out.
Oh, Henry!
You'll see from Henry, best charting platform software. So, a fan there.
All right. Henry is my buddy. Oh, my phone's ringing. After you say I'm a professional, I realize that I left my phone on. So let me turn that off real quick. Okay, Henry, it's good to see you. Jeremy asked another question. The cat's out of the bag, I suppose. We have a brand new update that's coming from called Metastock 15. It's a major upgrade. I'm not going to talk about it today because I'm not ready to talk about it. But our official release date is Tuesday, November 1st. Metastock 15 will launch. Okay, so cat's a little bit out of the bag on that one. This you can do in 14 and you can do it in 15. Everything I'm going to show you today. There's some new cool stuff in 15. They added a lot of stuff, especially for international customers. That if you watch Metastock.com, there's going to be a crap load of information on it on Monday. So, in any case, where was I? If you have questions as we go, please by all means ask them. Okay. So we talked about the primary trend. And let's just kind of go and show you on the chart. You can look at the indicator here. If we go up above zero here, right here is where it kind of goes from down below zero to up above zero. You'll notice we put this little trend ribbon on the bottom of the chart where it says I'm bullish. So you can look at the indicator if you want to. You can look at the actual ribbon right now. If we're looking, and you're always going to be looking at the hard right edge of the chart, right? But if we're looking at the hard right edge of the chart, our anticipation is this is going to go bullish right now. Okay, so we would be looking for long positions. Okay, that's it. That's easy. Again, to recap though, because I like to repeat myself, if the RMO is in a bullish zone, you're allowed to buy. You're not allowed to short. It's not a trigger just because it goes from below zero to above zero. Okay. Step two is we will look at the short-term trend. And let's show you how to do that. if we come in here, there's an indicator that Rahul calls swing trade number 2 and swing trade number 3 right here on the chart. And I'm just going to show you those real quick. I do like a little bit of a different view. This is the default view. And anytime you want to change something in Metastock, you just have to double click on it. You can come in here and make this align. And this is kind of the way I prefer to look at it. You don't have to do that. It's just the way I prefer to look at it. What we're going to be doing is for step number 2, or for identifying kind of what the short-term trend is doing, is we're going to be looking at this pink indicator. And you'll notice that it's also either above 0 or below 0. You read it the same way. In fact, right now, if we're looking at it on the hard right edge of the chart, it's still bullish. It's above 0, so that means short-term we're bullish. If it's down below 0, it means it's short-term that you're bearish. Okay, that's it. And you use it in conjunction with that. So right here, ever since about 9:20, we've been bullish both short-term and long-term. Okay. The way we use this indicator is exactly the same way. If your primary trend is bullish and your short-term trend is bullish, then you're still allowed to go long. Okay, and then you wait for the buy and sell signals. If they don't match, like if we looked at the days before here where it was bearish short term, but bullish long term, you wouldn't do anything. You'd wait for them to match. Again, it's about waiting until the opportunities and the momentum is in your favor, and until the trends are in your favor. Okay, so in this particular case, here is where everything started to match. Okay, now if I come to the chart, just like we push the ribbon here on the chart for you, what will happen is when it's bearish short term, you're going to notice that it starts to paint the bars red when this is down below 0, and when it goes up above 0, that's when it starts to paint the bars blue for you. Okay, very, very simple. We'll talk about triggers next. Nothing that we've talked about yet is triggers into the market, but those are also very, very easy to use. Okay, so right now, if we have the primary trend bullish and the short-term trend is bullish, as is the case on the stock that we're looking at, we're allowed to buy, we're not allowed to short, and it's not a trigger yet. Okay, step 3 is about the trigger and the money management and all those other types of rules. Okay, if they don't match, if the primary trend and the short-term trend don't match, well, we just wait for opportunities. We use the Explorer to scan, or you can use the Explorer to scan for other opportunities. So, but they won't match. Now we just want to look at identifying the trigger, and then we'll talk about how to manage a trade once you're in it and all that kind of stuff. So let's go ahead and go back here. We're going to look back at the swing trade 2 and swing trade number 3. We've talked about how to look at the RMO and how to evaluate the RMO. We've talked about how to use the swing trade number 2 and evaluate swing trade number 2. And now I want to talk to you a little bit about how these buy-sell arrows get posted on the chart. Okay, so and they have to do with the correlation between our short-term trend, this purple line, swing trade 2, and the blue line, which is swing trade 3, which I haven't really told you what it is yet, but it's just the medium-term trend. So whereas this one is very fast and adaptive, the first one we looked at is very slow to market changes because it's looking at the longer term. This one fits somewhere in between. And the trick with this one is we really aren't looking at whether or not it's above or below 0. That's not part of what we're looking at. What we're looking at is we're looking for a momentum shift. So for example, if the market, let's just look at it in conjunction with kind of like where this buy-sell signal comes in. If the market starts to go up and the momentum starts to shift in the direction of the trend that you're anticipating, that's a great opportunity to go ahead and get in the marketplace. And to make that totally 100% objective, what we look for is we look for when the short-term trend crosses up above the long-term trend. That's what Rahul calls a change of momentum or a change of direction or a change of force. Those are the kind of the terms that he uses to describe that type of an event. And that's actually where we get in the marketplace. So when that happens on a chart, and it's happened quite a few times, it happened right here. Okay, you had a switch from down above to from down below to up above. Here you had a switch and a reverse switch of momentum. It went from up above to down below, and then the very next day it went back up above. Whenever this change of momentum happens, regardless of the state of your long-term indicators and your short-term indicators, it's going to put a buy and sell signal on the chart for you. And that's exactly kind of what you're looking at in terms of a trigger to buy. Okay, so let me just get rid of these lines. You'll see there's a buy and a sell arrow that comes in on the chart. That all happens automatically for you. And let's just focus on what we would do with those particular those particular things in the marketplace. So and how we would take advantage of that buy and sell signal. So I'm going to look at the very last trade example, and then we'll kind of go back a little bit longer because I want to show you how to manage the trade once you get into it. But again, it's all very simple rules. I'm just going to kind of zoom in right here. Okay, and let's just pretend right now that we're looking at this stock back in October 18th. So that would be roughly just over a month ago on this chart. We didn't have a position on it, so and we were looking to kind of maybe take a position on this. So step number one is what we would do is we identify our long-term trend, okay, which was bullish. Step number two, we just we're up above zero. We have a short-term trend is bullish, so everything's okay right now. Step number three, we have that change of momentum, which puts this buy arrow on the chart. Okay, so then the rules are for that is as soon as everything lines up, okay, because a lot of times this all happened in the same day because we're in the middle of a pretty long upward movement on the stock. But in terms of a lot of times it won't all happen on the same day. You just wait until it all lines up, and we'll talk about that in a minute. But in terms of this, when everything lines up, you're going to take a look at kind of the high of the bar. And this is a daily chart, but you can do this intraday as well. I'm going to take a look at the high before that, and you're just going to determine, okay, this high is higher. I'm going to put an entry order right in above that level. Okay. And then what you're going to want to do, because again, it goes down to risk management. I want to know exactly what my risk is. And so what I'll look for is, particularly in terms of placing a stop, is I'll look for a little bit of a pivot. And a pivot is a lower low surrounded by two higher lows. So right here where this sell signal came in also happens to be a pivot low. You have your lower low surrounded by two higher lows, and this has effectively set up a bit of a support for you, if you would. So what I'm going to say right now is I'm just going to look at that value. I'm going to put a little bit of white space below that. I'm going to actually give it a little bit more space than usual because it did. This was a bit of a lower low right here, and that's what I'm going to use as a stop loss. Okay, so what I'm saying to myself is, okay, tomorrow or the next day after that, if this breaks through the high of today, which I've put at 1043, then I'm going to go ahead and buy the stock. Okay, and as soon as that happens, I'm going to put in a stop loss. In this particular case, I'm going to put it at 970, 979. Okay, so now I have a pretty good idea of kind of what my game plan is. I'm not trying to make decisions as we go. I'm not trying to make decisions on the fly if this trade comes against me. I know exactly kind of what my risk is. And of course, the stock can gap against you. You can end up losing a little bit more money than what you thought, but in most cases, you're going to get a pretty close idea of what your risk is. The next day, we go ahead and place a long trade because we go up above our entry area. And right now we're in a trade. It's making a little bit of money. It hasn't done too much yet, but that's just how you would go ahead and place a trade. Now, so that I can kind of walk you through exactly how a trade would work through and how you'd kind of use this to place a trade, what I'm going to do is I'm just going to go back in time and using this same security, we're going to go ahead and kind of just show you how everything would work through this. Okay, so I'm going to go ahead and go back quite a bit of distance in time. Now, this stock has had a pretty dramatic uprise. Since it went RMO bullish right here, it was at $400. Okay, it's been RMO bullish all year, and it's gone up to about $1,100. So my argument about that is, if you're only looking to take long positions during that upward rise, and looking to kind of take pieces out of that trend, is that going to work well for you? Absolutely. And just to kind of put it in perspective, and again, this isn't a stock that we cherry-picked, but we had also a huge run down in this stock, and it went from almost $1,100 down to about $400 before it went bullish again. And if you're only looking to take short positions all the way down that ride and putting those odds in your favor, it's going to work out pretty well for you. I'd also point out that we're not talking about taking the exact low, which would have been back here. Okay, we're not taking the exact high as well. You'll notice it made an exact high here where it was bullish, and then it kind of started to head down. You're never getting in at the exact bottom, and you're never getting out at the exact top with this system, but you're taking big, good chunks out of the trend. I kind of getting a little ahead of myself, but that's kind of one of the reasons I really like this particular methodology. To be frank about it, if I was looking at this particular stock right here, and here we got a buy signal, but it took so long to go bullish that I'd probably be a little bit hesitant. You could go ahead and buy here, but I'd probably wait for a kind of a new setup or a new signal to kind of come in to kind of get me into that marketplace. So I'd probably be looking to buy right here where everything was bullish all at the same time, and we've kind of set up a little bit of a trade to come again. So let's just kind of hypothetically say this is where we decided to start trading into this security. So again, what I'm going to look for, okay, and now we're looking at March 21st of 2016. What I'm going to look for is, are we bullish? We're bullish. Are we bullish short term? We're bullish short term as well. And we get that change of momentum or that change of force. And what I'm going to do is I'm going to go ahead and place my entry setup using the same way as we did before. So I'm going to look at the high. I'm going to say it has to go right above this high for us to get into the marketplace. I'm going to set up my stop loss in case we go into that trade, and my stop loss is going to be right here. Okay. So now what happens, this trade would have lost us money had we got into it, right? But since we're waiting for that additional momentum confirmation, what happens is we don't take the trade. We end up getting a sell signal in the marketplace. It comes down, it kind of goes in this sideways channel for a little bit, and we just haven't wasted time in this trade because we were waiting for that additional rule to kick in. And that happens. That's why it's kind of important to kind of understand what that rule is. So let's kind of go a little bit ahead in time. I'm just kind of going to zoom out a little bit. Finally, we do break that level. I'd probably, again, we've been sitting on this buy signal for a while. We had a recent sell signal. I'd wait for another setup to happen, which does happen. Okay, and so then we just kind of follow the rules along with that. We'd go ahead and put in a long position right here. Let's go ahead and do it. Okay, long position here. Okay, we put in a stop loss probably right here is where I'd put in that stop loss. Okay, and then we'll just see kind of how it does. Here, and this is kind of a little bit important, we kind of get a little bit of a run up, but then it runs back down, a little bit of a kind of indecisive activity. Here we get a sell signal, okay? And when you get a sell signal, when you're in a long position, what you're going to do is you're just going to start paying attention. Because if you ever go bearish short term, which we do in just a few days, and bearish long term, then you're going to reverse your position. You're going to look to kind of get out of that position. But that doesn't happen. What happens is it does come back down. Kind of sets a new bit of a support level here, and we're going to use that as an opportunity to move our stop loss up. Okay, so we've had this bit of a sell-off that set up a new sell position, and when you want to move your stops is when you have that buy signal come back into the marketplace. Okay, and so what I'm going to do now is I'm going to put my my stop loss right below this activity right here. Okay. And it doesn't get terribly decisive, so we move our stop loss when this buy signal comes in. Okay, comes back down again. It doesn't want to take off, right? Comes back down again, and we move up our stop loss when we get this buy signal. Okay, comes back down again. We move up our stop loss when we get this buy signal. Okay, this buy signal here makes us move up our stop loss. Okay, and then we just end up stopping out of this particular trade, but we did move up our stop loss and we took a little bit of advantage of the upward movement there. Okay, we're still bullish on the security, but when you stop out, you stop out. You're going to get out of that particular trade. So, so we stop out, we get a sell signal, we get another re-entry criteria here. Okay, I'm going to go ahead and get rid of these charts here. Here we get a buy signal. Again, we'll just use the same rules. Okay, boom. Here's kind of the recent low value that we're going to use as kind of our new support level. Okay, and then with this one, we finally start to kind of make some pretty good money. It pulls up, gives us a little bit of a run up, pulls back a little bit. We get a new buy signal, so we move up our stop loss. So right now, we're locking in that profit potential. Okay, here we get another opportunity to move up that stop loss. On this buy signal, we move it right down to this price activity, and we take this trade for a profit. Okay, that's how it works. Generally, it's very, very mechanical. Once you kind of get into the rules, here we would have taken another trade, and we'd still be in that trade. Our stop loss would be right here. Okay, again, it just works pretty well, and it does a really good job of taking chunks out of that upward trend. And that's how it works. I don't see a lot of questions. I can't see the questions, so if you got them, ask them. Okay, and again, such a nice upward movement, and then we're just looking to take bullish trades and take pieces out of it as it goes up. And it hasn't been a real smooth ride. You know, it's gone sideways for a long period of time, and now it's kind of starting to blow up. And this last trade that we had gone in and probably make up for, well, okay, let's just look at where we would have entered this last trade. It would have been right here. Entered in at 849. It's now up 300 points. So right now we'd be pretty happy trading this methodology. Okay. Let me show you another example. This is just something I pulled out of it's HSBC. This is something I pulled out of the major index this morning. I'm going to apply the model. If you have Metastock to apply this RMO trade model, what you're going to do is you're going to go ahead and click on the apply template. Go ahead and click on RMO trade model. And we won't go through this. Here's an example of the alerts. It's giving us an alert from that. This stock has had a pretty good bullish run. And again, we've been bullish the whole way, been putting in an entry order here. Probably would have stopped out on it, probably would have got back in right here, moved up our stop here, moved up our stop here, moved up our stop here, and we'd still be long, but we would have just moved up our stop to right here. So again, we're going to take advantage of a lot of these really good trends that happen in the marketplace. Okay, so that's RMO in a nutshell. With a couple of examples that were kind of randomly selected. Again, what I like about it, and I thought I had that on the slide, but what I like about it again is it's a very objective system. It's 100% objective. It's 100% rule-based. It employs solid money management and works on all time frames and a lot of different markets. And you can just apply it. It's something that you can start to play with while you're trying out Metastock, and you'll enjoy it. It's one of those things that works in so many different instruments. I've shown it. I just showed you it on 3 stocks I picked out of my list of stocks that were on the index of LSE. So, and the reason I picked the index is because that's a good place to start, usually when I'm looking at it. But I've shown it literally all over the world. Works well with Forex if you're interested in Forex, and it's a very simple process. And what I've learned over 20 years is simple works. You know, the better things are, the less you can complicate things and work with a business plan that's working well, the better that's going to work for you, because you understand why you're doing stuff, because you have rules in place that you're going to use, and discipline is key when you're trading. So, all right, anyway. Let's talk about one of the other things, and again, I'm just covering 3 things that I really like in Metastock. There's other classes that I do that talk about testing and that kind of stuff. There's a lot more into Metastock, but this is another one of my favorite things in Metastock, and I play with it all the time. And a lot of people use support and resistance. They look for breaks of support and resistance. How do you pull out of a trade? On RMO, it'll be one of 2 things, Gulam. Thanks for the question too, by the way. and I can't believe it's 140. I better hurry. For RMO, there's going to be two ways that you get out of the trade. Number one is everything goes the other way. So if you're in a trade and your primary trend goes bearish, and your short-term trend goes bearish, and you get a change of momentum, you're going to get out immediately at that point. And then, in fact, you're going to be looking to reverse that trade because we're no longer bullish on the trade. All of a sudden, then we're bearish. That happens probably about, I would say, roughly about 15% of the time, if not less. Most of the time, you're going to be moving it out on one of the stop losses that you've moved up as you're in that trade. That's going to be what happens the majority of the time. So it'll be one of those two things. Hopefully that answered your question pretty well. Okay, so you're welcome. You're welcome. And in my experience, like most of the time it is, we got into a trade here, right? We moved up our stop, we moved up our stop, we moved up our stop. We wouldn't have gotten out of this, but most of the time we still wouldn't have gotten out of this particular trade, but most of the time it's because you hit a stop that you've moved up. Okay, and that's kind of one of the nice things about it is I really like this method of looking at the lowest pivot, because it kind of makes sense. Okay, I get my new buy signal here, right? I'm already long in a position. Rahul says you can buy more if you're already in a position and you get another buy signal, but I prefer to buy as many as I'm going to buy right at the first of the first. But right here would be a kind of a natural place to put it because you've set up a new support level, and so you're putting a new line in the sand. And most of the time, it's going to be that line in the sand that gets you out of the trade. It usually isn't that everything turns around and now all of a sudden you're bearish on it, although that does happen. Most of the time it's because of that. Henry, I'm actually going to show that. Henry asked, can you do more webinar scan end and entry and exit on DT trendline? I'm going to actually show that scan today. So yes, absolutely. He's talking about the dynamic trading tools, which is where we're going. A lot of people are using dynamic trading tools, and what it does is it's a few things. It's indicators that are automatically going to put support and resistance. There's long-term and short-term versions of them. It'll also draw trend lines, and they come in fully automatic and manual versions. So what that means is, let me go ahead and I'm going to take this chart that we've got and just show you kind of how they work. I have a template, but because we've been testing 15, my template is saved in a different version of Metastock. So we're going to make a template with it instead of just applying the template. It's pretty easy to do, and I kind of give you an idea anyway of how Metastock works from a perspective of adding indicators and stuff like that. If you go into your into your indicator quick list, this is, for those of you that don't have Metastock, this is your indicator quick list, by the way. This lists all the indicators, and there's a huge amount of them. There's a couple hundred of them in here. The ones that I want to focus on here today are the ones that are called DT resistance and support and trend lines. Because what these will do automatically for you is they'll actually place on the chart for you support and resistance areas based on kind of the calculations that we do looking at the chart. Okay, so if I wanted to find if I wanted to use that, all I do is I actually just grab one of these off and I drag it onto my chart. So this is the longer term resistance. It's the automatic version. There's a manual version that you can play with if you want to. I usually just use the automatic versions, and I'm just going to drop that onto the chart. And this was resistance. Okay, so that it hasn't had a new resistance since right here it established a new long-term resistance level. Okay, I don't like to look at them this way. Here's how I like to look at them. If I double-click on this, I can change the color. I'm going to make it green. I'm going to change the weight because this is the longer term. I want it to be a little bit more visually appealing and a little bit bigger on the chart. So I'm going to make it a little bit fatter. And then I like to look at it in this kind of dotted line because then it actually kind of looks like resistance. Okay, and I'm going to do that with the shorter term as well. So we'll just do the automatic version of the shorter term. Okay, you'll notice this moves around a little bit quicker, but we haven't set up a new resistance area here yet. So our last resistance is going to be right here, and I'm just making the changes to the coloring. So now I've got my, I'm going to make that just a little bit bigger. Okay, apply that to a chart. I'm going to go ahead and click on close. Here we've got that kind of the shorter term resistance. We haven't set up a new overhead resistance, so right now we're just looking at them right here. We can also do support. So from a long, I'm going to just add these indicators real quick, just in this case of time, but I'm just going to drag them and drop them on the chart. You do want to merge them on the scale on the right. Here's the support level. This is quite interesting too. Where this showed up. I really haven't done this yet on this chart. Apply. Okay. So you notice how support was also resistance, and you notice the big move that we've had since it crossed. That's pretty interesting. Let's go ahead and put the shorter term automatic. Oh, that's not what I want to do. Let's do the shorter term automatic support level here. Okay. So there's my shorter term automatic support. Again, I'm just going to make the quick changes to it so that it looks pretty to me. Go ahead and click on close. That's fine. Now I kind of have all those levels kind of plotted on the chart. It also does trend lines. I think if we do an uptrend line, it's going to find some uptrend line activity. So what I'm going to do here is I'm just going to drag this. I'll drop it onto the chart. It didn't find a longer term trend line, so it didn't plot. That's just basically the way that it works. So let's do the shorter term. Here we had a little bit of a shorter term trend line that did cross down below a few days ago. So now that's kind of cool. I have a whole template that incorporates all of this. It automatically puts on the support and resistance. But where this is really cool is the ability to find stocks that have crossed through a support or a resistance level. This stock's a great example of that. Right here we crossed through a support and resistance level, and what's happened since? Well, it's went from $475 to $627 since it passed through that support and resistance area. So that's actually pretty cool. And a lot of people, what they want to be able to do is they want to be able to find the breakouts on those support and resistance areas. So we can do that in Metastock. Since these values are automatically calculated and automatically generated, we can say, okay, give me a list of all of the stocks that have broken through support or resistance or through one of these trend lines. And let me show you how that works. I think Salmon answered that question. Ben asked a good question. What time frame do you normally apply this method? I normally work, and this is not necessarily indicative of our customers. This is more indicative of me, but I normally work quite a bit during the day, and I just don't have the time to be looking at real-time charts. And then I go home, and I try and play with my kids and read to them and stuff like that. And so generally I'm always looking at daily charts. With Metastock you can apply these methods to any type of a time frame that you want. For me, based on kind of like where I am and how busy I'm during the day and how busy I'm at night, daily trading works really, really good for what I'm doing. Okay, so for me personally, I'm using daily charts. Okay. If your situation is different and you want to use this intraday, yeah, you can. It's not a big deal. Okay. So I'm going to show you how to scan. Well, again, just to kind of get back to where we were going, what I want to be able to do is I want to be able to scan and I want to find any stocks that are currently breaking through like one of these resistance or support levels. You can also do trend lines and that kind of stuff. And to do that, it's very, very easy. I'm going to go ahead and click on the scanner right here. And here you've got your DT support and resistance long-term, short-term, and trend line breakouts. Okay, so let's just do the, let's see if there's anything that has a longer-term short support and resistance area right here. And that's the only scan I'm going to run. I could run all of them if I wanted to and go look at the reports for all of them. But I'm looking at the time and I have 15 minutes and still haven't got to thing number 3. So I better hurry. Down here in the instruments, and just to kind of give you an idea of what's available here, Reuters covers approximately 376,335 issues. So regardless of what you're looking for, if you're in Asia and you're just following along with that, you can do Asian stocks. If you're in Europe and you want to follow LSE, you can do that. If you're in if you want to trade U.S. stocks or U.S. optionable stocks, you can do that. And they've put it together in a way that's very, very easy to find. So, for example, if I wanted to, I could come down here into Europe, Middle East, and Africa, and I could say, well, scan the whole LSE, and it would grab all 4,500 of those issues for me. Now, I'm not going to do that scan right now. I'm going to make it a little bit smaller just because of the time. Time is more what I'm worried about right now. Let's look at, I'm going to click on this index constituents, and I'm going to look at the FTSE 100. Okay. So we're going to scan through the FTSE 100 just because I know it's going to run faster than 4,500 stocks. And we're going to find all the stocks that had broken through that support and resistance level. So I just click on the Start Exploration right here. And it's going to go ahead and chunk through those and kind of tell me which ones have. And I'll show you how this report looks and kind of how you read it. And we may have some results. We'll definitely have some results, but we may not have any that are actionable. But again, it's what I'm trying to set you up for is a free trial. I want you to try it out. So that's why I'm showing you my favorite things. And then that way, if you want to do the trial, you can. Right here, here's a report. Okay. So right here, the way that you read this one is you see this breakup column and you see this breakdown column. So this one broke up through resistance and this one broke down through support. And there's a number here. So if we looked at MediClinic 263 days ago, it broke up through resistance. Okay, well, we don't really care about that. That's almost a year ago on daily data. We want to look at the ones that have recently broke up through resistance, and that would be St. James Place. 4 days ago, it had a breakout. If you were looking for breakdowns, maybe we're a little bit more bearish on the market. Brit AM Tobacco had a breakdown through support, just actually right now, today. So if we could go ahead and kind of take a look at that one. Whitbread had a breakdown through support 2 days ago. Smith & Nephew had one 3 days ago. So you kind of get an idea of how the report looks. This is just how many days ago it broke down, and this is how many days ago it broke up. Okay, and you can sort these columns, and what you want to do is focus on the ones that have recently broken up through that longer-term resistance. So if I opened up Whitbread, it's actually going to have a recent breakout. Now, and I'm not recommending you buy it right now. Take a look at it and see if it's something that you like. That's something that broke up today. Or I'm sorry, Brit AM is something that broke down today. Okay, make sense for everybody? I'm fairly certain you'll get a link to the. Oh yes. Simon says yes. I'm going to take all 9 hours of your recording and make them available. So that's the dynamic support and resistance tools. Again, there's all kinds of scans that are available in Metastock. Again, we're kind of just focusing on a few of the things that I really, really like, but you can find just about anything that you want. And it'll allow you to kind of zero in on what you like and what you want. Well, I want to show my last system, and this is one I'll probably go quickly through because I'm looking at my clock, and I don't want to, I know you guys are probably tired anyway, right? But I don't want to overstay my welcome. This is an LCI system. LCI stands for Logan Connors. It's a system that actually a former employee of Metastock wrote while he was here. He started on our support team. His name's Logan Connors. Henry probably knows him. He then worked on our sales team, and he quit our company to go manage a hedge fund. So he's very smart. He knows what he's doing, and he looks at a lot of things. I'm just going to show you kind of a few of the highlights. He goes by. Oh, Ben asks, how can your system monitor so many instruments? Well, we just monitor the ones you're interested in. We can monitor as many as you want because we get the data from Reuters, who's probably one of the biggest data vendors on the planet. But yeah, you just monitor the ones that you're interested in. In other words, like, you're not going to look at 330,000 issues, right? Certainly most of you, unless you're in Egypt, are going to be trading Egyptian Stock Exchange, right? But the fact of the matter is you can monitor what you're interested in. You can test these ideas against what you're interested in and really find the ones that work well. So, well, thank you. I kind of am impressed too, Ben. All right, so this one automatically identifies for you support and resistance levels. It does fib retracement, volume exhaustion and expansion, volatility, overbought, oversold conditions, trailing stops. There's about 93 things that it looks at to automatically identify buy and sell signals for you. Logan's kind of a bit of a mad scientist, but it also automatically draws support and resistance levels on the chart for you. It looks at Fibonacci retracement levels, and it does those automatically for you as well. And it also looks at volume indicators. And if you like this, in fact, I would recommend that you do your trial, because I'm doing a 5-minute on this thing. We're going to get through this, but there are lots of trainings. I'll show you the easy link to kind of learn a little bit more about this. It uses LCI. It does give you a stop loss. When you're looking at a chart right here, you would have got like a primary entry signal. It gives you stop losses, which are these blue lines. When the stock starts to go sideways, he gives you a shorter light blue line, and that's what you would use as stops. And it has a scoring indicator. And so it uses those things, and it kind of gives you kind of these automated buy and sell signals. And the way I kind of found the ones that I'm going to show you today is the same way I'd recommend that you find them. I went in and I told Metastock, okay, let's run a system test. And we'll just use the LCI systems and tell me which stocks work best with the LCI systems, whether those are his bounce trades or his breakout trades. And a few came up. Henry says, I've been using Metastock from July. It seems like you've been using it for longer than that, Henry. Okay, I'll take your word for it. seems like we've been friends for longer than that. Anyway. Let me not get distracted. I can't get to, anyway, with Metastock, one of the things that you have the ability to do is you can come in here and say, using this, and this was against that same list of 100 stocks, which stocks work the best for that? In other words, how well does this work over a list of 100 stocks, and which stocks does it work best on? So out of like the whole SE 100, which is I believe what I scanned against, no, that was the FTSE 100, these stocks work really, really well against it. And that's kind of just a preview into system testing, which is another thing that's available in Metastock. But if I wanted to show you exactly what LCI is, let me just give you a 5-minute glimpse. Let's do it on HSBC. I know it's going to work fairly well on HSBC because I already tested to see how well it would work. What I'm going to do is I'm going to apply one of the templates here. This is called LCI, SR main. I'm going to go ahead and apply that to the chart here. And we'll zoom in a little bit. Right here you had to, at first glance, what would have looked like bad trades. But they weren't, and I'll show you why in just a second. Here you had a good trade. Here you had a really good trade. Here you had some other things that looked at first glance like bad trades. When they weren't. And I'll show you why in 10 seconds. I'm going to actually go into Metastock. It's got a commentary function. And it's going to, if I actually kind of put the bar right on this buy signal, it'll tell us what it would have told us back on that buy signal. But under the entry confirmation, it says your initial entry within the next 3 bars, you want it to break down below 537.20 before you're allowed to go short. So even though these look like bad trades on the chart, because it never actually hit 537.20, you never actually took those trades, which is why it tested so good. On this breakout trade, though, I'm going to kind of move that commentary to this breakout trade. You notice that it had a kind of a neutral, bullish, bearish. This is an automatic score that he does. It actually kind of was a little bit neutral. But then it kind of gives you the same entry management rules. So again, a big part of this is how do you get into your trade and how do you get out of it? Okay. On this one, we'd want a break of 601.90 for the allowed entry within the next 3 bars. Okay. It did hit that, and then it's going to tell you what your entry stops are going to be, and your breakout signals are going to be. Then it's going to do some analysis on what the price looks like, and what the volume looks like, and what the time is looking like, and where your Fibonacci levels are, what your stop loss is going to be. All of this stuff is kind of just provided to you. And this guy's doing a really good job. This is the system he uses to manage his hedge fund. And it's just included in the program. And I do regret the fact that I'm at 159, right, or at 8:59, I think, London right now, because I don't have the time to do it justice. But I would recommend that you go through the online trading provided by them. He's got all kinds of videos that talks about his system and how to run the scans and that kind of stuff. And it's just one of the things that's available as part of your trial. And so you can go up to his website and you can get all kinds of training on LCI. It's a really comprehensive system that does a good job of kind of breaking up a lot of complex issues and giving you just entry and exit signals based on that. Henry's just feeding the testimonials in. Thanks, Henry. Okay. Gulam asks, how much tax do you pay on profits? Well, it depends on whether it's a short. Well, I'm in America. Depends on whether it's a short-term loss or a long-term, or a short-term or a long-term gain or loss, and it can be quite a bit, depending on kind of the difference there. Any answers in respect to that would also depend on just a U.S.-centric answer, right? But it can be quite a lot. A lot of people here will incorporate a business just so that they can take it as a trading expense, and you still pay taxes on it that way, but you're not paying short-term cap gains, which is a whole different story. And a little bit off topic for us. So that's kind of it in a nutshell. That's what it does. Again, I'd reiterate, 23 years in a row. The only thing I want to impress to you is, number one, this is a great software product that will help you regardless of where you're at in your market. If you're looking for some good techniques, if you kind of know what you're doing and you just want to start testing trading ideas and kind of refine your system, it'll help you. But 23 years in a row, it's been rated #1. It's a great software program. It would have to be to win that long. Like I said, we just got the UK Forex Awards, which was, I wasn't able to fly to the UK based on the notice, but it was awesome to get the UK Forex Awards on it. Here's some testimonials that I won't read. Henry's given us enough for today. Pricing on this, again, I'm going to give you a free trial on it. Metastock DC is like $59 a month. It updates every hour. It does daily data, weekly data, monthly data. It doesn't do intraday. But the daily bars do update every hour, and it includes the system testing, the forecasting, the scanning, the expert advisors, and the data for a region of your choice. So that would be Europe, Middle East and Africa, or North and South America. You could actually do both for your free trial if you wanted to. Metastock RT is $250 a month. That includes the news that I was talking about before. To give you an idea of how much Reuters charges for their news, it's about $1,200. And it's just built into the cost of our real-time software. It also includes everything that's in the DC version of the program as well. Okay, it is a pretty big toolbox. So we have put together a bonus that I'm going to include all the training that we have for the Unleash the Power of Metastock, which shows you how to put your charts together, shows you how to use the power tools, shows you how to use the RMO, shows you kind of how to use Icon. All that's included just for free. The bottom line is I wanted to show you a few things that you can use right away to help you, but it's a toolbox, and if you know how to use a screwdriver, it's going to be better for you. If you know how to use it, it's going to work better for you. So this is the training that you'll need to help you get started. In any case, yeah, first month's for free. You can do real-time in DC. You could try real-time just so you can play with all of that really cool Icon news in Zenith, and then go to DC if you decide that $59 is enough for you. Take advantage of that. It actually says buy one, get two free. That is actually our extended trial. It's an incorrectly typed slide. It's actually a free trial. Just go to metastock.com/roundtheclock. If you have questions, go to metastock.com/saleschat. I'm glad that I'm the last speaker because I went 4 minutes over. Jeremy, yes, we're both right. They are in a different category.
You are the last speaker. Jeffrey, thank you very much indeed for that. That's been a great presentation.
I felt like I kind of had poor time management, but I felt it went well other than that.
You covered a lot, and you do have the last slot, of course, and I think people are a little tired because it has been a big day. Perhaps next time we can invite you back to join earlier on.
Okay, sure.
Maybe in the afternoon time. but it's been super to witness how you use the software. I can see there's obviously a lot more than what you've focused on a few of the strategies and the features today. There are obviously a lot more there, and it's nice to get that sort of testimony from people, long-term customers.
Yeah.
Like Henry, of course, who it must be working for him. No other reason than he would remain a customer for at least 7 years. So that's great news. Jeremy's asking, oh, there we are. Where can I find the new features of version 15? Version 15 seems to be the one that everybody's waiting for.
Everybody's excited about it, and to be frank about it, like it might go ahead, and you might just want to download the software on Tuesday, because then you're going to get the new version. Whereas if you do it before Tuesday, it's going to be the old version. But it's just a little bit of an awkward release. And yes, the version costs are the same, Jeremy. So it's still going to be the same pricing as what you see on the thing.
Fantastic. And that free trial, people can take that free trial, then they can upgrade at the end.
Yeah, absolutely. Or they could upgrade on Tuesday if they wanted to.
Yeah, fantastic. Great. Well, Jeffrey, it's been a pleasure to have you on. Thank you for coming on to complete our 12-speaker event for October. I can hardly believe that we're almost in November already. It's pumpkin and Halloween time this weekend, as I'm sure it will be across for you in the US. It's a US phenomenon that you've managed to export and pumpkins before. When I grew up,
started? I thought it was like the Catholics that started it.
I think it's a very American thing. Because certainly growing up in Scotland, we used to carve out turnips and put candles in turnips, of course, because they didn't grow pumpkins. But now, of course, they're everywhere.
So are you going to be dressing up children this weekend? Do you have kids?
I have a young Count Dracula who has already been dressed up a few times. 6-year-old son Harry, and he makes a very convincing Dracula, I have to say. So yeah, we're looking forward to that. Listen, thank you so much.
Thanks for having me. I'll see you at the next one.
Definitely. We'd love to have you back and to talk about something else in relation to the software as well. Give us another perspective on it. In the meantime, I will take the presenter role back. You have to excuse me, my voice is on its last legs, as my computer is as well. So there we are. That completes our 12-hour round-the-clock trader for this October, and it's been a pleasure to host the event for you all. Thank you very much indeed for staying with me through all the highs and lows of the internet, switching itself on and off, but nonetheless I think through it all we've all managed to gain something which we didn't have at the beginning of today, whether that's just one slight insight into how a market's going, or perhaps you've seen some tools that you think would help you in your daily trading, then all the better. That's what we aim to do. So thank you very much indeed. We will be emailing you out the recordings as soon as we can, the link to the recordings on the YouTube channel. And of course, we hope to see you all at the Round the Clock Trader live, the show, the trading show that I've organised for us all on the 5th of November in London at the Grand Connaught Rooms. So thank you very much again, and good night.